Good morning, ladies and gentlemen. Welcome to the FSM ETFestival 2022, the biggest ETF event in Singapore for retail investors. This is also FSMOne's first ever hybrid event. Other than our virtual viewers who are watching today's program from the comfort of their homes, we have also exclusively invited our valuable FSMOne customers to join us in person for our first physical event seminar since 2020. What an eventful 2 years it's been since our last physical event in January 2020. We've seen global markets hit by COVID-19, followed by waves after waves of volatility. Especially so in the year thus far, investors who are now in the midst of the storm could be struggling with whether to sail back to safety or to continue with a voyage to seek greater returns in faraway lands. Despite the rolling waves of uncertainty, we still believe the right ETFs are useful vessels that can help us navigate the choppy waters and weather turbulent storms. Today, FSMOne.com and our various partners and experts will chart the direction for where you can find both calmer waters and growth opportunities. Be empowered today with the know-how on to put together a portfolio of ETFs that can help you invest globally and profitably. Find the right ETFs that will serve as useful vessels to help you navigate the choppy waters and weather turbulent storms. We would like to take this opportunity to thank our partners, CSOP Asset Management, Nickel Asset Management, iShares by BlackRock, and UOB Asset Management for making this event possible. In addition to today's presentations, we've also lined up some exciting activities for both our viewers at home and our participants who have joined us in person here. This year, we have Stage B, a place where you can ask our partners and ETF issuers any burning questions you might have. They will be on hand in these Zoom rooms at the timings shown on screen. Next, in our two quizzes today, show off your knowledge and you could be one of the 10 winners to walk away with $100 cash account credits each. In order to take part in the quiz, you will need to log on to Event Live. Get to Event Live by scanning the QR code up on screen. We also have 2 lucky draws today where 14 lucky people who are here with us right now will each walk away with $100 FSM1 cash account credits. 2 extra lucky winners could also win a brand new Apple iPad or $500 worth of dining and accommodation vouchers at the Grand Hyatt. To enter the lucky draw, remember to tear out the lucky draw stub on your event flyer and drop it into the box at the FSMOne.com booth located outside. Make sure to do so before the lucky draws happen. If you're on social media and want to win more prizes, take the chance today. All you have to do is snap a photo of yourself at the ETFestival and tag FSMOne.com. On Instagram, you could be one of the 10 lucky winners to receive $50 worth of FSM cash account credits. Head over to FSMOne.com's Instagram for the full instructions. Let's begin today's sessions with a macro outlook as we look ahead to what the markets may bring. To tell us more, we have Tan Te-Jun, Assistant Manager for Research and Portfolio Management from iFast Singapore. A round of applause to welcome him. Te-Jun, please.
Testing. Okay. Hello? Okay, that's good. Sorry about that, everyone. Good morning, everyone, and welcome to ETFestival 2022. This is our first in-person event in nearly 2.5 years, and I have to say it feels refreshing to be at a physical event after so long, and I hope you feel the same way as well. So my name is Jun, and I'm with the research team here at iFast, and to kickstart today's event, I'll be giving you guys a short update on some of the key developments that have taken place in markets over the first half of the year. And immediately after this, we will proceed into a panel discussion where I will invite two of our very experienced panelists to join me on stage for an in-depth discussion on some of these topics, the market outlook for the year ahead, and more importantly, how you guys can position your portfolios amidst this uncertain environment. So without further ado, let's get started. So there are three key topics that I would like to draw your attention to. So the first is probably something that you have heard of and in some ways felt. So those of you who drive, you might have realized that going to the petrol station and filling up your car on a full tank now costs $120 instead of $80. Or your favorite hawker stall in your neighborhood hawker has actually raised prices. And that is because inflation is rising. As a matter of fact, inflation has risen sharply across most major economies and even here in Singapore. So Singapore's headline inflation was reported by MTI for the month of March. It grew by 5.4%, and that is the highest level since April 2012. So similar trends can also be observed in Western markets such as those in Europe and even in the US, where inflation rose by 8.3% year on year in April, which was just reported, and that is actually a little bit slower than the 8.5% in March. That was a 40-year high. Nonetheless, April's numbers are still close to the highest level in 40 years. And more importantly, with prices rising and showing no signs of easing, it's safe to say that the Fed was wrong about inflation being transitory and that higher prices is something that all of us will have to live with going forward. So there are a couple reasons why inflationary pressures are so high at the moment. So some of them, they have to do with pandemic-induced factors such as your labor shortages and your supply chain disruptions. So for instance, in the US back in January this year, when the country was actually opening up, lifting most of its COVID-19 restrictions and declaring that COVID was endemic, it actually saw a huge surge in COVID-19 cases, with nearly 1 million cases reported each day at its peak. And because of that, major US ports also suffered the worst congestion in decades, with dozens, if not hundreds of ships waiting off the coast of the US to unload their cargo, and that is partly due to a shortage of workers and truck drivers at the ports. And of course, this is also because of the fast-spreading Omicron variant. So as a matter of fact, ports in Southern California, which are among the largest along the west coast of the US, at one point they actually reported that nearly 10% of their daily workforce was actually unavailable due to COVID-19 related reasons. And that itself has resulted in logistic delays, supply chain disruptions, and that further drove prices higher. As a matter of fact, freight rates have actually increased by 4 times since the pandemic started, and that itself is putting pressure on businesses to raise prices, further driving up inflation. And now, with the recent lockdowns in China, we are seeing the same thing also, and that is also adding to your supply chain woes and inflationary pressures. So at the same time, the US economy is actually roaring back to life. It's very strong. Consumer spending is stronger than ever thanks to the pent-up demand. And with most of the COVID-19 restrictions already lifted since the start of this year, consumer spending has actually surpassed its pre-pandemic levels, even in somewhere around January 2021 already. So most of these consumers who were cooped up at home over the past 2 years are starting to go out once again, and they are increasing their spending on services such as travel and dining, which is pushing up services inflation and hence overall inflation. So another reason that explains the recovery in consumer spending is that consumer finances, they remain in great shape. Household balance sheets are robust, And thanks to the generous stimulus packages and also the significant accumulation of savings over the course of the pandemic, US consumers are now sitting on roughly $4 trillion in cash, the yellow line over here, which is significantly higher than pre-pandemic levels at about $1 trillion. And because of this, they are all going out to spend. And on top of that, the labor market in the US also remains relatively tight, with the US experiencing one of the lowest unemployment rates since the pandemic started. And because of that, employers, they are having difficulties finding the kind of talent that they need. And because of that, they have to raise wages, and that increases the disposable income, and thus fueling the propensity for consumers to spend even more. And now, of course, to make matters worse, Russia invaded Ukraine in late February, sending commodity prices from food to energy skyrocketing. So both countries, they are actually very important in the global supply chain. And the war in Russia-Ukraine has actually rocked commodity markets, because Russia and Ukraine, they actually both account for, together, these two countries, they actually account for nearly 1/4 of the world's wheat supply. And on top of that, Russia is also a major exporter of energy, especially to its neighbor Europe, where it is responsible for about 40% of the continent's natural gas imports. So right now, the EU, the European Union, it is currently deliberating whether or not they want to impose tougher sanctions on Russia because of its actions in Ukraine. And this includes a potential ban on Russian oil. And if this materializes, energy prices, they are likely to go even higher than current levels. And also, Sweden and Finland recently, they have been talking about applying for NATO membership, and Russia has stated clearly that they will respond either economically or militarily should that happen. And that is also adding more uncertainty into the commodity markets. So in essence, with the crisis in Russia showing little signs of ending, commodity prices, we think that they are likely to remain elevated for the near term, or worse, go even higher, and that should add to inflationary pressures even more. Now, with inflation running red hot, the Fed has finally kickstarted the current rate hike cycle by raising rates 25 basis points after its March meeting. So earlier this month, it followed up with another 50 basis point rate hike. So just for your information, the last time that the Fed actually did a 50 basis points rate hike was actually back in the 2000s during the lead up to the dot-com bubble. More importantly, the Fed has also signaled that more rate hikes should be expected, and rates could potentially go to as high as 2% this year. And before the March meeting, the Fed was actually a lot less aggressive, as they still thought that inflation was going to be transitory, and they were only projecting about 3 to 4 rate hikes this year, and assuming each rate hike is for 25 basis points, that will bring the Fed funds rate to 1% by the end of the year. So this was what they were expecting at the beginning of the year. So this dramatic shift in interest rate policy comes as the Fed has finally realized that inflation is no longer transitory. And not only that, because of its slow action, it is now already behind the curve, and they have to hike rates quickly in order to tame inflation. So the risk of such a rapid rise in interest rates, it raises the risk of a policy misstep, which could trigger a recession if it is not done carefully. So right now, I think the primary challenge of the Fed would be to tame inflation without slowing the economy too much. And with inflation unlikely to come down sharply, I think that rates are going to rise even further, and that investors should begin preparing their portfolios for a higher interest rate environment over the next couple of years. Now, turning our attention over to China, which is probably one of the few countries that is still continuing to pursue a COVID-0 policy. Shanghai has been locked down since the beginning of April, and there are rumblings that other countries like Beijing, other parts like Beijing and Hangzhou are also going to be locked down in the future. And that is raising some concerns about whether or not China will be able to hit its 5.5% GDP growth target for this year. So in response to the slowdown, the government has actually rolled out several policies to support the economy. So such policies include things like targeted financing for small businesses, tax rebates, tax cuts, And back in April, they also reduced the reserve requirement ratio for banks to ensure that there is enough liquidity in the market. The government has also pledged to ramp up their infrastructure spending to stimulate the economy. And it's not just for traditional infrastructure such as your roads and your railways, but also for advanced infrastructure, things like your cloud computing and artificial intelligence that will benefit the country in the long term. And with regards to the tech sector, this is one of the first times that the government has directly addressed the crackdown on the Chinese tech sector that has begun somewhere in late 2020. And what is important is that they have stated that they plan to wrap up the regulatory crackdown on the tech sector as soon as possible. And on the issue about overseas delistings, so China has been facing quite a bit of pressure from the US in terms of maintaining some of their companies on US exchanges due to the audit requirements. However, earlier this year, China made a rare concession by changing some of the rules, basically to allow US regulators full access to the audit reports of Chinese companies so that they can be compliant with the US regulators' laws and stay listed on US exchanges. So overall, we remain cautiously optimistic on Chinese equities. We think that with most of with share prices falling so significantly over the past year or so, most of the negatives have already been priced in. And looking forward, we do see a number of catalysts that could drive higher share prices for Chinese equities. So this includes stronger policy support by the government and also the further easing of the regulatory crackdown on the property as well as the technology sector. And in addition, 2022 is also shaping up to be a politically important year for President Xi Jinping, as the man is actually seeking a third term as China's president. So as such, he and his government, they will likely want to show that China has actually achieved great economic progress under his leadership to improve his chances of re-election, and therefore it incentivizes the government to roll out more supportive policies and ensure that economic growth doesn't go negative. And in terms of valuations, Chinese equities, they remain attractive as they're trading at about one standard deviation below their long-term average of about 12 times already. So at this point in time, I personally think that upside potential for Chinese equities, it actually outweighs the downside risk. And with that basically summarizes some of the key developments that have taken place in markets over the first half of the year. But stick around and we'll be back shortly with the panel discussion. Thank you.
Thank you, Dajun. For the next part of the segment, we'll move to a panel discussion where our panelists will discuss and share their views about navigating the uncertainty in markets today. We would like to invite on stage Chu Wing Kwong, Group Head of Portfolio Solutions, Senior Managing Director at Nickel Asset Management, Tan Dejun, Assistant Manager, Research and Portfolio Management at IFA Singapore, and Clara Cheong, as Executive Director, Global Market Strategist at JP Morgan Asset Management. They will further discuss what Dejun has just shared about navigating an uncertain second half of 2022. Moderating this session will be Jean-Paul Wong, General Manager at FSMOne.com, Singapore. Let's put our hands together to welcome them.
Thank you, Gladys, and good morning to everyone. So it's really a happy moment, I think, for me and also our team at FSMOne to see live audience, because it's our first hybrid with live audience and virtual audience attending FSM ETFestival 2022. So as my colleague Dejun mentioned just now, the last time we had our physical event with our FSMOne investors was back in January 2020. So almost 2.5 years of not being able to interact face to face. So gives me great pleasure to have all of you here in the live audience, but also of course virtually, where a lot of our investors are also watching us. So we come together at a time when global markets are being shaken. And as one of our clients mentioned to me this morning, his portfolio is in the red. I told him he's not alone. Of course, that's not of any comfort to him. But hopefully today, after the various segments, the various presentations from IFAS analysts and also our partners from the various fund houses, there will be useful insights that you could all take away from today's event. So as Gladys mentioned just now, I have with me Wing Kwong from Nikko Asset Management in the panel. I also have De Jun from IFAS research team, and I also have Clara, who is joining us via Zoom. Clara is from JP Morgan Asset Management. So Clara, good to see you as well via Zoom. So it's a really hybrid format, live and also Zoom. So what I'll do is I'll just run through a few points in our panel discussion first. So a backdrop firstly of how markets have performed. So as I mentioned just now, markets are in the red. Probably some of our portfolios are also in the red. And I think it's not a surprise. We see global markets, especially on this slide, we have the equity markets, mostly down year to date as of 10th of May. And in fact, I think the only couple of positive markets include our home market, Singapore, which has stood out so far this year. But I think the last few days also has corrected. There's been some downturns. But you can look at this slide and you'll go away with basically a conclusion that, it's been a tough year for markets because of the various concerns that De Jun has mentioned. And I just wanted to bring up this next point because I think one of the key concerns that has roiled markets and investors for the last few months has been inflation. So I think this chart that De Jun used just now basically is a good summary of what that means. The prices of goods and services has shot up considerably in various markets, including the US economy. Home as well, in Singapore, we've had that problem. I think the only very few exceptions to this trend includes the likes of China. So I think we'll talk about China quite a bit later. It gives them a bit more room in that sense to expand monetary policy in terms of how to grow their economy. And of course, what the Fed has done recently with its interest rate hike, especially the one in May, earlier this month, right? So that was 50 basis points. So that's like the largest rate hike they've done since 22 years ago. So it shows that they need to aggressively target inflation. They're worried about inflation because long-term inflation is not good for the economy. And my question here to my panelists, very first question is really, US Fed Chair Jerome Powell last year was still saying that inflation will be transitory. I think that has proven to be a wrong statement. In hindsight, of course, easy to say, but I think they're trying to be more aggressive. So my question to the panelists, and I'll start with Wing Kwong. So what is the right policy to ensure you can tame inflation on the one hand, and at the same time, right, while you increase interest rates, you also don't want the economy to slow down too much. You don't want a recession. So you don't want a situation of stagflation in the economy. So what is your view on whether the Fed will now get it right this time around and going forward? So Wing Kwong.
The Fed has a very difficult job because with inflation so sky high and there's a lot of political pressure for them to bring inflation down. This year is a very politically sensitive year in the US, not just in China. And my biggest worry is that the Fed might find themselves tightening in a slowing environment. If you look at leading indicators in the US right now, for example, the ISM, it is still above 50. It is in an expansionary territory, but we are already seeing ISM numbers coming down to especially important sub-index, ISM index like new orders and inventory build-up. And we are also seeing early signs of this demand destruction among the consumers. One bright spot at what De Jun said just now is really the US consumers has been doing fantastically well. In 2020, there was a huge fiscal transfer from the US government to US consumers through paychecks, to direct cash injection for them to spend. That is normal. And wage inflation is still very high. Unemployment is very low. So that allows the US consumer to continue to spend and even rotating their spending from manufacturing to services, like what Tejun has mentioned just now. But the risk is really that with inflation so sky high, we are seeing early signs of the housing market in the US slowing down. And also, if you look at the consumer sentiment, like the University of Michigan's Consumer Sentiment Index that was last released yesterday, we are seeing continuous deep slowdown in consumer sentiment. It has not really shown up that much in terms of the headline numbers yet, but my concern is whether we will start to see demand destructions leading to lower consumption growth, or if not even negative. I don't think that is negative, but low consumption growth. Or if you look at the US economy leading indicators like now, the risk is really for a softening of the US economy. I don't think we are there yet to say that we're outright recessions, but it will make the Fed's job more difficult in aggressively hiking interest rate to tame down recession as the US economy slows down.
It's a tough balancing act. You don't want to slow down the economy too much, but there were some indications from, I guess, the US Fed that they could expect the economy to somehow have to slow down. So it's the extent of, I guess, the slowdown. So whether that leads to a recession and whether it's short-term or whether it's prolonged. So maybe I'll invite Clara at this point to join us. So good morning, Clara. Good to see you. Do you agree as well with what Wing Kwong just shared? And what is your view on the Fed's policies, whether they're going to get it right, and what is right in this instance?
Yeah. First of all, can you hear me well?
Can hear you very well.
Okay, perfect. So I do think that, I agree that it's a very tough question to answer. And honestly, I don't think the Fed themselves actually know what the right policy is to, actually kill off inflation just enough, but not, kill the economy at the same time. But I think, what is apparent to me, at least from the last discussion at the FOMC meeting where, Chair Powell actually ruled out the 75 basis points rate hike, is because they do see that the nature of the inflation at the moment is a little bit different than what we're seeing in the past, right? Because I know there's been a lot of headlines about how services inflation is picking up, but if you do take a little bit of a closer look at the 8.3% headline number, a lot of it still comes from the more transitory components that are linked to the reopening. So think about things like your hotel prices, like your airline fares, like used car prices, energy prices as well. So these are things that are not very easily fixed just by raising interest rates, right? So I think what the Fed doesn't really want to do is to start off by being so overly aggressive at the early stages and then end up engineering a recession or something like a hard landing to actually kill off inflation, because like what you had already pointed out, there are some other forces at play that are already slowing the current US economy. So think higher mortgage rates slowing the housing market, and then you have also fading fiscal stimulus, and at the same time you have a US dollar that's extremely strong. So this shows that the Fed is being very thoughtful about the fact that monetary policy has often operates at a very large lag, which makes it difficult to actually gauge what higher rates mean for the economy at this point in time. So my personal view is that the Fed actually has a very decent shot at getting this right, just because of the starting point of the US economy. And I think many of you have already pointed out, and in the presentation today it was covered very well, that the US economy is continuing to emerge from this global pandemic. And while we could see demand from goods actually shift to demand for services, the US consumer actually still remains very strong, and corporations are in very, very good shape as of today. So, the strength of the labor market that we're seeing, yes, it might lead to some wage growth that is, not great for inflation. But, at the same time, I think it is a double-edged sword, right? Because this wage growth is exactly the reason why the US consumer is so strong. Because they have built up $2.5 trillion of excess savings during the pandemic. And, even with the energy prices that we're seeing today, it's estimated that it can only drag excess savings by about close to $20 billion. So you still have, a large amount of excess that the consumers are able to work with to get through this environment until inflation starts to moderate in the second half of this year.
Yeah, Clara, the point that you brought up about the US households still being very robust in terms of their balance sheets. I mean, Dachin had this slide on consumers' finances in the US. Still very strong. As you can see, the last few months, right, that trend, the lines are going up in terms of their net worth, the money that they have. So partly because of wages and maybe because of US market rally in the last couple of years as well, before the volatility in the US markets in more recent times. I just wanted to bring up this point because we talked about US economy, but I think we can't escape the discussion on the US market and its influence on everywhere else in the world. Because the last 2 years have been about investors making so much money. I hope it happened for all of you here as well. But we've heard about investors, very young investors as well, getting started, finding it easy to trade, and a lot of their trades have gone to the US stock markets. So the question is really, what's the outlook for the US stock market at this point? Because we've seen how badly whacked it has so far this year, right? And what's the outlook for, let's say, the remainder of the year? So I'll bring in Terjun in terms of the equity performance for US. What's your view?
Right, thanks, JP. I think the outlook for the US, I think my personal view is that equities, they are definitely not going to have the same kind of performance as they did in 2021. US equities is clouded by a number of issues, such as the Russia-Ukraine crisis and also the lockdowns in China. And some of these things are really out of control of the Fed, so they can't really do much about it. And on top of that, the financial conditions in the US are also starting to tighten, and that will weigh on business sentiment. And moreover, if inflation doesn't come down, then I think businesses, they will start to see margins come down, and they will start to take a hit from margins, and that will ultimately lead to lower earnings growth for US equities. So ultimately, I think for the first half of the year, US equities, the share prices have actually come down, but I don't think that they are extremely attractive at this point in time because just because how highly valued they were to begin with. And on top of that, like I mentioned, earnings growth is likely to see some form of downwards re-rating due to the factors that I mentioned earlier. So valuations, my personal view is that they are probably not extremely cheap at this point in time.
And I guess related to this point, you're probably finding better opportunities elsewhere. I think you mentioned China just now, right? So probably talk a bit more about that on the next couple of slides. But I'll bring in Wing Kwong. So do you also agree, Wing Kwong, with the Terjun's assessment on the US market?
It is a very difficult because right now the market is so volatile and there's so much policy uncertainty. So the way we think about it is we think in terms of different scenarios and different time horizon. The bull case, the bull scenarios, S&P has dropped by almost 15% this calendar year. The bull case is if we achieve a beautiful soft landing as what the Fed envisaged. I can easily see S&P retracing most of the losses within this year. And any zero COVID adjustment from China will be an added bonus. So that is a huge bull case. But my base case is that we will continue to see a bit more downside weakness, potentially even 5% or even 10% downside for this calendar year. So my base case is rather similar to what Terjun. There's a combination of but Fed will adjust along the way. They are also looking at how the economy and inflation and wage numbers, employment situation pans out. And we also have to remember that a lot of the problems the US market is facing is not just about Fed policy, but also the geopolitical uncertainty in Ukraine, the energy crisis, and also the imported inflation. Not everything is within the control of the Fed. So the base case is we probably see a bit more downside, 5 to 10% for this year. But if you have a longer time horizon, right now S&P is trading about 20 times PE, which has come down quite a bit. If you were to look beyond the 1 or 2 years, you're looking at S&P trading at 16 times, which is a really reasonable entry level if you were to start going in bit by bit. And my team has come into this year, from Thanksgiving last year, which was about end November, we have been increasing our underweight of equities to almost like 10%. No, my team will have been buying US equities now. We're going to slowly go back into the market, re-engage the market. But the bad case, which is not my central scenario, obviously, is you could potentially see another huge drop if the Fed is unable to tame down inflation, and if the US consumer is so worried and that they will stop spending. But that is quite an unlikely event for me at the moment. So right now, my advice is, not my advice, but my view is that the base case is just be nimble. If you have a longer time horizon, when it falls, it's a good time to go in if you have a longer time horizon, like 2 or 3 years out.
Yeah, thanks, Wen Kuang. And Clara, I'll invite you as well to comment on the outlook for the US market going forward.
Sure. So I agree with a lot of the points from the other panelists. And I think one thing I would say is that we can also employ the same level of flexibility as we do to different equity regions as to different equity sectors or styles. So I would say we do continue to like US equities as the earnings outlook still remains relatively strong. So the last time I checked, despite whatever that has gone on in the markets thus far, excuse me, the earnings outlook for US is still north of 10% for 2022 as well as 2023, and it was actually pretty surprising to me that actually analysts haven't really downgraded like the earnings outlook at all. In fact, the cumulative year-to-date revisions remain quite positive, about 2% or so, which is in stark contrast to what we've seen in other places like Asia ex Japan, for example. And overall, I think we do need to realize that the US is still a market with stronger fundamental metrics, right? Even though valuations are not cheap, you are paying for that higher quality earnings stream there. And the fact that it's derated to around 15-year historical averages, I think is a good time to consider to start to leg in back to US equities, as we do still continue to think that the growth environment is quite strong there. And within the US, I do think that in this environment we still have a slight preference for value versus growth. Because the positive earnings growth outlook is actually very much driven by cyclical sectors still, like energy, industrials, consumer discretionary. Tech is something that comes up a lot. It's still quite expensive even after the sell-off, but there will come a time as we progress through this cycle and enter more of like a later stage cycle where tech as well as growth exposures will become more attractive again, just because as the macroeconomic outlook becomes more lackluster, then people or investors will start to search for more growth opportunities, and typically they will tend to gravitate towards tech because tech continues to be a beneficiary of secular themes. So think digitalization of businesses that has a very strong long-term potential for relative growth versus the market. So yeah, that's my 2 cents on US equities.
Yep. Thanks, Clara. Very good insights from on this point, I think. We'll talk a bit more about, I guess, asset allocation as well. So US and other markets and other sectors in our portfolios later on. So I'll move on to the next point, which is on the war, the Russia-Ukraine war. So I think it's coming to close to 3 months old. And that has, of course, led to a number of disruptions, whether it's on the supply side, commodities prices especially, because both Ukraine and Russia are major producers of a certain amount of commodities as well as energy. So the question here is, what does this mean for us investors? Should we, expect that commodities prices will continue to shoot up? And should we then consider inflation hedging ideas in our portfolios? And if yes, what are some examples of those ideas? Wing Kwong?
I think inflation, my team's view is that inflation will stay elevated for quite a while. Not at 8-9%, but most probably at 3-4%. That is still very high compared to what we have experienced in the last 20-30 years, since 1970s. It is not just because of Ukraine-Russia war. There's also a huge underinvestment in a lot of the commodity industry, in energy and material and mining industries. And now we're also faced with huge demand in commodities coming from the green transitions. And this green transitions is a multi-year, maybe more than 10-20-year runway to go. So on the demand side, I really see a lot of demand for commodities. On the supply side, there's not been huge investment. So the case for commodities is a good one. And so all of us should start thinking about how do we inflation hedge a portfolio. There are at least two ways. The first is buy into things that is exposed to the commodity complexes. This could be in oil companies, in even countries that is net commodity exporter. It is no surprise that, like what Terjun said, Indonesia is one of the best performing countries this year. And the other thing that is worth considering in part of this inflation hedge is really buying to stocks of companies that have huge pricing power, that can pass through this inflationary to their end customers. And so it is really worth thinking about building up a portfolio of good quality companies that can do that.
Yeah, thank you. And Clara, would you have similar ideas as well?
Yeah, so I think there are a lot of confounding forces that are impacting commodity prices. So on one hand, you have the Russia-Ukraine war and the supply chain disruptions that's really causing elevated commodity prices. But on the other hand, we also have to think about what's happening in China right now. There's waning Chinese demand due to the lockdowns, as well as some growth fears that are seeping into the market. And there's also a slowing U.S. economy is another one, right? But I think, yes, overall, I agree that, commodity prices should remain relatively elevated. But do I think that it will go a lot higher from here? The answer is no. But typically, if you do have an environment that is slightly more inflationary, commodities tend to do relatively well in those types of environment. And, actually, equities have also historically delivered on its role as a pretty good inflation hedge over the longer term, obviously, and when inflation is not as volatile. But I think another interesting asset class that I wanted to highlight to investors is also alternatives, right? So I'll think about alternative assets like transportation, like real estate assets, infrastructure. So all of these, can really help to, generate income in a portfolio, as well as to help to hedge against inflation. Because if you look at private real estate investments, typically they do have a clause in the rental contracts that's tied to CPI. So it's linked to what inflation is currently doing in the economy. So in a sense, the rental income that you're receiving is kind of protected against the rate of inflation in the economy at the moment as well. So I do think that these opportunities in the alternative space can help to provide some kind of exposure to some unique growth opportunities, as well as a form of diversification, as well as an inflation hedge for investors.
Yeah, thank you, Clara. And I'll move to the next topic, which is China. So Terjun just now, he shared this slide as well, as one of the supporting factors as well to show how the valuations of the China market have turned pretty attractive. But of course, for China, I think most of us, or at least for myself, have some exposure to China equities and even fixed income. It's been an interesting, I guess, market because it's done so poorly the last few months. And you have to balance on the one hand that there's, that the competition and that geopolitical risk between US and China. And, there's even been news that Chinese regulators have met with banks on how to protect assets in case there are US sanctions. So I guess in the wake of what's happened with Russia. And you also have, of course, the negative news, disruptions on supply chain and so on because of, their severe, very strict zero COVID policy. But on the other hand, and I think Terchin mentioned that, the crackdowns are possibly, coming to the tail end of it, and delisting risks are also subsiding. And of course, I mentioned just now, inflation risk in China is actually in a very unique situation. It's not like the US. Prices haven't really skyrocketed in China. And what that means, of course, is Chinese authorities have the possibility of playing with monetary policy, expanding fiscal policy to boost the economy, right? So those are good things. How do you balance those two, situations, Wing Kong, for you?
I think the biggest catalyst I'm looking for in China is really their adjustment away from their zero COVID policy. My fear is that no amount of fiscal easing or monetary easing will boost the economy unless you allow the normal economic activities to carry on. And one thing that is really hampering normal economy activities from carrying on is really the zero COVID policy. So on the margin, we definitely see a lot of potential for the Chinese government to ease monetary policy and do fiscal priming, especially infrastructure investing, like what we were told. But I think the number one catalyst I'm looking for is really they are stepping away from the very strict zero COVID policy and allowing normal economic activities to carry on. Within the China space, we find local assets, local RMB denominated assets to be really interesting. And for example, we have a basket of local consumptions that we are building up right now because they're really very low valuations. So rather than overweighting China tech, and right now actually investing a bit more in China consumption story. Not for now, but in preparation for an adjustment on COVID policy that will have to come. It's just a matter of when. Local Chinese government sovereign bond is also something interesting to do because on the margin, we do expect the Chinese government to be more fiscal and monetarily more supportive. But the risk there is really whether we will see any weakening in renminbi. Renminbi has been extremely strong in the past few years, 2 years, until the recent few months. So there is the risk there. So we are not in a stage whereby I'm moving hugely into Chinese assets at the moment, but we do start to look into it, especially a local Chinese consumption story, which has been it has slowed down because of COVID situation, but it's still a long-term story for us to play.
And Clara, do you agree that we should slowly build up, let's say, the exposure, and then what sectors in that, in China for yourself?
Yeah, I definitely agree that controlling the pandemic is absolutely key, and moving away from COVID zero, I think, is going to be very difficult politically for this year. But we're really seeing quite encouraging developments in how the government is actually making some creative tweaks towards the definition of what COVID zero actually means. So I think recently there's been an announcement that COVID zero is achieved if there's COVID zero within the community. So instead of just focusing on COVID zero stance, right, they are kind of like broadening the definition to include, so if there are no new cases within all of the quarantine facilities, the hospitals, as well as the buildings that are currently in lockdown, that will really enable the government to declare that a particular district or community has achieved COVID zero. So this has really, helped with the reopening that we're seeing in Shanghai, where the local government has already announced that at least 10 out of the 16 districts in Shanghai have achieved this COVID zero within the community. So I think it's an encouraging development in the right direction that will help them still kind of adhere to COVID zero and put the health of the Chinese citizens first, but also not tie their hands at the same time with regards to helping the economy to continue to reopen. And because of these developments in this direction, we are actually quite positive on Chinese equities. And I think overall, the rhetoric coming out from the Chinese authorities have been very incredibly accommodative. And I thought it was particularly helpful that President Xi himself came out to speak about how they're going all out for infrastructure push as well. So we do believe that in due time, as the pandemic is under control, the Chinese government will come out to do more stimulus, both from the fiscal as well as the monetary policy front. And with that regard, I think it's the cyclical sectors that will benefit more in this current environment and the setup.
Thanks, Clara. And I guess zooming in very specifically on China tech. So I'll bring Jun in at this point. You talked about Chinese equities looking attractive, looking at its forward PE ratios and comparing historically, right? So for Chinese tech, do you see something similar as well? Is it looking increasingly attractive for you?
Thanks, GP. So I think with regards to the Chinese tech sector, obviously it has been in a sell-off since end 2020 after the government cracked down on Ant Group's listing, and after that it escalated into a number of things. Alibaba was investigated for its anti-competitive practices. There was a crackdown on the edtech sector, and I think throughout 2021, most of the trading that's been going on in Chinese tech names is mostly sentiment-driven. However, I'm starting to see a change in tone from the government between 2021 and today. So in 2021, they talked a lot about common prosperity, equal distribution of wealth, ensuring that consumers are protected. However, in 2020, with COVID zero policy continuing, economic growth is obviously slowing. I think the government is aware of that. And since then, you can see that they have started to mention the word stability more often. And in fact, they haven't really talked about common prosperity or any thing related to the tech sector. And on top of that, I don't think that there has been any major crackdowns on the tech sector for quite some time already. So, and in addition, the government has already mentioned that they want to wrap it up as soon as possible. So I think there's probably light at the end of the tunnel there. And also, the tech sector in China is huge. It employs a lot of people. So by affecting the outlook of these companies, you are also indirectly affecting the likelihood of Chinese consumers. And I think that's something that the Chinese government is very wary of, and they might not want to take things too far. So I think, yeah, probably Chinese tech sector could recover this year or next.
Thanks, Chun. Just now, Wing Guang, you mentioned about Chinese assets that you are slowly accumulating some of your favorite ideas. So if I move to fixed income, which you alluded to just now, so are you worried or do you see some light at the end of the tunnel as well for Chinese high yield, especially the property sector, because that's the sector that has been hit, with the default risk rising and so on, right? So what's your outlook there?
Generally, I'm a bit more sanguine on that. If you look at the supply side, the Chinese government seems very aware of the contingent risk of not holding up the Chinese property sector. So that's why we've been seeing administrative measures, including asking banks to be to loosen their lending to property sectors. And that is a good sign. But ultimately, you also must have demand side kicking in. And right now, many of the Chinese property companies sell their properties through pre-sales activities. And pre-sales activities has come down by almost like 50-60% because people can't go around viewing flats because of COVID policy. So ultimately goes back to the point that, well, the Chinese government is clearly aware that they want to control the contagion risk in high yield, especially the property sector. That will most probably provide a good backstop to how far lower it can go, how far lower it can drop. But to have a clear rebound, you do need the demand side catalyst to come in, and which is really needing people to start buying properties again, right? And that has to really come with adjustment line of the zero COVID policy. If not, you probably won't see a quick rebound in Asia high yield, particularly the properties.
Going back to your catalyst on COVID-0 for China, right? So Clara, for fixed income in China, with regard to Chinese property and Chinese high yield sectors for fixed income, right? What's your outlook?
Yeah, so I think Chinese developers have created a lot of problems for Asia high yield market over the last year or so, and with Chinese real estate actually accounting for about 40% of Asia high yield, it is not very surprising that the spreads are trading close to 1,000 basis points for overall Asia high yield, which is 2.5 standard deviations cheap versus the average. And I do think that there's a recovery story to be thought about, from Asia due to the overall reopening, the fiscal and the monetary stimulus that we expect to see out of China, and broadly, more support from the government for the Chinese property sector. That should overall create a more favorable environment for Asian fixed income and Asian high yield in particular. But I do think that credit selection is really, really important here in order to avoid some of the poor outcomes and the most troubled developers in terms of credit metrics. And I think one of the clearest points to how the high yield market in Asia has actually done a very, very good job in kind of segregating where the troubled spots are with the rest of the market is if you look at ex-China real estate, Asia high yield spreads, it's actually just trading at close to 500 basis points, which is much more reasonable and only close to 0.5 standard deviations cheap versus the 10-year average. So I do think that investors, the Chinese regulators are not going to make a significant U-turn in terms of what they've implemented so far in order to enable the property sector to be able to deliver more stable growth and sustainable growth over the longer run on a go-forward basis. But I do think that if investors do want to link back into this space, you have to do so very carefully and probably work with an active manager to select more superior credit.
Yeah, thank you, Clara, on the points shared on Asian high yield and Chinese high yield. I think a number of our investors have exposure there, and obviously it's a sector that's been extremely volatile for the last few months. I'll wrap up with the last discussion point, which is just taking a step back for our portfolio in terms of asset allocation between equities and fixed income. Traditionally, that's how we've been looking at it in IFAS. In terms of building a portfolio, do we overweight equities or fixed income at this point of time? And within equities, then what are the ideas we like? And within fixed income, what do we like or don't like? So I just wanted to wrap up here, and I'll bring all of our panelists into this point. I think Warren Buffett, as you know, has been on a buying spree. He's been buying quite a lot of things. Activision Blizzard is one of the stocks he bought. He was literally on a roll at his recent AGM with Charlie Munger in terms of a lot of the things that he said. So when Buffett buys, doesn't mean we have to buy. I mean, of course, a very different budget size in terms of what we can buy. But maybe more importantly, what should we do? Asset allocation, overweight what, and what are sectors you like? So Wen Kong?
Warren Buffett has a very long time horizon.
Even at his current
yes, correct.
age.
Yeah, he thinks multi-generation. And I think we should all adopt some of that. And there are a few long-term structural trends that is happening. Green transition, elevated, commodity price going to stay elevated. And these are some important structural trends that we can latch on. But in the shorter term, my strategy is really to be nimble. And because I do expect market to be continuing volatile, but because my portfolio is starting from a point of huge underweight equities and starting to buying back, I don't think now is the time to sell. But if you do allow yourself to lengthen your time horizon a bit, now is a good time to buy, to start nimbling in according to your own risk appetite. So yes, we should really think in terms of adopt Warren Buffett mentality to a long term and start building our portfolios if you not have been right now. In terms of asset allocations, I totally agree with what Clara mentioned about the alternatives. And in fact, that is one of the biggest talking points that my clients and I are having. So, and particularly among the alternatives, what looked really interesting to us are really very asset-based type of alternatives. For example, one of the things that we're looking into right now is actually buying the agricultural land. Right. So these are very real, tangible, real asset-based investing, which tick the boxes in terms of being a good inflation protection, in addition to being long equities, especially long, good quality equities with pricing power. Right.
Yeah, which reminds me of what Charlie Munger said: buy farmland better than crypto, right? So, so Clara, what are your views on this point?
Yeah, so I do think that staying invested through volatile times is quite a difficult thing to do, just because of our behavioral tendencies. But I think what investors should really note is that success in investing is really achieved through time in the market, and it's not timing the market. So it's quite tempting to try to get out of markets into cash and search for a better entry point during these sell-offs. But more often than not, what we see from historical analysis is that investors actually do miss out on the best days of the recovery, and those that do miss out will see a significant degradation in how their portfolios actually compound over time. So for me, I would actually use this sell-off as an opportunity to, find the high conviction themes that you believe in, right, and these ideas, and actually add to them, because these companies that have really longer term potential are pretty much on sale right now. And for the asset allocation question, I think we've been getting this a lot nowadays from clients that, do we still rely on equity bond allocations? And I think my answer is still yes. But definitely there are times when equity bond correlations do break down. And historically, what we do see is it tends to break down a little bit more when inflation is more dominant in the macro story. But it doesn't mean that there is no diversification benefit to owning equities and bonds. And so what I would really recommend investors is, maybe still stick to equities and bonds, but look outside that by considering things like alternative investments, like I had mentioned earlier, with regards to real estate, for example. The contractual negotiations and the leases typically have some kind of inflation-linked clause that's baked into it, so that can help with your cash flow during inflationary times. And also, on top of that, one of our highest conviction ideas is really Asia ex-Japan equities. And a large part of that is actually a reflection of our conviction in China, as well as the broader reopening and the cyclical recovery that this region as a whole hasn't really gotten the chance to experience versus, what has been going on in the developed world. And the sentiment in Chinese equities is already very, very weak. So I think if you think think of risks on a spectrum, I think it is asymmetric to the upside that these markets will tend to do a little better on a go-forward basis versus much more downside from here.
Yeah, thank you, Clara, for the insights, and we'll wrap up with Jin's views on this question.
Thanks, Sripi. So some comments about Warren Buffett first. So first of all, Warren Buffett, he is a professional investor. And like most professional investors, they have better access to information and therefore they can make better informed decisions. But not all of us can be Warren Buffett. So, but one of the things that he advocates is diversification. And I think that's something very relevant and all of us should take note of. And I think my colleagues and our partners later on, they're going to share some of the ETF ideas. And I think ETFs are actually a very good way for you to diversify your investments in the event that you are not very confident in your stock picking skills. So that's one thing. And in terms of the question about my highest conviction idea, it actually has to do with something that Clara brought up just now. So just now, Clara, when she was answering the question on the US, she brought up something on digitalization. So my idea is also related to digitalization, but it's not the internet companies, it's actually the semiconductor companies. So personally, I really like semiconductor companies. I think they really have a place in our world, especially if you think that the world is going to be more tech-driven. Every day we deal with tech. So to take cars, for instance, maybe 50 years ago, there isn't even a semiconductor inside a car, but now with electric vehicles, the silicon content in cars have increased by 60-70%. And I think the long-term story for semiconductors is actually quite simple, and that is if, as the world becomes increasingly digitalized, we will need more semiconductors to actually support all these underlying technologies that we deal with daily, your iPhone, cloud computing, even this mic that I'm using right now. So yeah, I think that would be, to answer the question, semiconductors would be my favorite investment idea right now. Okay. Yeah.
Thanks, Tejun. So thank you to Clara, Wing Kwong, and Tejun. I hope the audience has enjoyed the insights. And with that, we have come to the end of the panel discussion. Happy to catch some of you and later on for face-to-face discussions, something we've missed for 2.5 years. Thank you once again. Bye-bye.
Thank you, John Paul and the panelists. Next up, we have Chloe Nadia Halim, Research Analyst for Research and Portfolio Management from IFA Singapore. She will be sharing with us the latest edition of the ETF Focus List. Give it up for Chloe.
So hello everyone, thank you for joining us today. My name is Chloe. I'm a research analyst from IFAS. Today, I'll be sharing more about our ETF Focus List, which contains some of the best-in-class ETFs and serves as a starting point for your investment journey. So here's the outline of the presentation today. I'll start off by giving just a brief introduction to ETFs, followed by moving on to share about how we choose our ETFs. Last but not least, I'll be sharing some snippets of our 2022 edition of our ETF Focus List. And this could actually help to guide you through your investment journey. So without much further ado, let's begin with a brief introduction to what exactly are ETFs. So an ETF is actually an exchange-traded fund, and they represent a basket of securities that allow us to reach every corner of the market. So an ETF can contain that of a portfolio of stocks, bonds, as well as other asset classes. And most of the ETFs out there, they're passively managed, and they aim to produce a return that replicates an underlying index. So the underlying index, in a sense, could be a market index like the STI, as well as the S&P 500, or an index that is for a specific sector like the Hang Seng Tech Index, which tracks a basket of Chinese tech stocks. As mentioned just now, there are many different types of ETF, and the range is so wide that it allows us to reach every corner of the market. So the most common type of ETFs will be that of equity ETFs, and they track this equity market of a specific industry. There are also a lot of fixed income ETFs out there, and they can track a corporate bond market or a government bond market. So other than these two types, ETFs can also provide us an exposure to alternative assets, and this can actually serve as a hedge for one's portfolio, such as commodities as well as currencies, for instance. So given that there are so many ETFs out there, choosing the right ETF could be actually a pretty daunting task. And given that not all the ETFs are made equal, I would like to share a few factors to consider when selecting an ETF. And this is also the methodology that we will use for our ETF focus list. So when choosing an ETF, we consider things such as the quantitative as well as the qualitative factors. So under the quantitative factors, we consider things like the expense ratio, liquidity, as well as tracking difference. So first, when we look at the expense ratio, and this is actually the annual cost that investors have to pay in order to cover the ETF's operating expenses as well as management fees. So we tend to prefer ETFs that have a lower expense ratio, as all things equal. Assuming that an ETF has a lower expense ratio, it also means it lowers your net cost, and this would translate into higher net returns. The second factor we consider is that of liquidity, and this refers to how easy it is to buy and sell an ETF without affecting its price. So we prefer ETFs that are more liquid. So this means that it will have a higher daily average volume as well as a smaller bid-ask spread. So lastly, for these quantitative factors, the third factor we consider is tracking difference. And this is the difference between the ETF's performance and the performance of the underlying index, as most of these ETFs out there, they actually track an underlying index. So all ETFs will have this tracking difference, and this usually is due to factors like expense ratio, rebalancing costs, as well as currency hedging costs, so on and so forth. So having a smaller tracking difference is more desirable, and it means that the ETF is closer to the performance of the underlying index in the sense that you're trying to track. So after considering these quantitative factors, some other qualitative factors we choose to look at when going about our ETF selection methodology is that of the choice of index. So this is pretty important, as the underlying index has to be a good representation of the market and the sector that the ETF is intended to track. For example, if you want to, let's say, access Chinese tech stocks, the Hang Seng Tech Index in this case would be more relevant than, let's say, the Hang Seng Index. So one way to gauge the underlying exposure is to actually look at the investment objectives as well as the top 10 holdings, which can all be found in the ETF fact sheet. Next, for the other qualitative factor we look at, we consider the structure of an ETF. So ETFs can come in either a physical or synthetic structure. The majority of ETFs out there are physical, and what this means is that they actually hold the underlying securities that make up the index that they are tracking. However, there are a couple of synthetic ETFs out there, and they rely on derivatives such as swaps to execute their investment strategy. So it allows investors to actually gain exposure to illiquid markets as well as hard to access markets such as commodities. But synthetic ETFs, they use derivatives, and so investors are often exposed to the counterparty risk. So we generally prefer physical ETFs, as in this case, they tend to have less and limited counterparty risks. So this sums up the various factors we consider in our ETF selection methodology. And with this, I've actually hoped to have given perhaps a little idea on how we go about selecting ETFs for our focus list. And so with this, we also reached the highlight of my presentation today. And this includes sharing snippets of the latest edition of our ETF focus list. So to help guide investors through their whole investment journey, we first introduced this ETF focus list in 2018, and we sift through thousands of the ETFs out there to identify the best-in-class ETFs for our ETF focus list. So to ensure that our recommendations, they also remain current as well as relevant, this ETF focus list is updated on an annual basis. So we have made a couple of changes to this list this year in order to reflect the wider range of the ETFs which the world has to offer. So firstly, we made changes to our China A-share recommendation under the core equity category. So China A-share here, it refers to those stocks that are listed on the Shanghai as well as the Shenzhen Stock Exchange. So there are two common indices that are typically used in order to track this exposure, and this is the CSI 300 index as well as the FTSE China A50 index. So this CSI 300 index, essentially what they track is that they track the largest companies trading on the Shanghai and Shenzhen Stock Exchange, and they are considered the blue chip index for mainland China Stock Exchange. While this FTSE China A50 index, on the other hand, they actually track about 50 of the largest companies that are trading on the Shanghai and Shenzhen Stock Exchange. So seeing that this CSI 300 index is the more commonly used mainland China benchmark and comprises a wider universe of A-share companies as opposed to that of the China A50 index, we actually decided to change our recommendation from the iShares FTSE China A50 ETF to that of the iShares Core CSI 300 ETF this year. And also in light of whatever is happening in terms of the geopolitical tensions and Russia's invasion of Ukraine, many countries out there, they have imposed sanctions on Russia. And due to a lot of this severity of sanctions, as well as ethical issues that are now facing Russian companies, we believe that most fund managers will not be able to wait out this situation and will be forced to pivot away from Russia or forced to close entirely if they fail to do so. And more importantly, we are aware that these armed conflicts are a violation of human rights and they cause substantial humanitarian suffering. So as a research house, we do have a responsibility to uphold our investment values as well as ethics in light of all these human rights violations. So in addition to removing Russia from our ETF focus list, we've also disabled Russian products and ceased coverage on Russia. And next, we've also added China property bonds into the fixed income category. So as we all know, this Chinese property sector, they saw turbulent times in 2021. And following the dramatic sell-off last year, we believe that investors have actually priced in a large degree of credit stress. And the spreads of China property bonds, they've also reached one of their highest levels on record. And so with the worst of likely behind in terms of China property sector, we think that this year could actually be a better year for the sector as a whole. And supportive policy fine-tuning has actually been rolled out in China to prevent a systematic crisis and also to stabilize the housing market. So we see that these bonds, they offer a combination of high yields as well as shorter duration. And with this, we actually recommend the Premier China USD Property Bond ETF for such exposure. And besides some of the key changes mentioned above, we've also made notable changes to the tactical plays category. Firstly, we removed China financials from this tactical plays category. Our previous recommended ETF for this China financials was the Global X MSCI China Financials ETF, also known as CHICS in short. And this ETF has many similarities with our ETF for China banks. And this is the China AMC Hong Kong Banks ETF, also known as 3143. But given that the previous recommended ETF for China financials is CHICS, and CHICS is US listed, so what this means is that it's subjected to a 30% dividend withholding tax. And after considering the dividend withholding tax, this average forward dividend yield for CHICS is about 5.25%, and this is compared to that of a 7.29% for this China AMC Hong Kong Banks ETF, also known as 3143. So this makes CHICS less attractive for income-seeking investors, and hence we have removed China financials from our ETF focus list. And you can see the overlaps within the next slide. So as seen in the table here, As seen at the table here, you can see that there are many overlaps. Sorry. If you see in the table here, that the ETFs, they actually share many similar holdings as highlighted in bold. So for instance, things such as China Construction Bank, as well as the Bank of China and China Merchant Bank, these are the common holdings within the ETFs. And besides these removals, we've also made about 6 new additions to our tactical plays category. And we included things such as China electric vehicles, as well as China clean energy as new additions, as we see the rapid expansion and growth of these two sectors, especially going forward. And do note that the Chinese government is also supportive towards the development of both these industries due to their alignment with their long-term green goals, as China ultimately has this goal of achieving peak carbon emissions by 2030, as well as carbon neutrality by 2060. So we think that these two sectors could benefit from such long-term plans. So cybersecurity is another new addition to this tactical plays category, as increasingly the world is undergoing this massive digital transformation, and cybersecurity has become more important than ever. So cyber attacks have increased in greater numbers, and there's a need to actually impose new and tighter cybersecurity laws on organizations to protect as well as to secure their data. So we think that moving forward, those investors who are keen on this sector can actually consider the Global X Cybersecurity ETF. And this is designed to actually track the performance of the companies that are primarily involved in cybersecurity. So besides cybersecurity, as seen here, we've also added robotics as well as AI to our tactical plays category. Increasingly, we find the case where robots are increasingly now more commonplace in both the manufacturing floor and our daily lives. So artificial intelligence has also allowed these robots to become increasingly efficient. So given this trend towards the greater automation, robotics and AI, they are the industries of the future, and investors can gain exposure to this sector via the Global X Robotics and AI ETF. And these are the last two additions that we have made to our tactical plays category. And as seen here, they are that of the agribusiness as well as the metal sector. So we've decided to include agribusiness and been covering this space since August last year, due to the fact that increasingly we find the issue of food security has become increasingly brought to the forefront, especially now with the rising food price and with the current Russia-Ukraine war. So this food business is a critical industry and one that is growing in importance as well as opportunity for investors, as the broader secular trends such as population growth as well as income growth, they've also underpinned the industry's long-term potential. So investors who are looking to tap into this mega trend should consider the VanEck Agribusiness ETF, also known as SMOE. For metals, we see the case where the world is moving towards this clean energy transition, and these rare earth and strategic metals, they've made this possible. So they are important in developing both these emerging as well as new green technologies. And so investors who are interested in this space may consider the VanEck Rare Earth Strategic Metals ETF. So to view this full list of ETFs, please visit our FSMOne homepage, then go to the ETFs or the Research tab, and you click on the ETF Focus List. And you will then arrive in this page. And then you can switch between the 6 different categories that we offer as shown here to actually discover our ETF Focus List. So all in all, our ETF Focus List, they serve as a good starting point for investors who are seeking diversified exposure to markets at a low cost as they zero in the best-in-class ETFs. So you may notice that some of the ETFs from last year, they did not make this year's ETF Focus List. But if you're holding on to them, please do not worry, as they are still viable investment options for your portfolio, and they will continue to remain available under our ETF regular saving or RSP plan. So with this, I'd like to thank everyone for coming here today, and I'll come to the end of my presentation. So thank you very much.
Thank you, Chloe. Before I introduce the next session, I'd like to remind everyone in this hall today that in order to participate in the lucky draw, you have to drop the lucky draw stub found in your event flyer at the FSMOne.com booth located outside. Now on to our next presentation. In recent years, investors have become accustomed to a world of very low interest rates and subdued inflation. But that looks set to change this year. How should we position our portfolios in a rising rate environment? To share with us more today, we have Bruce, Hui Xian, Jing Yan up on stage. Give them a round of applause to invite them up. Joining us here, first up, we have Bruce Zhang, Fixed Income Portfolio Manager at CSOP Asset Management. Hui Xian Kui, Director of the Product Strategy Team, Global Fixed Income Portfolio Management Group at BlackRock. Moderating this session is Cheng Jing Yan, Research Analyst of Research and Portfolio Management at IFA Singapore. Over to you, Jing Yan.
Thank you, and hi, good morning everyone, and welcome to today's discussion. So joining me today are Hui Xian and Bruce. So maybe we could start with a short introduction, starting from you, Hui Xian.
Sure, my name is Hui Xian. Thanks for having me, everyone, and for attending. Great cracking agenda, glad to be part of this. I look after the fixed income index and ETF business for BlackRock based in Singapore here. So everything you've heard about iShares, especially when it comes to bond ETFs, is right up my street, and I'm very excited to be talking about what to do with bonds today.
Yeah, good morning, everyone. My name is Bruce. I'm currently working at CSOP Asset Management as a fixed income portfolio manager, mainly covering the onshore China bonds as well as Singapore REITs. So today I'm happy to share more views on the back of the higher interest rates. Thank you.
Okay, so Bruce, at the start of the year, the market consensus was maybe 3 rate hikes this year and another 3 next year. At least that was what happened in January. So obviously that has changed quite a bit, and we have seen the interest rate hike expectation go up quite a lot. So maybe the question is, how did this escalate so quickly?
Yeah, sure. I think to understand why the Fed is so aggressive this time, we maybe review the different priorities of the Fed over different time of periods. And since 2019, the Fed's monetary policies is mainly based on 2 factors. One is inflation, and the other is the job market. But after the outbreak of the COVID-19, it's obviously the job market was the top priority. So at that time, the lower interest rate did support the growth, as well as boost the core inflation in the later stage. But however, as the commodity prices started to accelerate, in particular early this year in the Russian-Ukraine war, there was a mounting pressure which forces the Fed to hike sooner rather than later. And now the market actually expects the Fed fund rate target range to 2.75% or to 3% in 12 months period of time. But what we should care more about here, is that the bips hike of each time. because the lack of the 75 bips hike in the most recent decision doesn't mean the zero possibility in the future, because the Fed's attitudes towards the tightening can be changed quickly if the data warrants it.
Huisin, you got anything to add?
I think you're spot on, but I think it's probably also useful to give some context on when, Jing Yan said, how did it escalate so quickly? How quickly? We're talking about the past 6 months or less.
Yeah, about 6 months.
I think at the start of the year, rate hikes were pretty much very evident for the market, right? Actually, for 2 years, you have 0% in US bonds, something we've never seen before, but heralded as something that was needed to be done to fight COVID. And now I think we're in a better place because there's yields now, right? You need yields for your bonds to generate income. How did it escalate so quickly, though? So I have some data here, so I don't get my numbers wrong. At the start of the year, everyone thought 2022, 3 rate hikes, 25 basis points each, so you get to where 1 year you can at least earn 0.75%. Now, it's all pretty much magnitudes higher. So I've got here 9 25 basis points hikes expected for the year. That's consensus right now. 9 times 25 just for the year. And what's actually happened just Wednesday is a 50 basis, not just Wednesday, I think a few weeks ago now. So the latest FOMC Fed's meeting is 50 basis points. So the market is now keeping to push and push and push all the expectations. So just to put some context there. Short answer, jobs and inflation. It's a balancing act, right? The Fed needs to make sure this hike continues to go at a good pace without derailing jobs growth and the economic growth. But at the same time, they have this ugly rearing ahead of I wouldn't call it the enemy, but if it's too high, it's definitely an enemy called inflation. So post that hike, the markets kind of agreed, and the markets actually agreed a lot earlier. The markets agreed in January, where the bond yields already started lifting off. So that's a very, very key point to acknowledge, and I think, like I said, once bonds have hiked rates, we have income now. It's actually a good point to think about the sell-off. Has it all been priced in? I think that's the key question going forward. So long story short, inflation to watch. Just a few days ago, CPI, the US one, still came in well above expectations. So I think that's the big question of the next few weeks or months that we need to look.
Yeah, I think I totally agree with your comments. I think another challenge we're facing here is that we are in an environment mixed with both the epidemic and the war. And in peace times, the inflation pressure always came in. For example, that the unemployment rate is below the natural rate, and or the GDP growth is above the so-called the potential rate. But this time is quite different. Actually, the inflation started to accelerate last year when the US jobless rate was still around 6%. And even a weaker than expected first quarter GDP for the US this year didn't prevent the Fed from aggressive tightening. So some of the investors attribute this to war. Of course, the last time we have seen this scale of war is perhaps the Korean War in 1950s or even World War II. At those times, the employment or spending pattern were changed so rapidly so that the supply chain could not keep up, which did lead to some inflation. But this time, if we check the disruption level, it definitely was not as severe as was 70 years ago. So even the war itself could not explain the faster inflation today.
Okay, so with maybe 9 rate hikes this year, but a lot of the factors that we've mentioned today, war, oil prices, they are largely out of control of the US Fed, right? So how successful will these rate hikes be in managing this inflation?
if I knew there'd be a crystal ball, the Fed really has a really tough job. It's rightly normalizing its policy. When I say normalizing, years of 0% bonds not paying you anything is not normal. But they will need to slam the brakes. They will need to stop raising rates if inflation gets out of hand. So it's very tough to see the perfect outcome, actually, which is why, even though it's rising rates is not good for bonds, we're in a time where it's not necessarily good for equities either, because the perfect outcome is low inflation and then growth like humming along nicely. But where we are now, because of the supply chain, that's frankly never happened before, to Bruce's point, in this magnitude, means we have to endure inflation or higher than normal, than historical rates of inflation. So the Fed, we believe, success looks like keeping the rates at maybe, is it 2, is it 2.5, is it 3? That's the golden question. The neutral rate that won't derail the economy nor make inflation go worse. So that's kind of how we look at it.
Like a tightrope, yeah, basically. Yeah.
Yeah, I agree. I think there's no easy way to fight against the inflation. And first of all, the inflation is driven by both the supply and demand. And I believe the current Fed tightening could somewhat help curb the inflation, or at least curb the speculation on commodity prices. But it was noting that the Fed tightening could only impact inflation from the demand side at the very beginning, with risk lowering the growth, as I mentioned, right? But from the supply side, it takes time to transmit this to the production side. And the immediate supply side pressure is a bit out of the Fed control. And obviously the Russian-Ukraine war, that boosts both energy prices as well as the food prices. And another factor which cannot be downplayed is China's productivity, as the nation is still partially locked down, which doesn't only impact its domestic demand, but also impact its supply chain, which adds more inflation pressure globally. So in the near term, we may still facing some inflation pressure despite the Fed tightening.
Okay, so I would say that rate hikes are basically inevitable in the rest of 22 at this point. So we move on to fixed income, which is naturally affected by rising rates. So bonds and rates have an inverse relationship. So when rates go up, bond prices go down. So what are the implications for investors in this case? So how should investors navigate this kind of environment?
I like that Bruce took China into the conversation. Even China bonds is now quite investable for investors, which wasn't the case a few years ago. And it's now no longer a market we can ignore, nor sitting here in Asia or the global investors that we've been talking to. But generally, US bonds, China bonds, any bonds doesn't like inflation. So inflation is not good for bonds. However, especially for holistic multi-asset allocators, we all hold a bit of bonds, a bit of equities, a bit of cash, a bit of property. We remain generally, I guess, underweight bonds for that very good reason. Important note though, rates have risen, right? Rate rising means bond prices dropping, but the big question is, has that already all been priced in? Because of the dramatic moves this year, it's already risen. So is it time to enter? So I would actually stress that, even though you maybe dial down bonds a bit or stay on the sidelines on your fixed income allocation, importantly, we want to remain invested, right? I think that's the key if I leave with you here. And then this year's dramatic rate hikes has restored a lot of value, right? You get 2-3% depending on which bonds you're choosing now, and that's your cushion, that's your protection, that's your ballast in your portfolios. And one very good reason Bruce mentioned as well, right? Bonds don't like inflation, but right now equities don't seem to like it either. The downside risk has increased because commodities price will hit growth for US and Europe. And I'm going to repeat what you said. And at the same time, COVID is still hitting China. So global growth is not looking rosy at the moment. So if anything, it's time to look at adding back to bonds, at least from my point of view. The investors who have done well for the past 6 months would have dialed down bonds and then now are looking to add that dry powder back to some protection in your portfolio. But in terms of what we're seeing, so I look at all the iShares, we have 100 over bond ETFs. You can kind of look at the flows of what are people doing. We see people adding back to short duration. So short duration meaning kind of 1 year, 2 year type of bond safe, which has gone from no yield to now more than 2% yield. So just, it's like, a bit more than fixed deposit. It's just a matter of whether it's all priced in. We see investors still shy, still not taking the longer end, right? So if it's 10-year bond, it should pay you a bit more, but simply not enough. Investors are demanding so much more compensation. If I'm going to lend you money for 10 years, or if I'm going to buy a 10-year bonds, either in US or China, I need to be compensated for inflation on the US side or the growth outlook on the China side. So no one's doing that yet, at least from what we can see on the flows, which makes a lot of sense. So the ETF flows are good to watch. They are becoming a good barometer for what bond investors are doing. And looking across asset classes, where I think it makes sense now, is where the cushion is the highest. So I mentioned short duration already. The curve is super flat now in the US, where the 2-year is also above 2%, the 10-year is 3%. That term premium is incredibly flat. So just to give you a sense of what you can get in terms of income now in your portfolio.
Yeah, I definitely echo your view. The investors should stay invested in the bond market instead of liquidating all of your fixed income assets, because the bond still provides stable income, relatively low volatility, and the potential diversification benefits. But on the back of rising interest rate environment, I would highlight 3 major risks so that investors could fine-tune their fixed income allocation then. This is namely the credit default risk, and also the FX risk, as well as the duration risk, as you mentioned. And first risk is the credit default risk. Of course, each bond issuer's default risk potential is linked more to its own growth outlook, as well as its own credit robustness. But it's quite natural to imagine the higher interest rate could lead potential higher borrowing cost, which could also, of course, lead to some potential higher default risk. So the risk-averse investors could definitely increase its credit quality of their portfolios, or be more selective in terms of liquidity and potential default risk when picking bonds in the high yield space. And the second risk is the foreign exchange risk. It's also quite straightforward, as the dollar strength may erode your total return if you invest in non-dollar assets. So in this scenario, investors may increase their allocations to dollar-denominated fixed income assets, or hedge their FX exposure if their underlying bonds is non-US dollar. And lastly, it's about duration risk. You already mentioned a bit. Is that it is also true for the US Treasury, which already denominated in US dollar, with no more FX risk, because the long duration multiplied by the higher yield can still negatively impact the bond price significantly. So the investor could definitely shorten their duration, or even adopt a buy and hold approach. And alternatively, investor could explore some fixed income market with decent yield, or still have some room to keep a relatively supportive monetary policy.
Okay, so fixed income is important, as it traditionally has been, as a defensive aspect and diversification and all that. So now for the tough questions, I guess. So maybe we will start with Hussein. So what is your highest conviction fixed income idea for the rest of 2022?
That's actually not tough at all. That's my favorite question so far. I guess the tough question is, what the Fed needs to do to not derail stuff. To Bruce's point, all those risks of yields hiking can just reverse if the central banks slam their brakes. That means yields will come back down. But personally, candidly, I hope we don't see that, because the past 2 years was not fun. There was simply no yields, which is not how bonds are supposed to work. Staying invested is key. So when I look at, out of all the 100 or so ETFs we could design our bond allocations today. 2 years ago, it was a no-brainer. I would just sit here and tell you it's China, because renminbi was strong. China was still paying, again, 2.5-3% income. Right now, that's jittery. The renminbi has corrected a little bit. But at the same time, the US market is now paying income, and the USD is strong. That was the opposite view 2 years ago. So just very simplistically painting the picture on both sides. Right now, for fixed income investors as a bond, wearing my bond hat, I'm in a nicer position because I have choice now. But my implementation for 2022 at least is not either or anymore. It's probably a combination, right? Diversification, if that's the golden rule for your portfolio. I think that's becoming increasingly clear for me. Very much like the supply chains, right? We see people needing to localize their supply chain, protect it a little bit more. So people are developing a home bias, needing to make it more resilient. Same thing as portfolios. I think we're seeing our investors being a lot more deliberate with the global bond and the home biases they have in their portfolios. So, example, if it's a China, I think we're both fans of that, if it's the China renminbi bond ETF plus a US dollar bond ETF, you get your risk that diversifies each other. They are uncorrelated because the economy is being driven, as we mentioned just now, as very different factors. But both sides still pay you, hopefully, 2 to 3% income today, which was 0 on one side, something on the other side. When you combine these, when you look at them from an aggregate level, that's what we like. That's what we like bonds to do for us. You get a low volatility outcome, but still a chance of positive, potential, real yield type of returns for the next foreseeable future. Because I'm not going to pick either side. Both sides are super uncertain and both sides are not giving me enough conviction to go 100% each for my bond portfolio, bond allocation at least. But still can protect me from any equity scares.
Exactly, yeah. I really love Hui Xian's ideas to combine both the dollar assets and the renminbi assets. And obviously, the dollar assets is favored for now. Just as I mentioned, the short tenor, the treasury bond or the IG credit, invest either buy them through an ETF vehicle or even holding them to maturity to lock the yield. And also, high yield is not a forbidden area as long as investor can consider both the liquidity risk as well as the default risk. And in terms of the onshore China government bonds, I have to say the renminbi was not immune to the current Fed tightening, as we saw here over the past months. The renminbi also dropped a lot, but it's not only because of the narrow negative carry, but also because of the country's current lockdown situation. But just as you mentioned, things can change. But if in the second half China managed to overcome this difficulty, and the nation will benefit from more effective monetary policy, and the renminbi may get back its fundamental support aimed at global recovery, then we will be still constructive on the onshore China government bonds. And lastly, also recommend REITs. This is something between fixed income and equities, in particular for those large cap liquid Singapore REITs, because they are benefiting from the ongoing reopening of the Singapore economy. They also have dominant assets, right, in Singapore to raise rents to outperform the inflation. And on the other hand, they'll also have some diversified debt profile across the fixed and floating debts across different maturity years. So they are more defensive to the current rising interest rate environment.
My rent is definitely increasing.
Okay, so other than long duration, which is the obvious answer, what should investors avoid then?
Sure. Avoid. Okay,
avoid, yes.
That's a good adaptation. I wouldn't say to avoid, but I would say over the past few months, the frequently asked question is, hey, Hui Xian, well, how come I bought inflation-linked bonds but I haven't made money whilst inflation's gone up? So I would say it's a great asset class. We like inflation-linked bonds. especially over longer duration rates exposures, but it takes a bit more homework to know when to get in and how TIPS work, Treasury Inflation Protected Securities. Because these things are still susceptible to rates rise, as susceptible to rates rise as nominal bonds, and then on top of that, they will compensate you for inflation beating expectations. So just because inflation is trending upwards does not mean your TIPS ETF will definitely be positive. It simply gives you more of a cushion versus the rate hikes all of us are susceptible to. So I wouldn't say that's a place to avoid. I would say that's a smarter play, but a harder play to make sure you generate positive income for your portfolio, if that makes sense.
Yeah, I can't agree more. I also want to mention the TIPS because the inflation-linked bonds can definitely provide some inflation protection, but it is also subject to the interest rate risk, which means the current Fed tightening can also negatively impact the TIPS price, even the inflation is rising up. And even I'm a fixed income portfolio manager, I won't say we should avoid all the riskier assets, but I just want to expand a little bit more from your answers, is that on the back of the high inflation environment, there are some talkings about the anti-inflation assets like TIPS or even gold. Of course, the gold has anti-inflation features as well, but the gold is denominated in US dollar, which means the dollar strength can also erode the gold prices. And secondly, the gold, unlike bonds, they cannot yield coupon or mini gold. And also the gold cannot generate power like oil, right? So they may not be able to start my car today. So, but even if we talk about the broad-based commodities, it does not only include oil. For example, the iron ore prices, they started to struggle after the China's regulatory crackdown on its property sector. And even we talk about the oil itself, the higher oil price, it's a driver of inflation instead of a result of the inflation. And the current high price of the oil also subject to the rapidly changing dynamics of the supply and demand. So investors should be more cautious.
I mean, you can see the slight different traits here. It's more credit default risk and commodities, and more steady fixed income. I just want something fixed and a lot of income.
Well, I think that seems to me like a good place to wrap up with, like, you guys sharing your ideas of what to invest in. So a bit of REITs, a bit of a diversified US-China portfolio, as well as what to avoid, which seems to be TIPS and gold and certain resources that might be vulnerable to the strength of the USD. Yep. So as always, I think you have also stressed this multiple times that diversification remains very important for investors. And also remember to keep duration low to avoid being hit by rate hikes in your long duration portfolios. Yep. So once again, thank you. And please do, for our guests today, please do put in your questions into the Q&A segment, and we'll try our best to answer them. Yep. Thank you.
Thank you.
Thank you, Jingyan and the panelists. For those of you who still have questions for CSOP Asset Management, head over to Stage B. They will be on hand shortly to handle your queries. We will now move to our next segment of the day called the China Debate. If you've ever wondered what a typical discussion is like amongst the analysts from our IFAST regional research team when exploring and analyzing investment ideas, this segment will give you a picture. Today, they will each pitch and defend their investment cases for various sectors in China: technology, healthcare, financials, and real estate. In the arena today, from our research and portfolio management team at IFAST Singapore, we have Ian, Heather, Huishi, Ferlin, and Weiren. Let's give it up for the presenters of our China Debate session. In the team with us, we have Ian Lee, Assistant Manager of Research at IFAST China, representing the healthcare sector; Heather Lim, representing the technology sector; Hui Shi, representing the property sector, and for Lin Tan, representing the financial sector. Moderating this debate will be Yo Wei Ren, Senior Portfolio Manager of Research and Portfolio Management at IFA Singapore. Over to you, Wei Ren.
Mic test. Good afternoon, everyone. My name is Wei Ren, and I will be the moderator for this session. And as Gladys has already mentioned, this session is actually called the China Debate. And as the name suggests, this segment specifically zooms into the Chinese equity market. And very specifically, what we will be doing is we are going to explore the various sectors in China at this point. And I have with me today 4 analysts, and each one of them will be representing a different sector in China. And just to recap their names one more time, over to my furthest on my right, furthest to my right is Ms. Heather Lim, who will be representing China Tech, followed by Hui Shi, who will be representing the real estate sector, and also Ms. Ferlin Tan, who will be representing the financial sector. And I also have with me on the line Mr. Ian Lee. He is based all the way in Shanghai, and he will be representing the China healthcare sector. And as we all know, Shanghai right now is under lockdowns because of the COVID-19 outbreaks. So Ian, thank you so much for joining us today for this session despite all the lockdowns. So just to kickstart today's discussion, I thought it would be interesting to get Ian to share with all of us his personal experience so far in Shanghai right now. So Ian, first question to you is, how has your personal experience been in the lockdowns in Shanghai? And could you just share with members of the audience, what have you been observing during the lockdowns, and what is your personal assessment of the situation on the ground?
Hello, Aaron. Hello, everyone. Thanks for inviting me. Shanghai started lockdown around the middle of March. I thought it would last no more than a month at first, but the restrictions is taking Shanghai's lockdown into its 9th week. At the very beginning of lockdown, some residents, especially elders, foreigners, who are not familiar with community group buying, have been struggling to access food supplies and forced to wait for government drop-offs of vegetables, meat, and eggs. Also, people are not allowed to go outdoors unless taking nucleic acid test. But the test will make people feel strained because of potential infection risk. Over the past few weeks, personally, I'm getting used to working remotely, and I've been doing a couple of things to help deal with the ongoing pandemic and the restrictions. Clearly, Shanghai lockdown is costly for economy because it's a hub for semiconductor, electronics, and car manufacturing. I believe authorities will ease restrictions to restart the city's economy soon, as we still have to meet 5.5% economic growth target this year. I don't think other major cities like Beijing will repeat the mistakes after a much criticized month-long lockdown in Shanghai.
Well, Ian, over in Singapore, we have actually heard a lot of things about the lockdowns in Shanghai, from the food shortages that you have just mentioned, and we have also heard about some of the extreme measures that the government has been taking to ensure zero transmission of COVID-19 cases. So could you also give us a bit of color and also a bit of background as to what are some of these measures that a person could be experiencing at this point during lockdowns? So what happens if you or any of your neighbors in the building test positive for COVID-19? What actually happens?
It would be a terrible case. In fact, during this time, we should self-test every other day and report any positive results. And the nucleic acid test has been conducted citywide almost 10 times so far. The infected patients and close contacts will be transferred to government-run centralized quarantine to up to 2 weeks, no matter the circumstances. Even newborn juveniles who tested positive will be separated from their parents and transferred to quarantine by themselves. Also, it's not uncommon for hundreds of people to be put together in such centers. Images shared on social media have showed unsanitary conditions where patients are unable to sleep properly and receive proper treatment, but they are not allowed to leave until tested negative.
Looks like the situation there, it's still pretty uncertain. And also one of the reasons why we have arranged for Ian to begin his sharing first is also because he can be called on short notice by the Chinese government to do an emergency PCR test. So such is the uncertainty and fluidity of the situation over in Shanghai right now. So Ian, today you represent the healthcare sector, but as we all know, the strict enforcement of COVID-0 measures, this has actually placed a severe strain on healthcare resources in China. But yet, Yin, you see investment opportunities within China's healthcare sector. So right now, I'd just like to invite Yin to present his investment case on why investors should still consider an investment in China's healthcare sector amidst this uncertainty. So over to you, Yin.
Thank you. Good morning, everyone. This is Ian from CN Research, and my topic for today is short-term correction in China's healthcare stocks, an attractive buying opportunity for investors. In year 2021, China's healthcare sector recorded a minus 16.6%, underperforming the CSI 300 index by roughly 11%. And the sector has continued its downturn trend in 2022. The healthcare index has dropped down by circa 24% by the end of April. We believe that there are two main reasons resulting in the correction. Firstly, valuation bubble. The healthcare sector increased by over 100% during 2019 and 2020, which hit two standard deviation above 10-year PE multiple. Secondly, China's centralized drug procurement policy has weighted on sentiment towards healthcare companies, which had to deal with drug price cuts. In recent years, China's centralized drug procurement has been the main policy that has guided the reform in the industry. The key focus of this policy was on price reduction and fee control, and was initiated to improve the affordability and the availability of drugs in China. At this point, after a few months correction, we believe there's a buying opportunity. We are confident that leading healthcare companies in China will be able to adapt quickly to the new normal of centralized drug procurement. The growth drivers underpinning China's healthcare sector include China's aging population, potential increase in medical expenses, cost advantage enhances international competitiveness, and internet plus health industry, a new landscape for the sector. To clarify, China's population is rapidly aging. Its fast-growing society means that there's an ever-growing need for healthcare services. Next slide, please. Especially when considering a recent spike in demand resulting from COVID-19. According to the population census in 2020, the population of people aged 65 and above account for around 13.5% of the total population. Meanwhile, the growth rate of newborns in China has been negative for 3 consecutive years. While China has recently introduced a new three-child policy aiming to alleviate the problem of aging population, we believe that this policy is unlikely to be a quick fix for its demographic challenges. as the high cost of raising a child in China. Next slide, please. Second of all, as can be seen from the left-hand chart, the overall healthcare expenditure has maintained a steady growth over the past years in China. Additionally, as the largest player in pharmaceutical industry, the national medical insurance shoulders a considerable portion of medical and health expenses. According to the data provided by a National Medical Insurance Bureau, the total medical healthcare expenditure in China has increased from 2 trillion yuan in 2010 to 7.2 trillion yuan in 2020, representing a compounded annual growth rate of about 13%. Despite the strong growth, we believe that the expenditures has further room to climb as the industry is relatively nascent compared with developed countries. At present, China's healthcare expenditure totaled 7.2% of total GDP. This is still lower than the world's average of about 10%, and much lower than that in the developed countries in European and US. Besides, the competitiveness and the market share of companies in China's healthcare sector are constantly improving compared to their international counterparts. Next slide, please. Over the years, local pharmaceutical companies have been trying to catch up with multinational pharmaceutical companies in innovative drugs and research and development, and they have made great progress. The number of domestic new drug applications and the registrations has also reached a record high. According to the National Medical Products Administration, a total of around 2,000 new drug applications were accepted in 2021, which is higher than that in 2020. Besides, China's contract research organization and the contract manufacturing organizations have leveraged on their cost advantage and China's talent pool to continue obtaining international orders and expanding their production capacity. Next slide, please. Last but not least, Internet plus health industry develops rapidly in recent years, and investors shouldn't miss out investing in this area. As we all know, since the pandemic, policies have been introduced to promote online sales of prescription drugs and realized medical insurance payouts to internet hospitals. This is a major move to open up the internet hospital ecosystem and form a complete closed online loop from consultation and prescription to settlement and medicine delivery. As you can see from the table, I summarized the major internet plus conglomerates, and it's clear that major players all extended their footprints to build a comprehensive service portfolio. Next slide, please. Although the new policy, i.e. Measures for supervision and administration of online drug sale in 2021 is stricter comparing with the prior version, which are likely to expand the restriction list of prescription drugs for online sale. We believe the prudent policy is essential to build a healthy and sustainable foundation in the long run. In the next 10 years, we foresee the healthcare industry will undergo an unprecedented transformation with the application of high techs such as big data analysis, AI, 5G, etc., which helps form an efficient and safe information sharing mechanism. We still believe that healthcare products like e-commerce GMV should grow around 18% CAGR over 2020 to 2023 to reach like 1.1 trillion yuan, driven by pharmaceutical products and a broad online penetration expansion during the period. Next slide, please. The valuation at the moment looks appealing, as shown from the left-hand chart. If you look at the subsectors of the healthcare, most current PE of which are at lower quartile. Also for the CSI 300 pharmaceutical index, on the right-hand side, the PE multiple falls below 10 years valuation average after nearly 2 years downwards adjustment. Next slide, please. So based on above, we are bullish on China's healthcare sectors this year. Investors can gain exposure to the opportunities within China's healthcare sector via green shares MSCI All China, which is a US-listed ETF designed to track the MSCI China All Shares Healthcare Index. We revised our 2023 target price for the ETF to $30 US, and this is based on a fair PE multiple of 30 times. And this translates to a potential upside of close to 24% based on the last closing price on April 2022. And this is the end of my presentation. Thanks for listening.
Well, thank you so much, Ian, for giving us a summary of your investment case for China's healthcare sector. But many of the points that you have highlighted inside your presentation are actually long-term drivers for the industry. And in the short term, there are obvious challenges. And as indicated by one of the charts you have just shared, there has been a sharp correction in share prices of Chinese healthcare companies. And, over the past year, we have been talking about, regulations and crackdowns. Tech, real estate, these have been the primary sectors that have been cracked down by China. But healthcare has also had its fair share of reforms over the past few years, because the Chinese government actually wants to keep healthcare affordable to the general public. So what this has resulted in is actually a sharp price cut in drug prices. And we're not talking about just 20-30% decrease in prices. We're talking about 70 to 80% decrease in drug prices. And this is going to affect the profitability of Chinese healthcare companies. So my question to you, Ian, is, are you not worried by some of these healthcare reforms that are taking place in China right now?
The impact of this reform on different enterprises is different. To clarify, if the market share of the bid-winning products is now too high before entering the catalog, 60 to 70% of the sales volume of the bid-winning market can be changed. Changing price for quantity can quickly increase the sales volume of products and occupy most of the market share. However, if the market share is high before and the price reduction is large during the negotiation process, the amount exchanged at the price may not be enough to make up for the loss of the price, which will lead to the decline of enterprise profits. But even so, if we consider the aggravation of aging, the number of patients with chronic diseases is increasing, and the high drug price leads to the increasing medical burden of patients and the country. Medical insurance cost control is a very important means to reduce the overall burden by controlling drug prices. I believe the market has priced in the impacts, namely the era of high gross profit of generic drugs is over, and a reasonable profit margin of the manufacturing industry will be earned. In the future, we believe the reform will adjust the drug structure of medical insurance, by which I mean Medicare will make more space for covering patent innovative drugs. So it will benefit the industry in a long run.
Okay, so to summarize what you have just said, you are expecting the increased volume to make up for the deep price cuts that some of the healthcare companies are taking right now. Quite an expensive price to pay for being accepted by the Chinese government into their official drug list. But yet at the same time, even though China's long-term prospects in terms of the healthcare sector, it is attractive, but this is also a highly fragmented market. You're talking about 5,000 healthcare companies that are operating within this space, and top players in this healthcare sector, they actually hold a very small slice of the healthcare market. And this has created room for global healthcare companies like AstraZeneca and Novartis to go in to grab significant market shares from the domestic players. So Yen, my next question to you is, do you think China's domestic healthcare companies have what it takes to compete with these multinational healthcare companies?
Yes, I believe Chinese innovation will continue to break over the global pharmaceutical industry for decades to come. If you consider what's happened with COVID-19, within 8 months, China generated 6 original vaccines and 6 antibody candidates that entered clinical trials. Thanks to a decade of sustained government support, including policy reform, talent development, funding, etc., China's farm market is booming. We notice more and more private capital is available to the industry through venture capital and private PE, etc., which underwrite most R&D in China. Also, over the past years, China has enacted several policies explicitly to improve market access and support innovation. The Chinese government has also supported the development of science parks and city hubs for innovation and R&D by offering land to developers on a very attractive term. So I believe over the next 5 to 10 years, these homegrown companies will continue to improve their innovation capabilities and eventually compete directly with MNCs outside of China.
Thank you so much, Yen. And to also give credit to some of the Chinese companies over the past 10, 20 years, they have indeed been catching up to their global peers in several areas. Technology is one of them, and Yen, as you have just heard from him, he's also expecting Chinese healthcare companies to eventually catch up with the global peers. Okay, so thank you so much, Yen. Ladies and gentlemen, you have just heard from Yen, his investment case on why China's healthcare sector is one of the most interesting places to be in right now. So we will now shift our attention to a sector that is perhaps no stranger to all of us here, and that's actually the technology sector, which has been the poster child of the crackdown over the past year. If you have invested in any of the Chinese tech stocks, including Alibaba, Tencent, over the past 1 year, your losses would have been very steep. And if you just look at the Hang Seng Tech Index, from its peak last year, it is currently down by 60%. And such has been the extent of the crackdown on the tech sector in China. And we also have prominent investors declaring China tech stocks to be uninvestable. And that's a big call. That's a very big call. So the question that we seek to address today is China tech stocks a value trap at this point, or is this a deep value opportunity that we should all take advantage of at this point? And to answer this question, I will invite Heather, who is our analyst for the digital economy, to present her investment case for China tech stocks. Heather, please.
Right. Thanks, everyone. Great to see everyone today. So yes, as many of you guys are aware, China tech has plummeted from highs as the regulations, delisting risks, macro concerns that has spilled over from the global economy and also the COVID lockdowns this year has all weighed on China tech this year. So here we plot some of the various key events that has happened across the past year, and just to highlight some of it, in March last year, 2021, we see that some of the several tech giants have been fined for price dumping by the Chinese regulators. And then in August last year, 2021, the regulators also imposed a time limit on gaming because they did not want the youth to be gaming too much. And then moving on to one of the major concerns, which some of you might have already read about, which is the delisting concerns. And these have heightened this year. And as you see on the chart, on 15 March, Hang Seng Tech actually plummeted to lows. And this was when the US SEC, Securities Exchange Commission, announced that 5 US listed Chinese companies are to be delisted by 2024. And since then, this list of 5 has gone up to roughly 80. So yeah, why did the Chinese companies actually face delisting? And the whole issue really surrounded on the fact that Chinese authorities did not allow the US listed Chinese companies to allow the US PCAOB, Public Company Accounting Oversight Board, to actually audit the Chinese companies' books. And also, this was the whole issue because the Chinese government did not want the data of Chinese consumers to be released to the US as they deemed it as confidential. But this was against US law because according to the US Holding Foreign Companies Accountability Act, all US listed companies, not only Chinese companies, had to let the US Accounting Board audit their books and also disclose government ownership. So markets were really concerned and really negative on this whole situation. But on 1st April, there's kind of a turn of events where the Chinese authorities actually announced draft rules in proposing a rule change. And what this rule change is basically allowing the US listed Chinese companies to let the US audit their books and also disclose government ownership. And so our view on this is that the risk of delisting significantly declines, and it really shows that China is willing to amend rules to prevent the US listed companies from being delisted. And also, this is really the first relatively concrete step by the Chinese regulators in allowing the Chinese companies to remain listed. And so this gives us confidence that the Chinese regulators intend to walk their talk of what they have been previously saying and announcing across the past year, where they have said they want to continue to support overseas listing, they want to stabilize financial markets. And also it shows us that the Chinese government is still heading towards the opening up of financial markets rather than heading backwards and closing up. And so, nevertheless, the risk is still not entirely off because although there have been progress made between the US and China, where the US PCAOB actually went to China just last week for further discussion and to reach an agreement, but it's not fully off until a full agreement is reached. And also, we see that a likely outcome of this whole situation would be that sensitive companies, which will be the minority of companies to be delisted, while the majority of companies that are considered non-sensitive to the Chinese government to remain listed in the US. So just one example is that last year, Didi was asked by the Chinese government to delist, and it was because they had confidential data of the consumer travel and all these. So, yeah. So all in all, that was on the regulatory front. And going forward, we also see that in the past year, the fundamentals of China tech has remained resilient. As you see on the chart on the left, revenue has continued to trend upward, and this demonstrates that demand is still strong and that services are still popular and growing and consumers are still continuing to use these platforms across the past year. And then when you look at the chart on the right, earnings has largely held up. It's still stronger than pre-COVID, which shows that digitalization has remained sticky. And although it is flat or a bit slight decline in growth from 2021, we think that it's rather resilient because we have to remember that last year, some of the companies had to pay fines and also some of them had to amend the regulations and work out how they would implement the regulations such as the minimum wage. And also we have to note that some companies still continue to deliver earnings growth such as Tencent and NetEase. So then moving forward, we still see that the long-term growth story of China's tech remains intact, and it will be mainly driven by digitalization. So here on the slide, we just have some of the few key drivers of the key internet segments, digital economy segments in China tech, and just to highlight some. So like looking at e-commerce, many of us know that e-commerce has grown significantly over the past few years, but there is still further room for growth and penetration. So just citing an example is that looking at the e-commerce grocery segment, penetration is quite low at 5%, while in the consumer electronics segment is higher, much higher at 40%. And so it just shows that e-commerce grocery is one of the segments that still has much room to grow. And this is an area where many of the e-commerce giants in China is trying to expand their footprint. Next, we also look at the cloud market, where in 2021, we saw strong attractive growth of 45% year-on-year growth. And going forward, the growth is expected to remain stable and strong at 25% CAGR. And also in the video game sector, over the past 5 years, revenue actually doubled. And now going forward, there's also still growth at 20% CAGR for the next 3 years. And also good news is that most recently, the video games license approval has restarted in April after having 8 months pause as the regulations tighten. Another thing that we see also is a growth driver for the brands would be the international expansion, where the Chinese companies are expanding their global footprint. So just an example would be, for example, Lazada, who is owned by Alibaba. They saw a strong 52% year-on-year order volume growth in the last year, fourth quarter 2021. And so these are just some of the things that we see from the different segments of the internet sector. And now zooming out a little, we also see that the government's commitment to digitalization and growing its tech sector, and also the supportive macroeconomic backdrop as supportive growth drivers for the industry. So the government is committed to digitalization and innovation. And one example is that the government aims for the digital economy to account for 10% of total newly added economic output by 2025. And it shows how they're still seeing that the digital economy, platform economy is still important. And also, if some of you have read about it, the Digital Yuan project by China, it also shows that the government still wants to continue to facilitate digitalization and a shift towards technology. And so, as we see more digitalization, China tech stands to benefit. And then finally, on the macroeconomic front, China does stand attractive as currently inflation is not a major issue, and it gives the government more leeway to keep monetary policy accommodative. And we have seen recently this year some reserve ratio requirement cuts and also interest rate cuts. So in summary, with the long-term growth drivers of China tech and also of the industry, we think that China tech should see recovery as the regulatory overhang eases.
Thank you so much, Heather. Now time for some difficult questions for you. Just now, as I was talking about the steep decline in the shares of Alibaba and Tencent, I saw some investors here sitting with us nodding their heads. So I think some of us here have been caught up in the sharp sell-off in China tech stocks over the past year. And I think many of us here, each time there was a sell-off in China tech stocks, we think that we could go into the market to bottom fish, to pick up some cheaply priced Alibaba or Tencent stocks, only to be burnt time and again by the unexpected changes in the regulatory environment in China. So my first question to you, Heather, is it really different this time around?
Yes, indeed. So, great question. So yeah, first we all need to note that definitely the regulatory crackdown over the past year has been a major cause of the sell-off. But there have also been other factors, as I mentioned earlier, that like, for example, the COVID lockdowns, the delisting concerns, which is more of a US-China tension, and also the macroeconomic situation, and all these have also weighed on the sector. So what we have observed is that in 2021, a lot of the regulations have been concentrated then, and the Chinese government really just full force all of it in 2021. And since then, it has eased with less frequent, or at least not so much in this year. While in 2022, what really sent the stock market down are various things like the delisting concerns, macro concerns, and also the COVID lockdowns. So overall, we do see that it has rather relatively eased. And also, moreover, in the last two weeks ago, the CPC Central Committee, which is headed by President Xi in China, actually announced that it is necessary for the healthy development of the platform economy, and also they called for the complete rectification of the platform economy. And so all in all, it does seem like the worst is over for China Tech. But what we really need as investors going forward to see are some positive catalysts which would really drive the recovery of China Tech. So positive catalysts could come in the form of earnings growth, earnings surprises, and also we need to stop seeing negative news that can come in any forms. So yeah, more positive catalysts and less negative news. Yeah.
I think Heather brought up a very good point. I think if you look at the news headlines for this year, one of the common themes, one of the things that has been dominating news headlines this year is China coming out to say that they intend to do what they can to stabilize the economy. And that is the one thing that they have been doing. And also, I think what Heather has just mentioned, the ensuring the healthy development of internet consumer companies. That's also recently been highlighted in one of their government statements. So this year, it could really be different for China tech companies. Okay, we have talked about healthcare. We've also talked about the tech sector, but there is one distinct group of companies that is not just internet, but also healthcare. I'm referring to companies that are in the internet healthcare sector. So right now, I'll just shift the attention back to Ian. Ian, my question to you is on the topic of regulation. Chinese internet healthcare companies, they have been subjected to regulations over the past year. And that includes a ban on online consultations. And this is actually core to the business model of some of these companies that are operating in the internet healthcare sector. Companies like JD Health, companies like Alibaba Health. So my question to you, Ian, is how does this regulation affect these internet healthcare players?
I think these new rules represented the continued cautious stance of regulators on internet healthcare industry, as there are still many issues that haven't yet been adjusted under the existing practices and the legal framework. For example, public hospitals are constrained by budget caps of the healthcare security fund and are therefore reluctant to share budget with online channels. Indeed, the regulations has deepened concerns about restrictions on growth potential for the sector, but expected to push China's internet healthcare industry into the era of standardized development. To clarify, the policy has released a clear signal that online medical consultation should be the same of quality as that provided by physical institutions, which is essential for the standardized development and market expansion of the internet healthcare industry. We know China has 1.4 billion people. They have a huge demand for healthcare services, and physical hospitals are definitely able to meet this demand. With the regulatory policies for the internet healthcare becoming more transparent and standardized, companies providing actual medical services with a sound regulatory compliance system like Alibaba Health and JD Health are expected to benefit in a long term.
So in short, short-term pain from the regulations for long-term potential gains. And judging by the share prices of some of these consumer healthcare internet companies, a lot of pain has been reflected in their share prices. And also, back to Heather, on the topic of business models. So we all know right now that Alibaba and Tencent, they have actually been asked to open up their walled gardens, their ecosystems to their competitors. And this walled garden, this ecosystem has traditionally been a source of competitive advantage for some of these big tech Chinese companies. So my next question to you is, do you think that the government's regulations, the government's intervention into these Chinese big tech companies has permanently affected the long-term business models of these big tech companies?
Right. So the short answer is no. The business models are still intact and still sustainable and not damaged totally. So first, we all as investors need to note that even with the regulations, these Chinese companies, that they still play a key and important role in the Chinese economy, where their services and goods are still very necessary for the daily consumer. So with that, just an example, it will be Meituan. Even though they had to pay some benefits to the delivery riders and also to the merchants, overall, you can see that their algorithm and cost optimization in their business model has given them a competitive edge. And so if with that, their services are still there and you still have demand. And so overall, the business models are still intact. And second, we also need to note that the government's intention is not to hinder the growth of these Chinese tech giants, but rather they want to create a fairer competitive landscape. And this in turn will drive more innovation in the industry as there is a fairer competition. And so overall, we see that these tech giants have also gone along this line of innovation and this trend, and they have found new ways to grow earnings. So for example, Baidu has recently launched their autonomous driverless taxi fleet, which is the first autonomous taxi fleet in China. And so this is something very innovative. And also in Alibaba, their cloud computing business has also shown a strong growth, and they have been expanding into new verticals, and also Tencent's fintech business. So overall, we just see that these companies have continued to innovate, and this is also aligned with what the government wants. So all in all, with the businesses still being very necessary to daily consumer, and also seeing that they continue to find ways to innovate and grow earnings, we do think that the business models are still intact and still will grow.
Thank you so much, Heather. So, ladies and gentlemen, Heather has just presented her investment case on China's tech sector. So if you have been holding on to shares of Alibaba, Tencent, or even the Hang Seng Tech ETF, perhaps now is not the best time to sell it, because you're probably selling at the bottom right now. And for those of you who still believe in the future of China tech stocks, Heather thinks that now is perhaps the best time to go into the sector. Okay, right now, we will shift our attention to another sector that has also been experiencing a lot of distress because of the crackdowns by the Chinese government. And that sector is the real estate sector. And this sector has been undergoing a lot of distress because of the government's crackdown on excessive leverage. And we have already seen quite a lot of defaults among Chinese property developers over the past few months. So the question that we want to address today is, have we already seen the worst of the debt crisis in China? Or is there still more pain to come? So to answer this question, I will now be getting Hui Shi, who is helping to cover the real estate sector, to share with us her views on China's real estate sector. So Hui Shi, please.
Thanks, Weiren. Yes, so the property sector, it was also another area where China had launched a crackdown on. And needless to say, Chinese property bonds, they have gone through very rough times after the crackdown. We have Evergrande, which was the first major developer to fall to the tightened regulations, and its downfall had also sent a rippling effect across the rest of the property sector. And we see the carnage continue on this year, with more developers missing their coupon payments, and also the Russia-Ukraine crisis has also added on to the market uncertainty. But despite this, we think that the worst could already be over for China's property sector, and we see that the sector is set for better times ahead, and that also provides investors with an opportunity. And here are some of the reasons why investors should start considering investing in the Chinese property bond market. So with this year being a politically important one for China because of the 20th Party Congress, we think that the property sector will be one of the key areas of focus, especially since its downturn had cast a shadow on China's economy. And with respect to this, we have the Vice Premier Liu He, who is President Xi's closest economic advisor. He has said that the government needs to reduce the risk in the property sector, as well as propose measures to facilitate a new development model. And so what we could possibly imply from this statement is that China's property sector has likely already reached a turning point. At the same time, we have heard from the regulators who have once again, they have reiterated their intentions of stabilizing the property market, and we have the Finance Ministry announcing that a property tax trial that is initially planned for this year will be put on hold. So overall, we think that China's assurance of providing continued support to the property sector, that should paint a better picture for the outlook of the Chinese property bond market. And at the same time, this policy easing environment, that should be a key near-term catalyst for the recovery of the sector. And currently looking at the prices of the Chinese property bonds, we see that most of them, they are still trading at distressed levels despite some recovery from their March lows. And in fact, more than 50% of those bonds, they are currently trading below 50 cents on the dollar. So half their values are being wiped off. And this is a significant difference as compared to the end of last year, where only about 15% of such bonds were trading at such distressed levels. And we also keep in mind that the ongoing policy easing environment, that should help to alleviate some of the credit stress that's being faced by the developers, and that should also help to keep default rates in the sector from reaching extreme levels. So we do expect the default rates in the sector to remain manageable. And more importantly, I think that current bond prices, they already seem to be pricing in a large degree of credit stress. And therefore, we believe that the sector is offering investors with attractive risk-adjusted returns, and current bond prices are presenting investors with an attractive entry point. And besides looking at the bond prices, we can also consider the spread levels of the Chinese property bonds. And currently, their spread levels have widened to over 2,900 basis points, and that is about 29%. And this is still one of the highest levels on record, despite some recovery from their March highs. And relative to the US and Europe high-yield bonds, we also find that the Chinese property bonds, they offer a spread differential of more than 2,000 basis points, which is more than 20%. And I think this highlights the fact that Chinese property bonds are providing an attractive yield pickup over their global peers. And also, the bonds, they provide a combination of not only higher yields, but also shorter durations. The bonds, they currently have a yield to worst of over 30%, and that is several times higher than that of the US and Europe high-yield bonds. This also comes alongside a relatively shorter duration of less than 3 years. And as a result, we find that Chinese property bonds, they have the highest yield per unit of duration. Also known as the Sherman ratio, this yield per unit of duration, it is a measure of interest rate risk. So what this means is that a ratio of 1 would indicate that it will take a 1% rise in interest rates in order to completely offset the yield of a bond. And hence, having a higher yield per unit of duration, this can potentially provide more buffer to offset the impact of rising interest rates. And this also makes Chinese property bonds with their highest yield per unit of duration a more compelling fixed income investment option against the current backdrop of aggressive rate hikes, which are obviously going to have a greater impact on global peers instead. And for investors who want to ride on the recovery of the Chinese property bond sector, we recommend this ETF, which is the Premier China Property Bond ETF, which is listed on the Hong Kong Exchange under the ticker 9001. Currently, only ETFs are able to provide investors with a dedicated exposure to the Chinese property bond market. And specifically, this ETF, it is the only product available that is able to provide such diversified exposure. This ETF, it invests in secured as well as senior unsecured rated offshore USD debt securities that is being issued by the property developers as well as the REITs. And with these securities being largely secured, they can provide investors like us with better recovery prospects in the event of a default. And this actually differs from your typical Asian high-yield bond funds or Asian high-yield bond ETFs, where securities being held, they can either be senior or subordinated. They are typically unsecured, and sometimes they may even be unrated. And other key details of this ETF is that it has an average credit rating of BB, and that is the highest out of the speculative grade. And also it counts the more resilient developers like China Vanke as well as Country Garden among its top 10 issuers. And so overall, to sum up what I've just mentioned over the last couple of slides, I think the risk of defaults in China's property sector has largely already been priced in. And also considering the policy easing environment, we think that the property sector is set for better times ahead, and the worst is likely already behind us. And as such, I think the risk-reward of the sector is now being skewed to the upside, providing investors with an attractive entry point. And of course, investors can stay diversified through instruments such as an ETF in order to gain a diversified exposure to the different property developers, as well as to minimize any idiosyncratic risks.
Okay, thank you so much, Hui Shi. Well, I think we can all agree that the Chinese government has been very forthcoming in terms of its support and policy measures to help support China's real estate sector. But the reality on the ground is that home prices and house demand, they have actually been falling over the month, which means that it is still not taking effect. These policy support measures, they have not taken effect on the property market yet. Housing prices have been falling, demand has also been falling as well. And these two factors, they actually reinforce one another, because if I expect home prices to fall further, then I will of course want to delay my purchase. And when everyone delays their purchase, and that also causes home prices to fall further. So given these factors, given what is actually happening on the ground right now, so my first question to you, Hui Shi, is it still safe to assume that the Chinese government has everything under control?
Thanks very much for the question. I think this is a very good question. So firstly, there are some risk factors that I would like to address and acknowledge. So firstly, the policy easing from the government, it could be too little or even too late. So far, efforts undertaken by the government to stabilize the property sector has been fractional, and so far it has also produced little positive impact. And so if additional policy easing from the government comes too late, or takes too long to be implemented, that could also be possibly too late to restore the confidence in China's property sector. And besides this, I think another risk factor will be COVID-19 lockdowns. Given China's very strict COVID-19 policy, having more COVID-19 cases in even more cities could also result in further lockdowns in China. And that could hurt the developers' contracted sales and also delay the recovery of China's property sector. But despite this, I think we also have to acknowledge that the property sector is an important component of China's economy. The sector contributes about 25% of China's GDP. So I think China is unlikely to let the property sector to fail, as that would have detrimental impacts on the rest of the economy. And also, despite the sector having its own challenges, I think that there's still value to be found within the property sector. I think that there will certainly be some developers who will be able to withstand a prolonged downturn, assuming that the recovery is slower than expected. Because the reality is that not all developers are created equal. Not all developers are like Evergrande or Shimao Group. There will certainly be some developers who have much stronger fundamentals given their better liquidity positions. And such developers will include some of your SOE companies. So I think these kind of companies are likely to survive through this crisis. And so my advice for investors right now will be to stay diversified through instruments such as an ETF in order to minimize any idiosyncratic risks.
Thank you so much, Hui Shi. And right now, I'd just like to shift the attention, the focus of the discussion to the banking sector, which is represented by Feline. She hasn't presented her investment case for Chinese banks just yet, but we cannot talk about the property sector without highlighting the banking sector, because these two are interlinked given the importance of the property market to China's economy, and also the fact that there is a lot of lending by Chinese banks to these property developers. So my question to you, Feline, is from a banking perspective, do you think that the wave of defaults that we are seeing in the Chinese property market right now, is that going to create significant stress on China's banking sector?
Okay, yeah. So just now you mentioned that the banking sector has quite a significant exposure to property-related sectors. So that's true. So on average, Chinese banks have about 30 to 40% exposure to property-related sector. But I think it's very important for us to know the rough breakdown, which is that majority of these loans are actually in the form of mortgage loans. And when I say majority, I meant about 30 to slightly over 30% are in the form of mortgage loans, whereas the remaining 6 to 8% are then to loans to property developers. So when it comes to mortgage loans, there are probably less concerns over it, given how buyers in China, they have to fork out huge amounts of money to pay for their initial deposits, which kind of reduces the risk faced by the banks. And for the property developer-related loans, so I think it's also worth sharing that most of these loans are already collateralized, which helps to cushion any further defaults, if any, in the property sector. And also, according to Bloomberg, on average, 70% of these loans to property developers are secured with collaterals, guarantees, and pledges. So in some way, I think that the direct impact on the bank's assets, the loan book, may not be as bad and may not be as significant as what many people are thinking. So in my opinion, I at this juncture, I don't think that there will be significant stress on the banking sector.
And the fact that the Chinese government has been willing to allow China Evergrande to default on its debt without needing a bailout, I think that itself also shows that the Chinese government, they probably have some confidence in the ability of the banking sector to absorb stress at this point in time. Okay. Back to Hui Shi. I think one of the main concerns that investors have towards these Chinese property developers is the use of hidden debt in their balance sheets, the use of financial engineering to hide the true amount of obligations that they actually have on their balance sheet. And even the credit rating agencies, they have been caught off guard because some property developers, they were initially judged to have enough cash to repay their bonds, only to find out that they actually don't have enough to repay their obligations, and they ended up defaulting on their bonds. So my next question to Hui Shi is that what is your assessment of this situation of hidden debt right now? And are we expecting to see more defaults ahead, more unexpected defaults ahead?
Yeah, this off-balance sheet financing situation, this is very real, and so far it has really damaged the market confidence in Chinese property developers on the whole. And I think the recent auditing crisis, where some developers, they were unable to report their audited results before the deadline, it has once again shed light on the excessive use of off-balance sheet financing by the developers. And so far, I think what we can learn from this situation about this auditing crisis is that developers who have managed to release their audited results before the deadline, and auditors did not report any material uncertainty regarding to going concern, I think these kinds of developers would have much lower credit risk. And examples will include China Vanke, Country Garden, as well as CFI Holdings. But also at the same time, we have developers who did not manage to report their audited results before the deadline, and auditors also had reported material uncertainty. So for these kinds of developers, I think that there's a high possibility of them having excessive off-balance sheet financing. And of course, I think that would affect their default risk, so they have higher risk of defaulting. And prime examples will include not only China Evergrande, but also Shimao Group, and also Sanex China, who recently just missed one of their coupon payments. And so considering this, I would not rule out another wave of defaults in the property sector. But then again, we have to keep in mind that markets, they are forward-looking, and I think that a large degree of default risk has already been priced in by the market. So if you take a look at developers who have so far have issues with reporting their audited results, we can see that their bonds are already trading at distressed levels. In fact, for Sunex China, even before they miss one of their coupon payments, all of its bonds are already trading below 30 cents on the dollar. And with most of the potential downside being priced in the Chinese property bond market, I think that the risk reward of the sector is now skewed to the upside, and I think that provides long-term investors with an attractive entry point right now.
So in a nutshell, a distinct differentiation has to be made between the good ones and the bad ones inside the property market, and also diversification is important for a distressed sector like China's property market. Okay, so thank you so much, Hui Shi. And ladies and gentlemen, you have just heard the investment case for China's property sector. And right now, we'll just move on very quickly to our last sector for the day, and that's the banking sector, which is represented by Feline. And the Chinese banking sector has surprisingly been holding up well despite the volatility that we have seen in China's equity market. So right now, I'll just invite Feline to present her investment case for an investment into China's banking sector. Feline, please.
All right. Okay. Thanks, Weiren. So yeah, as the last speaker for this session, I just want to share one of the most important sectors in any economy, which is the China banks. So in our opinion, there are three big reasons why we think that you should pay attention to the Chinese banks. So number one, we believe that there's still very decent growth prospects for the banks. Number two, they are very, very attractive yield plays. And number three, they are trading at very cheap valuations level. So just to start off with my first point is about the growth prospects of the Chinese banks. Yeah. Okay. So when I'm talking about growth prospects, specifically I'm talking about the net interest income outlook of the banks. So the reason why I want to focus on this is because for the Chinese banks, majority of their operating income actually comes from net interest income. So about 80% on average. And so naturally, I think it's important for us to take a deeper look at this revenue stream. So when it comes to net interest income, there are two components. We have the net interest margins and we have the loan growth. So just now, I think we have discussed quite in depth about how the Chinese economy is currently facing a softening economic growth. And to tackle this, Chinese regulators have implemented several easing measures to stabilize the economy. So rate cuts is one of them. So as a result, we do expect to see the net interest margins of the banks narrow in the coming quarters. But on top of rate cuts, there are also other easing measures. We have the reserve requirement ratio cuts. So this was done in December last year and April this year. And what this means for the bank is that they do not have to hold as much cash with the central banks as before, which should translate to higher liquidity available for lending. So in fact, in January this year, we saw a record amount of new loans being extended by the Chinese banks, during which it grew by 11%, and most of these growth came from corporate loans. But what was really interesting to see is that the year-on-year growth in mid to long-term corporate loans returned back to the positive territory after a contraction that lasted throughout the second half of last year. So of course, moving forward, we remain cautious over the short-term outlook of the new loans given all the lockdowns in the major China cities. But generally, we are still optimistic about the overall loan growth of the bank in the coming years, given how we are seeing increasing capex in key sectors such as manufacturing and industrial. So in the 14th five-year plan, Chinese government it said that it aims to become a manufacturing powerhouse by upgrading their current industrial and supply chain in the next couple of years. So one good example is the semiconductor industry. So the Chinese government has been stepping up its effort to promote the local semiconductor industry because they want to aim to achieve self-sufficiency when it comes to chip production. So all these capex and upgrades, in our opinion, should translate to loan growth for the Chinese banks. And in fact, we see that corporate loan growth will be the main driver behind this loan growth for the banks. And besides, another point take note is that while China may be facing a softening economic growth, I think it's imperative for all of us to know that it is still one of the fastest growing economies in the world. So looking ahead, we can still expect to see double-digit loan growth in the financial year of 2022, which in our opinion will be a key factor that should help to support the bank's net interest income despite pressured net interest margins. And moving on to the second point, dividends. So capital return programs, which includes dividend payouts, they have been a very important component when it comes to any bank investors. So this is the same for the Chinese banks as well. So as you can see on the chart on the left, you can see the stark difference between the bank's price return and total returns, which include dividends. So I think investors will also be very happy to know that the Chinese Big Four banks, they have been increasing their dividends per share consistently over the last couple of years while maintaining a payout ratio of only 30%. So going forward, coupled with rising profits, we are inclined to believe that these dividends paid by the Chinese Big Four banks are indeed sustainable. And also at current share prices, investors can expect to receive dividend yields of more than 7% on average in the next couple of years. And finally, moving on to our last point, which is valuations. So you can see on the chart again, Chinese Big Four banks are really trading at very, very cheap valuations level. And at this kind of valuations level, we really do see more upside potential than downside risk for the banks. And besides, just now, Wei also mentioned, so the Big Four banks are actually now on a much stronger footing today. They are very well capitalized. They have adequate buffers to better prepare them for potential challenges ahead. So just to bring back my previous point again on dividend yield, if you are to enter into Chinese banking industry, you're actually getting paid at 7% every year while you wait for share prices to rebate. So therefore, I think to really sum it up, I think that the Chinese Big Four banks could be a very interesting industry for investors to consider, for those who have the risk tolerance, or also for those who've with the patience to wait for share prices to rebate. So our recommended product for this is none other than the China AMC Hong Kong Banks ETF. And for this ETF, it is listed in Hong Kong Exchange with the ticker code 3143. And also, Big Four banks actually makes up almost 50% or more of the total net assets of this index.
7+% dividend yield, that's actually quite attractive. For comparison, Singapore banks dividend yield right now on average are probably looking at about 4+%. So 7% is indeed a step up in terms of the yield. So in the interest of time, I'll just have one question for you, Feline, on the opening up of the banking sector in China to foreign players. This is indeed an attractive market, but yet at the same time, China is also allowing foreign players to come into its market. And that also means that in the future, in the long run, there's going to be increased competition in the banking sector. So Feline, what do you make of this situation?
Yeah, okay. So when China opens up its financial sector, no doubt competition will rise, but not everything is bad. So for example, right now, investment banking and security services are actually off limits to the China, even the largest China commercial banks, because the Chinese government, they want to minimize the risk faced across different aspects of the financial system. But now that they are opening up the financial sector, the Chinese government realized the need to kind of support the domestic players against the fight with the larger foreign players. So there were actually reports stating that the Chinese government is looking to break down the walls between the investment banks and commercial banks. So they are looking to issue new licenses so that the commercial banks can start offering investment banking and security services. So what this really means for the Chinese banks today is that this could be a potential new revenue stream in a form of fee income for them, which could then serve as a potential re-rating catalyst in the longer term. But besides that, I think more importantly, opening up of the financial sector really promotes transparency across the Chinese banks, which will also allow them to be more integrated to the global economy. So in our opinion, when that happens, this should reduce the risk premium that current investors are assigning to the Chinese banks, which will once again in the longer term help to support the overall valuations of the Chinese banks.
So more competition ahead, but yet at the same time, the Chinese government is going to support their domestic players and equip them with the necessary means to compete with some of these large players globally. So thank you so much, Feline. And ladies and gentlemen, you have just heard from Feline present her case on why you should consider an investment in the Chinese banking sector. So this is our final sector for the day. And just to wrap up today's segment, I will get each of the analysts to just conclude in a few sentences their investment case for their respective sectors. So I'll first start with Yen.
Hi. I think healthcare sector is the best place to be in right now because it has solid fundamentals. We know China has huge potential for patient and economic impacts. Its innovation is faster growing. Eventually would compete directly with MNCs outside of China. The current valuation of the sector is also attractive, so I believe it would generate attractive returns for investors.
Thank you so much, Yen. Yen represents China's healthcare sector. How about you, Heather?
So yes, China is one of the most innovative and digitalized countries in the world, and going forward, they aim to be even better and to be one of the leaders or even the leader. And so going forward, definitely China tech is going to grow, and long term, we still think that it's really attractive.
Heather represents China tech. And what about you, Hui Shi?
I think China's property bond market is the best place to be in right now because most of the downside risk has already been priced in after the significant drawdown that has happened over the past 1 year or so. And with the Chinese government pledging support to the sector, I think that the worst is already behind us and the property market is set for better times ahead. And at a yield to worst of over 30%, I think Chinese property bonds are looking very attractive, especially for long-term as well as income-seeking investors.
The only analyst today to be talking about bonds instead of equity. So could be something interesting for you to consider. So Hui Shi represents China property bonds. And what about you, Feline?
Okay, so I believe that Chinese banks is the best place to be in today because not only is it offering very attractive capital gains, but again, you're getting paid 7% per annum while you wait for share prices to re-rate. So right now, regulatory landscape in China is likely to remain fluid given how China is still undergoing rapid economic development. But trading at only 0.4 times, we really believe that there's more upside potential than downside risk for the China banks today.
Thank you so much, Feline, and thank you also to all the 4 analysts today for sharing your views with members of the audience. So I hope this session has been useful to all of you, those who are physically here, as well as those of you who are joining us online via the live stream. So I think China, obviously, there is a lot of things to worry about, but yet at the same time, it is also fair to say that a lot of this negative overhang has been reflected in the share prices. And as our analysts have highlighted today, there are still opportunities within China's equity market. So with that, I'll just conclude today's China's debate session. Thank you so much once again for joining us here at our ETFestival.
Thank you, team. That was definitely exciting and insightful. There are a lot of opportunities in China right now, but where will you be putting your money to? Tell us what you think. We'll pull up our poll system right now. To participate in the poll, firstly, log on to Event Live by scanning the QR code up on screen. Or you can find the same QR code on your event flyer. Click on Expand Your Horizon. Once you've logged in with your name and email, click on Agenda and Activities on the menu on the left-hand side. And under Agenda, click on the Join Poll button. Let's do that one more time. To head to the poll and participate, you have to scan the QR code up on screen right here. You can also scan the QR code on your event flyer. It will bring you to the same poll. You have to log in to Event Live. Click on Expand Your Horizon once you've logged in with your name and email. click on Agenda and Activities on the menu on the left-hand side. Under Agenda, click on the Join Poll button. We'll give you a couple more seconds before we start. There will be 3 questions in this poll and it will help us understand where we all are standing right now. Alright, without further ado, let's head to the first poll question. Question number 1. After attending the China debate session, which sector in China are you the keenest on investing in? We've just had the debate session. Are you the most interested in the healthcare sector, the technology sector, the property or real estate sector, or is it the last option? Nope, the China market is not for me. There are no right answers here. It's just to help us understand where you all stand. A couple more seconds and we'll check out the results right away. Alright, let's head to the results. It seems that we have an overwhelming 48.57% of you choosing the technology sector as the one you're most interested in. And the property and the real estate is at the lowest percentage. Interesting results. I hear some laughter around here. Let's move on to our second poll question. What is your biggest concern now when it comes to investing, especially in ETFs? Is it the Fed rate hikes and rising rates? Could it be the Russian-Ukraine war, China's growth risk, or it's because you're simply unsure of what to invest in? Or could it be the last option, catching falling knives? Is it all of them? Just a couple more seconds to go. And let's check out the results. An overwhelming percent, close to half of our audience here, are afraid of catching falling knives. And let's see, the smallest number of us here are worried about China's growth risks. Interesting, interesting. All right, let's move on to our last poll question for this segment. Are you already invested in the ETFs featured in our ETF Focus List? That's an interesting one. Yes, you are a long-time big fan of ETFs. Or is it the second one? Yes, you've chosen them from previous year's lists before attending today's ETFestival 2022. We've got a third option, no, but you're thinking of starting soon, or no, you're still unsure of how to start. Once again, there are no right or wrong answers, and these are all anonymous, so no worries, you won't find your name on our screen. Just a couple more seconds to go. And let's check out the results. An overwhelming number, 42.86%, have answered no, but you're thinking of starting soon. We are extremely glad that this festival has been helpful for you. And 11.9% have said no, we're unsure of how to start. Well, I hope that the rest of today's events will be able to help you out. Thank you for participating. The results definitely gave us an understanding of where our investors stand. For those of you keen to know more about the opportunities within these sectors, you can continue to find more updates and ideas from the research team published on FSMOne.com. Let's now move along to our quiz segment. Do you think you know all about ETFs? Now here is your chance to prove it. 5 lucky winners will each walk away with $100 worth of FSMOne multi-currency cash account credits. You have to get to the poll once again. To get there, you have to be on Event Live. The QR code is right here up on screen. Make sure to scan the QR code with your phones. Once you get in, click on Expand Your Horizon. And once you've logged in there, with your name and email address, click on Agenda and Activities on the left-hand side menu. Let's give us all a bit more time to get there. After scanning the QR code on screen, click on Expand Your Horizon. Log in with your name and email. There is a left-hand side menu. Click on Agenda and Activities. I hope you're there. Under the Agenda section, click on Quiz. Click on the Join Quiz button. The activity window will be displayed on the right. And after the quiz ends, there will be 5 quiz questions. After each quiz question, there will be a leaderboard. And you can check if you are one of our winners. Just a couple more seconds to go. Scan the QR code, log in, and click the Join Quiz button. There will be 5 quiz questions. Fastest fingers first. You have to aim to be the 5 fastest per people to answer the questions. All right, I see that we're all ready. Let's move on to the first question. Quiz question number 1. When was the ETF Focus List first introduced on FSMOne.com? Is it 2017, 2018, 2019, or 2020? When was it first introduced on FSMOne.com? Fastest fingers first. Do your best to answer as fast as you can. And all right, let's check out the results. You have to aim to be the first 5 fastest people who've answered. At the end of each question, there will be a leaderboard. And it seems that the majority of us have got it right. It is in 2018. We did introduce that in 2018. 45% of you, congratulations, that is the correct answer. Now let's check out the leaderboard. Congratulations to our first 5. We've got YTC, Yuan He, Anne, Shainu, and Kiet, but not to worry, CJ and G, Shia, Jennifer, Will, Go, and to the rest of you whose names are not here, you still have a chance. You will have this leaderboard coming up after every question. Let's move on to our second quiz question. Which ETF has been newly added to the 2022 ETF Focus List? You'd have to really know our focus list to be able to answer this one. First Trust Dow Jones Internet Index Fund. We've got Global MSCI China Financials ETF. We've also got the VanEck Vectors Russia ETF and the Nickel AM Straits Trading MSCI China EVFM ETF. That was a mouthful. Which was newly added to our 2022 list. Let's check out the results. Wow, that's amazing. Close to half of us, once again, have got it right. It is the Nickel AM Straits Trading MSCI China EVFM ETF. The global MSCI one was really close, but congratulations to all of you who've got it right. Not to worry, we've got 3 more questions to come. Let's check out our leaderboard. Wow. I think JJ is a newcomer in our top 5 rankers in today's quiz. Congratulations once again to all 5 of you, but to the rest of you out there, no worries, we've got 3 more questions and let's hit question 3. Which of these is a top performing equity market in terms of year-to-date returns? Could it be Brazil, Europe, Singapore, or South Korea? Which of these countries is a top performing equity market in terms of year-to-date returns? All right, I think we've got enough time to answer this one. Let's head to our results. We've got 4 countries in here, and we're looking for only the top performing one. And congratulations, close to 60% of you have got it right. It is our very own Singapore. A small percentage of you chose Europe and South Korea, but no worries, let's check out the leaderboard. We've got 2 more questions to go. Wow, the names have changed once again. Now, in order, we've got rank 1 YTC, followed by Kiat, Yuanher, Shireen, and Will. Congratulations. I think we've got a few names new on our list, and Kiat has risen up the rankings. Let's go on to our fourth quiz question right now. Which of the following bond sectors has been more resilient in recent months despite rising interest rates? Which of the following bond sectors has been more resilient in recent months despite rising interest rates? Healthcare, real estate, technology, or is it commodities? Take your pick. Once again, it's fastest fingers. Do your best. Our 5 lucky winners will walk away with $100 worth of FSMOne multi-currency cash account credit, so don't miss out on this one. And an overwhelming 55.88% of you got it right. You went with commodities. Congratulations. Let's move on. This will be our final quiz question for this segment. But let's check out the leaderboard first. Congratulations, Will. You've gone really fast as the questions went by. Tanengi, Shainu, YTC Go, congratulations. Now, time for the final question. Which of the following bond sectors has been more resilient in recent months despite rising interest rates? Could it be the emerging market bonds sector, the global high yield bonds sector, the Chinese government bonds sector, or the Sri Lankan bonds sector? This is the final deciding moment to see who are our 5 lucky winners for this segment. I'll just give you a couple more seconds to go. And a disclaimer, even if you do fall out of our top 5 rankings, we do have another segment later on after lunch as well. Alright, let's check out the results. 52.11% chose Chinese government bonds and got it correct. Congratulations! Now let's check out our leaderboard. It's time for the moment of truth. And congratulations, Tan Engyi, YTC Go, Chik, and WKJ. If you see your names from rank 1 to 5, congratulations, you are one of our lucky winners. Now, all you have to do to get your prize is to take a screenshot showing the entire activity window. Ensure your rank, score, and nickname are captured clearly. Then, email the screenshot and include your name, FSM account number, and the daily quiz date to events@fundsupermart.com. You have to email us by 31st of May to claim your prize. Once again, if you are one of our 5 lucky winners, take a screenshot showing the whole activity window, making sure your rank, score, and nickname are captured clearly. Then, email the screenshot and include your name, FSM account number, and the daily quiz date to events@fundsupermart.com by 31st of May to claim your prize. Now we're keeping up with this pace. It's now time for our lucky draw segment. For those of you who are here in the hall today, this draw applies to you. If your name is called, you must be physically present to claim your prize. In the event that you're not able to come up on stage, a new winner will be chosen. Let's welcome up on stage John Paul to give away the prizes. A round of applause for him, please. There will be 8 winners in this round. We'll pick the first 7 winners first, where each of you will win $100 worth of FSMOne cash account credits. We will have an extra lucky winner after this, and I will reveal what the prize is later on. Let's start with our first lucky winner.
Good luck, everyone. Okay, the first lucky winner's number 8424.
You can check out your event flyer to see what your number is. 8424. Congratulations, sir.
Would you like to come to the stage? I'll pass you the special envelope.
You can head up from the side and then take a photo. Congratulations, a round of applause for our lucky winner.
Oh, okay. Thank you. Yeah. Thank you. Good luck.
Now let's move on to our second winner, who will also win $100 worth of FSMOne cash account credits.
Okay, the lucky winner, 8439.
Congratulations, sir! Let's welcome him up on stage. Moving on to our third winner for this segment.
The numbers are quite close, so still very close. 8437.
Congratulations! A round of applause for him, please. Moving on to our next winner.
Okay, now we have first two numbers. Yeah, a bit different. 8395.
$8395. You can check out your event flyer for the number. We'll give you 3 seconds to find out your number. If not, we will do another draw.
8395. Going one final time. Right.
Once, twice, sold to the next draw.
Okay, we'll carry on to the next one. Okay, lucky winner with the number 8409.
Congratulations! And on to our next winner. $100 worth of FSMOne cash account credits.
For free. 8443.
Congratulations! This lucky sir is our 5th winner for this segment. Let's move on to our 6th winner.
Okay, the lucky number is 8435. Congrats.
Congratulations! Right after this, we'll move on to our 7th lucky winner, walking away with $100 FSMOne cash account credits. Before we move on to our final extra lucky winner, who will win something special.
Okay, the lucky winner is 8407.
Congratulations. Right after this, we will be doing our draw for the extra lucky winner, where that person will win $500 worth of dining and accommodations voucher for the Grand Hyatt Hotel. It's time to unveil our extra lucky winner for this segment.
Okay, our lucky winner has the number 8445. Congrats.
Congratulations, sir. If your number wasn't called, don't worry, there's still a chance to win at our next lucky draw round in the afternoon, so stay tuned for that. Congratulations once again to all of our lucky draw winners. And thank you, Jean-Paul. That's all for this morning's Expand Your Horizons segment. We'll be back at 2:15 p.m. where more presentations are in store in our Engage the Future segment, plus another lucky draw and quiz. In the meantime, if you don't have an FSMOne account, why not open one today? FSMOne.com is giving 3,000 rewards points to those who open an account just for today using the promo code ETFEST 2022 I was here. In addition, if you refer a friend to open an account, both you and your friend will each receive 3,000 rewards points. Also, take the chance during lunchtime to snap a photo of yourself today at the ETFestival and share it with your friends on Instagram. Tag FSMOne.com and you could be one of our 10 lucky winners to each receive $50 worth of FSM cash account credits. Head over to FSMOne.com's Instagram for the full instructions. We'll see you back here at 2:15 p.m.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains. Welcome to Last Station.
Welcome to Retirement with Ease.
Hey guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for FS TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
I must have been in my early 20s when I started investing.
Started working in a stockbroking firm as an investment analyst.
Later, I really find that investment was my passion, so
I just went to buy my first stock, and that was how I started.
Investing is never about punting. It is about taking a long-term view.
It's always about the evolution because market do change, and as an investor, we need to be adaptive.
Well, firstly is earnings potential of the company.
Understand the business model of the company.
The uniqueness of the product and the instrument.
The investment must support who I am, my life decisions.
Hi, I'm Wee Kiong.
I'm Alvin. My name is Christopher.
I'm Lim Chang Chun.
I'm Kenny.
Here is my investment
resume.
investing is like an art form.
The stock price will follow the long-term fundamentals of a business.
No, we want to invest in companies that are fast growing.
How do we actually know that the market is growing?
The past may not always mirror the future, but we want to see that at least there's a track record to show that our management team has been able to grow the company in a certain way.
In this show, we'll give you a peek into the minds of great investors, as well as their take on stocks investing. So no fluff, only solid stuff to help you become a better investor.
Exchange-traded funds, or more commonly known as ETFs, are growing in popularity because of their simplicity, cost-effective approach to investing, as well as the diversity they provide. Hundreds of new ETFs are launched every week, and while this is absolutely great news for investors, sometimes there are simply too many for investors to sift through one by one. Therefore, for our monthly ETF radar, we will be sharing some of the more prominent new ETFs that might be something you will be interested in.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease. Hey guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for FS TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune into iFast TV if you want to hear all these different programs in the different languages and dialects.
I must have been in my early 20s when I started investing.
Started working in a stockbroking firm as an investment analyst. Later, I really find that investment was my passion, so
I just went to buy my first stock, and that was how I started.
Investing is never about punting. It is about taking a long-term view.
It's always about the evolution because market do change, and as an investor, we need to be adaptive.
Well, firstly is earnings potential of the company.
Understand the business model of the company.
The uniqueness of the product and the instrument.
The investment must support who I am, my life decisions.
Hi, I'm Wee Kiong.
I'm Alvin. My name is Christopher.
I'm Lim Chang Chun. I'm Kenny.
Here is my investment
resume.
Investing is like an art form.
The stock price will follow the long-term fundamentals of a business.
No, we want to invest in companies that are fast-growing.
No. How do we actually know that the market is growing?
The past may not always mirror the future, but we want to see that at least there's a track record to show that our management team has been able to grow the company in a certain way.
In this show, we'll give you a peek into the minds of great investors, as well as their take on stocks investing. So no fluff, only solid stuff to help you become a better investor.
Exchange-traded funds, or more commonly known as ETFs, are growing in popularity because of their simplicity, cost-effective approach to investing, as well as the diversity they provide. Hundreds of new ETFs are launched every week, and while this is absolutely great news for investors, sometimes there are simply too many for investors to sift through one by one. Therefore, for our monthly ETF radar, we will be sharing some of the more prominent new ETFs that might be something you will be interested in.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease. Hey guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for FS TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
I must have been in my early 20s when I started investing.
Started working in a stockbroking firm as an investment analyst. Later, I really find that investment was my passion. So
I just went to buy my first stock, and that was how I started.
Investing is never about punting. It is about taking a long-term view.
It's always about the evolution because market do change, and as an investor, we need to be adaptive.
Well, firstly is earnings potential of the company.
Understand the business model of the company.
The uniqueness of the product and the instrument.
The investment must support who I am, my life decisions.
Hi, I'm Wee Kyung.
I'm Alvin.
My name is Christopher.
I'm Lim Chang Chun.
I'm Kenny. Here is my investment
resume.
investing is like an art form.
The stock price will follow the long-term fundamentals of a business.
No, we want to invest in companies that are fast-growing.
How do we actually know that the market is growing?
The past may not always mirror the future, but we want to see that at least there's a track record to show that our management team has been able to grow the company in a certain way.
In this show, we'll give you a peek into the minds of great investors, as well as their take on stocks investing. So no fluff, only solid stuff to help you become a better investor.
Exchange-traded funds, or more commonly known as ETFs, are growing in popularity because of their simplicity, cost-effective approach to investing, as well as the diversity they provide. Hundreds of new ETFs are launched every week, and while this is absolutely great news for investors, sometimes there are simply too many for investors to sift through one by one. Therefore, for our monthly ETF radar, we will be sharing some of the more prominent new ETFs that might be something you will be interested in.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease. Hey guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for FS TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune into iFast TV if you want to hear all these different programs in the different languages and dialects.
I must have been in my early 20s when I started investing.
Started working in a stockbroking firm as an investment analyst. Later, I really find that investment was my passion, so
I just went to buy my first stock, and that was how I started.
Investing is never about punting. It is about taking a long-term view.
It's always about the evolution because market do change, and as an investor, we need to be adaptive.
Well, firstly is earnings potential of the company.
Understand the business model of the company.
The uniqueness of the product and the instrument.
The investment must support who I am, my life decisions.
Hi, I'm Wee Kyung.
I'm Alvin.
My name is Christopher.
I'm Lim Chang Chun.
I'm Kenny. Here is my investment
resume.
Investing is like an art form.
The stock price will follow the long-term fundamentals of a business.
No, we want to invest in companies that are fast-growing.
No. How do we actually know that the market is growing?
The past may not always mirror the future, but we want to see that at least there's a track record to show that our management team has been able to grow the company in a certain way.
In this show, we'll give you a peek into the minds of great investors, as well as their take on stocks investing. So no fluff, only solid stuff to help you become a better investor.
Exchange-traded funds, or more commonly known as ETFs, are growing in popularity because of their simplicity, cost-effective approach to investing, as well as the diversity they provide. Hundreds of new ETFs are launched every week, and while this is absolutely great news for investors, sometimes there are simply too many for investors to sift through one by one. Therefore, for our monthly ETF radar, we will be sharing some of the more prominent new ETFs that might be something you will be interested in.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease. Hey guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for FS TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune into iFast TV if you want to hear all these different programs in the different languages and dialects.
I must have been in my early 20s when I started investing.
Started working in a stockbroking firm as an investment analyst. Later, I really find that investment was my passion, so
I just went to buy my first stock, and that was how I started.
Investing is never about punting. It is about taking a long-term view.
It's always about the evolution because market do change, and as an investor, we need to be adaptive.
Well, firstly is earnings potential of the company.
Understand the business model of the company.
The uniqueness of the product and the instrument.
The investment must support who I am, my life decisions.
Hi, I'm Wee Kyung.
I'm Alvin.
My name is Christopher.
I'm Lim Chang Chun.
I'm Kenny. Here is my investment
resume.
investing is like an art form.
The stock price will follow the long-term fundamentals of a business.
No, we want to invest in companies that are fast-growing.
No. How do we actually know that the market is growing?
The past may not always mirror the future, but we want to see that at least there's a track record to show that our management team has been able to grow the company in a certain way.
In this show, we'll give you a peek into the minds of great investors, as well as their take on stocks investing. So no fluff, only solid stuff to help you become a better investor.
Exchange-traded funds, or more commonly known as ETFs, are growing in popularity because of their simplicity, cost-effective approach to investing, as well as the diversity they provide. Hundreds of new ETFs are launched every week, and while this is absolutely great news for investors, sometimes there are simply too many for investors to sift through one by one. Therefore, for our monthly ETF radar, we will be sharing some of the more prominent new ETFs that might be something you will be interested in.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease. Hey guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for FS TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume.
歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters.
Welcome to the iFast TV Market Outlook 2022 series.
Tune into iFast TV if you want to hear all these different programs in the different languages and dialects.
I must have been in my early 20s when I started investing.
Started working in a stockbroking firm as an investment analyst. Later, I really find that investment was my passion, so
I just went to buy my first stock, and that was how I started.
Investing is never about punting. It is about taking a long-term view.
It's always about the evolution because market do change, and as an investor, we need to be adaptive.
Well, firstly is earnings potential of the company.
Understand the business model of the company.
The uniqueness of the product and the instrument.
The investment must support who I am, my life decisions.
Hi, I'm Wee Kiong.
I'm Alvin.
My name is Christopher.
I'm Lim Chang Chun.
I'm Kenny. Here is my investment
Resume.
Welcome back, everyone! Have you managed to take part in the photo challenge and snapped a photo of yourself today at the ETFestival? You could be one of the 10 lucky winners to receive $50 worth of FSM cash account credits. If you haven't, head over to FSMOne.com's Instagram for the full instructions. Next up, FSMOne.com is offering 0% processing fees on ETF RSP. With ETF RSP, you can start growing your investment portfolio by investing into ETFs on your choice on a regular basis from as little as $50 a month. Pick from a range of over 70 ETFs listed on the SGX, Hong Kong, and US exchanges and start growing your portfolio. 7 lucky people here with us today will each walk away with $100 FSM1 cash account credits, and one more lucky winner could win a brand new Apple iPad at this afternoon's lucky draw. To enter the lucky draw, remember to tear out the lucky draw stub on your event flyer and drop it into the box at the FSM1.com booth located outside. Now, don't forget to also pay attention to the upcoming presentations, as you could be one of our 5 winners at the quiz today and win yourself $100 worth of FSM1 cash account credits. You have to be on Event Live to take part, so be sure to join us there. You can scan the QR code up on screen to take you there. And finally, for this year at ETFestival is Stage B. There, you will have an opportunity to ask your burning questions directly to our partners and ETF issuers. For those interested, do take note of the timings up on screen. Remember to be on Event Live as well in order to access Stage B. As we gear up for the start of this afternoon's sessions, we'd like to begin with another poll. To get to the poll, you have to first be on Event Live. To get there, scan the QR code on your event flyer or up here on screen. Once again, you have to be on Event Live in order to join us at the poll. In order to do that, dish out your phone and you can scan the QR code up here on screen, or choose to scan the code on your event flyer. Once you're there, click on Expand Your Horizon. Click on Expand Your Horizon, and once you've logged in with your name and email, click on Agenda and Activities. Log in with your name and email, and on the left-hand side menu, you can find Agenda and Activities. Under Agenda, look for Poll, then click on Join Poll. There will be a left-hand side menu after you log in. Under Agenda, look for the poll and click on the Join Poll button. If everyone is ready, let's take a look at some of the poll questions we have for this segment. There will be 3 questions in this poll segment. Let's check out question number 1. How have you reacted to the recent market rout? First option, nothing. Long-term prospects are not affected. Second, nothing because I don't know what to do. 3, sold some, most holdings to hold cash. A fourth option, kept calm and bought the dips. And lastly, rebalanced my portfolio. How have you reacted? Let's check out the results real quick. An overwhelming 58.62% chose kept calm and bought the dips. Good job, everyone. A small number, 3.45%, chose rebalanced my portfolio and sold some, most holdings to hold cash. Now let's move on to our second poll question. Which of the following investment themes are you most interested in? Commodities, green technology, rare earth metals, electric vehicles and future mobility, REITs, general thematic investing. Well, they are all extremely interesting. Which of the following investment themes are you the most interested in? The poll questions are a great way for us to understand your preferences as well as for you to understand everyone else's. And we've got some really good balance of answers over here. 30.3% chose electric vehicles and future mobility, following closely at 24.24% general thematic investing. Thirdly, wow, green technology. Next question. Are you currently investing in any sustainable or ESG related products? Yes, you're a long-time believer in ESG. Yes, but you just started. 2, no, but intending to do so soon. Or lastly, no, and no intentions to do so. Are you currently investing in any sustainable or ESG related products? This is the last poll question for this segment before we kick it off with the other events up ahead. All right, and the results are a pretty good balance of numbers as well. 30.56% chose no but intending to do so. 33.33% are pretty new. 22.22% stuck to no and no intentions to do so. And a pretty small percentage of 13.89% said yes. Thank you to all of you for joining us in the poll. There are definitely a lot of opportunities considered, so without further ado, let us now turn our attention to this afternoon's session as we engage the future at FSM ETFestival 2022. Kicking off this segment on thematic investing with ETFs is Christian Obrist, Director, Head of iShares Distribution Asia at BlackRock. A round of applause to invite Christian up, please.
Okay, good afternoon, everyone. I get to take off my mask, which is lovely. Nice to see you all here. I'm just going to pop that back here because I don't have any hands-free. So my name is Christian Obrist. As it said on the screen, I run the distribution team here in Asia, based out of Singapore for iShares. I've been doing it for 10 years, so I've been around the ETF game for a little while. And today we're going to talk about thematic investing, which I think is really exciting because it's grown If you look at last year, it grew about 50% in the global assets under management. So it went from about 130 billion US dollars to about 180. So incredible growth last year. And really, you know, sort of a catalyst for this has definitely been the pandemic, which, you know, for a lot of us here in the room, the changes to the way we live, the way we work are very obvious, right, and have been quite profound. And also that there might be a sort of a long-term effect of the changes. So they're going to be around for a long time. So when you think of thematic investing, it's quite targeted. It's not as targeted as buying single stocks, but it's also not as broad as when you invest into broad indices like you find in many ETFs, certainly in a lot of iShares ETFs, which are very broad. Now, a couple of other things to say about thematic investing. So, as I said, quite targeted. The other characteristic is that it's usually based on a structural shift, a sort of a one-time shift that we think is going to stick around for a long time. That's also what we call the mega trends. And then the final thing is it's usually quite unconstrained as well, right? From a geographical perspective, but also from a sector perspective. So I'll give you an example. If you think of an automobile maker, or electric cars, it could fall under autos, but it could also fall under tech. So where does it fit? It's a little bit ambiguous, right? So that's really to just sort of start. Now, I did say, right, the world is changing rapidly. Investment portfolios are also changing rapidly. So one example I'll give you here. Innovation beyond the FANGs, and you probably all know what the FANGs are, right? It's the big tech stocks, your Facebooks, your Apples, Googles, etc. And yes, they do comprise, almost 20% of the S&P 500. But if you dig a little bit deeper, what's actually happening in the space around the FANGs? Well, 97% of new patents since 2019, so just a couple of years, is coming from companies outside of the FANGs, right? So there's a lot of innovation that's happening, and it's not happening just with the big guys. I think the other thing that's really obvious to everyone is the position of the US in the world's economy and also China's, right? And there's definitely a bit of a shift going on there, right? The US GDP as a percentage of global GDP is going down and China's is going up. Again, long-term trend. We've been observing this trend for a long time. So again, I think we can ask ourselves the question, what are these long-term trends? And I think that's the beauty about thematic investing. It's very relatable. It's themes that touch us, themes that we can understand, right? We don't need to take single stock risk when we invest. And it's also not so watered down into a broad index where you're going to get a lot more than what you think you're buying as well. Now, I talked about targeted access. So we've got an example here. So if you took $10,000 back in 1999 and you invested it, we've got a couple of options here in the colored boxes. On the blue, so on the left, you've got two stocks, Amazon and eToys. So back in 1999, these were very promising companies. But still, right, what were the chances that you're going to pick these two stocks back then? They were just up and coming. No one knew the global success that Amazon would have today. So if you took $10,000, well, you'd almost have $500,000 if you bought Amazon. eToys went bankrupt 2 years later. So not such a great trade. On the other side of the continuum, you have the NASDAQ composite. And guess what? Your money would have gone up 5-fold. Not bad either over 23 years. But there's another way, right? And that's this middle segment. These are the products that are coming to market at the moment and have been over the last few years. These are some of these targeted thematic indices. They are not quite as concentrated as buying just a few shares, and they're not as wide. So they fill a nice little space. Here's an example that we have with an MSCI index, and the figure sits nicely in the middle with almost 300K. So let's move to the next slide, please. So we were talking about thematics really being related to long-term predicted trends, right? So at BlackRock, we have categorized these into 5 different buckets. And again, I think all of you here and on the screen and at home, if you look at these 5, they're kind of relatable, right? Like, you don't need to be a rocket scientist to realize that with technological breakthrough, with all the innovation that's going on, 5G, cloud computing, artificial intelligence, there's a lot of progress being made, right? But how do you invest into this? Well, now you have some options, right? And you don't have to do all the homework yourself. Demographics and social change, right? Same thing. People are living longer. So we need to have different medicine. But medicine is also making us live longer, and it's changing our consumer behavior. So there's all kinds of opportunities that come up from an investing perspective. Rapid urbanization, right? Movement, and this has again been going on for a long time, movement from rural areas into the cities. And what does it mean? We need to build more. And you have aging cities around the world, particularly in the United States. So you've got to reinvest. Emerging markets, you've got to build more. So again, a lot of opportunity. Climate change, probably don't have to say too much about that. Bigger demand for cleaner energies, right? But then also companies under pressure to also make net zero pledges. And at BlackRock, this is a big topic for us, sustainability. And we think that climate risk is actually investment risk, because as the whole economy's transition to net zero, you have winners and you have losers. And so you want to pick the winners. And then finally, emerging global wealth. I think of that in 2 ways. Number one, you have this rising middle class around the world, particularly in emerging markets, which is really coming up, and you want to get in there and you want to tap into those opportunities. And then again, what I mentioned earlier, this global shift a little bit away from the United States and more into China and the emerging markets. So this is how we bucket it. There are, of course, many different, sub-themes that you can tap into. And there's a lot of products, right? As I said, the industry has grown 50% last year. A lot of products coming to market. Next slide, please. Now, I just wanted to talk you through this briefly, not to get too technical at all, but at BlackRock, the way we think about constructing an index for a thematic product is a little bit like a funnel. That you start with the global universe of stocks, right? And then you pass it through the funnel. And if you think of your theme first, so we're going to stick to the electric vehicle. But we don't just want to be buying electric car vehicle makers, right? There are other benefactors in the value chain. So there's the lithium battery providers. There are the EV charging station makers, right? The more EVs that get sold, they will also sell more of their product. So you want to make sure that you're getting that whole value chain. Secondly, once you've determined that, how do you really figure out that the companies you're going to get really, derive their revenue from those sources? Well, that's where fundamental research comes in. This is where big data comes in. So it makes sense to work with companies, providers, index providers who have the scale to do that properly. Finally, we talk about the weightings in the fund. We also talk about the liquidity. We don't want to buy shares that are very difficult to trade, that might have a high transaction cost, because all of that eats into your performance as well. And then what's not here on the screen, but the other consideration, especially for us, that's important is sustainability considerations. Again, based on what I said before. So you'll find a lot of the thematic funds also have some ESG, sustainability screens applied to them. Now, one of the, we'll move ahead to the next slide, please. Blockchain investing, we'll go straight to the next one. Now, blockchain, I'm sure everyone in this room has heard of it. I'm not sure that everyone knows exactly what it is, and there's probably different tiers of understanding. I recently saw a video, this was on YouTube, that had someone from the industry explaining blockchain at 5 different levels, to a 5-year-old child, to a teenager, to a university student, etc., etc. And it was fascinating because you also had to try and boil it down and make it as easy as possible. But often there's that misconception that blockchain equals Bitcoin, right? And that's not true. Bitcoin's a cryptocurrency. It is based on the technology of blockchain, as many of the other cryptocurrencies. And Bitcoin was developed in 2008, blockchain actually in 1991. And it started as document verification, right? So Bitcoin, in its sort of most simplest, blockchain, in its most simplest form, it's a record, right? And if you think of it in the context of the internet, it's basically this record or a protocol which allows an internet user, that could be anyone in the audience here, to pass digital content to another internet user. That could also be someone in this room. And to sort of bring that to life, what am I talking about? Well, it could be a payment. It could be tracking, a parcel that you have sent somewhere. It could be, just verifying someone's identity. And, there's a lot of things that are operating on blockchains now. A lot of media, a lot of entertainment, books, movies, right? And in the business world, like I said, payment processing, regulatory accounting, the list goes on and on. But the key thing here with blockchain is that it is very safe, very secure, and the main thing, and this is the absolute key point, is it is decentralized. So what does that mean? It is peer-to-peer. So again, to sort of give you an example, and I'll say old world, which we're still sort of living in, but if you make a payment, you use an intermediary, a bank transfer agent. In the future, using blockchain, you may not need to do that anymore. You can all communicate and transact with one another. And I know that's a little bit of an abstract idea, but that's essentially what it does. So on the next slide, and I love this quote, what the internet did for communications, blockchain will do for trusted transactions. So I think we can all relate to what the internet did for communications. So in that spirit, we can sort of apply what it's going to do for trusted transactions. And even that, when I first read that, I was like, well, what does that even mean, right? That doesn't really sound so exciting. But think about it. If we're talking about identity security or trade, right? Transacting. If you take away the need for an intermediary because it's all trusted, well, guess what? It opens up this whole gamut of possibility to trade with one another, and probably at a cheaper price point as well. So I think that's what really this is all about. Now, we'll move to the next slide, please. I'd like to show you a couple of examples on how this adoption is taking place at the moment. So number one, central banks. If you look at the last couple of years, 2 years ago, there's only about 30 plus central banks looking at digital currency. Today, it's 87, right? That's a big number that's gone up. You think of the top 100 publicly listed companies, 80% are already using blockchain in some shape or form. And you've got a couple of examples here on the screen, right? Whether it's payment processing, tracking, digital identification. These are all real life applications, and a lot of them are already being used. But again, most of us just think of Bitcoin and Ethereum. That's just the tip of the iceberg. The other thing that's really interesting is when you look at the generational sort of buckets here in terms of acceptance of crypto. So not blockchain, but crypto, and we're going to really keep those apart. But millennials obviously have a much higher acceptance, almost 1 out of 2, whereas the baby boomers, it's 1 out of 5, right? So that probably doesn't surprise, but what does it tell you about the future, right? And then finally, I'll just leave you with this. I think, again, the way that BlackRock thinks about some of these blockchain products and investments, we like to look at it in a diversified way, the same way that you would with a thematic ETF or fund, right? Not too much concentration, get a bit of a mix of what's out there. Here we're looking at 4 different areas of blockchain. So you've got the asset mining part, you've got the exchanges that are also part of that ecosystem, you've got the hardware, right? If we think of the electric vehicle, that could be the battery, it could be the charging station, so there's hardware here. And then there's just general enablers that are all part of that wider ecosystem. So again, we think of it as a safe way to sort of get involved, not be too specific in what you're investing in and have that sort of binary risk that it may work, it may not, right? Some people have made millions with Bitcoin, others have lost millions, and right now it's not going so well. But again, we shouldn't be too concerned, and I can see most of you are not too concerned. You're buying the dips. That's actually really good to see. And when I think of thematic investing, and I think the audience here, you are actually proof of all of this, that when it comes to investments, the last 2 years, and I represent ETFs, we have seen the number of unique ETF users double globally, not just iShares, everyone else as well, double in the last 2 years during the pandemic, right? It is shifting behaviors. So I think I'm going to leave you with that. Thematic investing, a lot of ideas out there, most of them relatable, most of them based on long-term trends. And what I think, is prudent for everyone to do is just make sure you understand the products, right? Don't just look at the label, look a little bit deeper, what am I actually buying? And I think what's nice about some of the thematic ETFs is it does occupy a space where you're not too concentrated, you're going to get diversification, and also the other thing is when you're buying the themes, you might want to think about not just buying one theme, because like any other investment, sometimes it's going to go up and sometimes it's going to go down. So you might want to diversify your thematic investments too. So unfortunately, we don't have more time. It was just a 15-minute quick fire presentation. Certainly, I think there's a Q&A session, so you can speak to my colleague and ask some questions. But it's been a pleasure to be here today, and I wish you a nice rest of day. Thank you very much.
Thank you, Christian. iShares will be coming online over at Stage B soon, where they will be on hand to handle your queries. So for those of you who are interested, here is your chance to have your questions answered. Quick question. Have you noticed that prices of petrol, electricity, and food have been going up? You probably have. Commodity prices have been one of the main drivers of what has now become the highest inflation in a generation. Here's how investors can play the commodities boom. Here to share more with us is Chloe Nadia Halim, Research Analyst of Research and Portfolio Management at IFAS Singapore. A round of applause to welcome Chloe on stage.
So hello everyone, thank you for joining us today. My name is Chloe and I'm a research analyst from IFAS Singapore. For today, I will be sharing about how rising inflation as well as the Russia-Ukraine crisis have brought about a commodity supercycle. So here's the content outline for the presentation today. First and foremost, we'll be touching on the impact of the Russian-Ukraine war on the commodities sector. Next, I'll be explaining why we think that the commodity prices will continue to remain elevated going forward, especially given this demand-supply imbalance within the whole commodity space. Moreover, in a high inflationary environment that we are currently in, commodities, they serve as a useful inflation hedge. And last but not least, I'll be providing some recommendations on how exactly we can go about to invest in the commodities sector. So the war in Ukraine has wreaked havoc on the global economy, and this economy is already suffering from soaring inflations as well as many supply chain disruptions. So Russia's invasion has severe implications because of the fact that Russia is so resource rich. So Russia is the world's second largest crude oil exporter, and they supply about 40% of Europe's natural gas. So beyond oil and gas, Russia is also amongst the leading producer of metals such as aluminium, nickel, copper, and iron. And if we look further down, the country is also largely involved in the agriculture commodity space, and they are responsible for about 20% of the world's fertilizers, as well as a major player within the wheat export industry. So given Russia's role as a commodity superstore, it's no surprise that a wide range of commodities out there have been impacted. And this ranges from that of the energy sector, such as the oil and gas, to that of the metals, and all the way down to that of the agriculture commodities. So in the next slide, it was no surprise that because of whatever is happening within this space, that the US as well as the global benchmark of oil prices, they've touched their highest levels. And this is pretty significant because the Brent crude oil price, they actually surpassed $100 a barrel in the first time since 2014. And when we look at what is happening within this space, we think that it appears that the current path towards a de-escalation of conflict, it becomes increasingly challenging. So over time, sanctions against Russia have been piling up. So let's take, for instance, the US as well as its allies. They've initially stopped short of imposing sanctions on Russian energy exports. But this has since changed as the US actually barred Russian energy imports as well as barred the Americans from financing the companies that invest in this Russian energy sector. And with regards to some of the latest news, the EU is actually now proposing a plan to ban Russian oil imports. And this is likely to be one of the toughest sanctions against Russia in response to their invasion of Ukraine. Moreover, we see this same scenario playing out within this whole agriculture commodity space. And this food price index, as seen in the chart here, is actually compiled by the UN Food and Agriculture Organization. So what it means is that it actually tracks a basket of food commodities. And as you can see here, these prices have been on an uptrend ever since last year, and they continue to reach an all-time high. So this is not surprising given that Russia is the world's largest exporter of wheat, while Ukraine is also another major exporter. So if we take Russia and Ukraine together, they combine, make up about 29% of the global wheat trade, and a prolonged military conflict would disrupt this trade and could make much of this wheat available to the export market, and you could see that the food prices would rise much further. So furthermore, this crisis is also being compounded by the fact that fertilizer prices have been rising as the war pushes up the price of natural gas. And this natural gas is a main input for things such as your nitrogen fertilizers, for instance. But despite all these recent volatility, we think that the rationale for investing in the commodity sector, they continue to remain intact, especially when you consider this demand-supply imbalance within this whole space. So this imbalance can be observed across the energy, metals, as well as the agriculture market. So looking into the markets, so let's take, for example, this energy market. And I would like to highlight the oil and gas specifically. So we see the case where the supply has been unable to keep up with this resurgent demand following a COVID-19 recovery. And one of the main reasons of this is due to the fact that this fossil fuel industry, they've fallen out of favor with the investing universe over the past decade due to many ESG considerations as well as mandates. And this is a sector that actually badly needed new investments in order to keep up with the growing demand. So in fact, we find the case where the annual investment in upstream oil and gas actually peaked in 2014. And as you can see here, since then, they've been on a decline, and this is despite the fact that the world is still consuming near record amounts of fossil fuels. So today, nearly all the energy that is needed to meet our needs, 80% of the global energy demand actually comes from burning fossil fuels. So it appears that for now, at least, renewable energy, they are actually unable to replace fossil fuels to meet our energy needs. And to make matters worse, the vast oil surplus that has been accumulated during the first few months of the pandemic have actually declined, and thus they've been wiped out with the many inventories of these OECD countries falling. So going forward, we think that this weak supply coming from the OPEC Plus will further worsen this demand-supply balance observed within this whole energy sector. So OPEC Plus, they are reluctant to actually pump more oil in order to cool oil prices, and are instead sticking to a modest output increase of 432,000 barrels per day. But this is an amount that actually has done little to kind of alleviate people's supply fears. And this is not surprising when you consider the fact that within OPEC, several producers, namely the West African countries, they are struggling with years of underinvestment, as well as the large maintenance work which has been delayed due to disruptions arising from this whole COVID-19 pandemic. And as seen in this recent news article, you can see that OPEC Plus, they've even fell massively short of their targets, as all these capacity constraints, they continue to persist. So in view of all these issues, the oil prices, we think, will likely remain elevated unless further supply becomes available or the world experiences some form of demand destruction. And that this could come when consumers reduce consumption in view of the high oil prices. So next, when we look within the metal space, I think a similar story can be illustrated here, where the demand for metals, in particular green metals, and these are the metals that are needed for this whole clean energy transition, in order to move away from that of fossil fuels to clean energy sources. So over time, this ongoing clean energy transition needed to combat these ill effects of climate change. They've unleashed a huge demand for metals within this coming decade. So let's take, for example, an electric car. So an electric car, for instance, requires about 4 times more copper than that of a normal conventional car. And besides copper, there are other metals out there such as lithium, cobalt, and nickel, and they are all tightly linked to this electric vehicle and energy storage sectors. So these demand for the metals are rising exponentially in view of all this. Not to mention, All of this are occurring as the largest economies of the world, such as your China as well as your US, they are actually pushing stimulus plans that are targeted towards this whole renewable energy infrastructure. So where it stands, this lack of supply has already sent these metal prices surging. So within the next slide, last but not least, the world is also experiencing a deepening food crisis. So even before this whole Russia-Ukraine war, there was a shortage of fertilizers in the market out there. So in 2021, for instance, there were sanctions imposed by the US on Belarus. And Belarus is the third largest potash producer. And this was following the Belarus president's brutal crackdown on widespread protests following his contested elections in 2020. And potash is one of the main input of fertilizers. And not to mention, as of last year, China is also tightening their export of fertilizers. So what this means is that they have actually shut off the supply of their fertilizers to that of the global market in order to try to limit their own domestic food prices. So last but not least, I think we all know that these fertilizer prices, they continue to spike as Russia's invasion of Ukraine puts a massive portion of the world's fertilizer supply at risk, given that Russia is one of the largest global exporters of fertilizers and accounts for 20% of the global output. So Russia is now urging its producers to actually reduce export of fertilizers, and all of this increases fears of such shortages. In view of all these, you can see that this fertilizer price index has shot up to a record high. And fertilizers, because of the fact that they are key to keeping things such as corn, soy, wheat, as well as rice yields high, this fertilizer crisis is in some respects very worrying because it could inhibit global food production. And what this means is that it will lead to higher food price inflation. And at the backdrop of whatever is happening within the whole commodity sector is none other than that of this rising inflation. So within these next few slides, I can see that inflation has risen to one of the highest levels in a generation. So just recently, it was announced that the US consumer prices have actually risen by about 8.3% in April compared to just a year earlier. So combined together, we think that this rising inflation as well as these geopolitical tensions, they have no doubt created a commodity supercycle. And in a high inflationary environment, we find the case that commodities, they typically will outperform other asset classes. So there's a strong 10-year correlation of 0.73 between the year-over-year growth of the Bloomberg Commodities Index as well as the US CPI year-over-year growth. So this highlights the effectiveness of commodities as an inflation hedge. So given that Russia's role as a commodity superstore, this economic impact of the crisis would mean that global commodity prices will continue to rise. So they're likely to remain elevated also, and this serves to mean that our commodities-related equities could actually serve as a rather decent hedge for one's portfolio. So with all that's being said, I think the next question to ask oneself is, how should I go about investing in commodities? So in the interest of time, I'll be sharing about how one can benefit from rising agriculture commodity prices by investing in the agribusiness sector. And my colleague Cyrus, who also happens to be the next presenter after me, will be coming in with a presentation on metals later, coupled with some ideas on how to play on this metals boom. So please check out his presentation if you are interested to find out more about this metal space. So in essence, investors can actually gain exposure to this whole agribusiness sector via the use of this VanEck Agribusiness ETF. So this ETF is known as Moonshot. In essence, it's one of the largest as well as the most liquid pure equity underlying ETF that provides one with exposure to the global agriculture space in a diversified manner. So it does so, in essence, by investing in companies that are involved in the farm equipment, seed and fertilizer and animal health industries. And the ETF comes at an expense ratio of 0.52%. So this ETF, Moon for instance, has actually benefited from this fertilizer boom, which I was just sharing about earlier. So the ETF as a whole has exposure to fertilizer companies such as Nutren, as well as the Mosaic Company and CF Industries. And these three companies are also the largest sellers of potash, phosphate, as well as nitrogen fertilizers respectively. And together, they make up about 14% of Moon's overall holdings. So this high demand for crop nutrients and this limited supply have boosted the profit margins for these fertilizer companies. And we think that this agribusiness industry presents an area of opportunity. So you can see that these agriculture prices, they're likely to extend their climb, especially in 2022, given what we're seeing within the current demand-supply dynamics. And with the food prices rising higher, the companies that support the food production, they would naturally benefit as rising prices lead to increased production. So this higher production will then translate into increased spending on seed, fertilizers, as well as farm machinery. And they'll benefit companies higher up this agribusiness supply chain. So in the next slide, as the war disrupts this whole global food supply, we think that it brings to the forefront the issue of food security. And again, it exposes this critical nature of the agribusiness sector. And beyond this, we do also want to note that there are secular trends that make this agribusiness industry one that has incredibly promising long-term prospects. And one of the most compelling trends that are driving these growth is no doubt an increasing global population. With a global population expected to reach about 9.8 billion by 2050, there's actually a pressing need to figure out how to increase our food supply. Another secular trend that is driving the growth of this whole agribusiness sector is that of income growth. So as one enters the middle class, it typically correlates with higher consumption of animal-based foods, and these are more resource-intensive to produce. So in order to feed this larger, richer, as well as more urban population, food production actually has to increase by 70% by 2035. And so we think that these agriculture companies, as well as the commodities, they present an exciting opportunity for investors out there. And with this, I actually come to the end of my presentation. So I hope you have enjoyed the presentation, and I hope to see you again.
Thank you, Chloe. We are moving towards a more sustainable future enabled by green technologies. Rare earth and strategic metals are an attractive play due to their importance in developing both emerging and established green technologies. We also expect governments to pivot towards greater self-reliance for these metals as they are critical to the development of many advanced technologies. Here to share more about how to tap into this opportunity is Cyrus Ng, Research Analyst from Research and Portfolio Management at IFA Singapore. Let's welcome Cyrus.
Thank you, Gladys. Good afternoon to everyone, and thank you very much once again for joining us at ETFestival 2022. My colleague Chloe has talked about the ongoing commodities supercycle and highlighted an agribusiness-themed ETF. Today, I will be talking about a metals ETF focusing on the rare earth and strategic metals industry. We believe that this ETF can not only leverage this commodity supercycle, but also benefit as we as a world move towards a greener and more sustainable future. Let us first look at rare earth metals or rare earths. Rare earth metals are a group of 17 metals with relatively similar chemical properties and are generally considered to be rare due to the high cost involved in extracting them. On the supply side, China is a clear market leader across the entire supply chain. As you can see from the pie chart on the left, China has one of the world's largest rare earth reserves, and they have leveraged these large reserves to build up the necessary supply chain knowledge and expertise over the past few decades. As a result, today, they account for majority of the world's rare earth production, as you can see from the chart on the right. And even more, the International Energy Agency, or IEA, estimates that they have about an 80 to 90% market share in rare earth refining. On the demand side, key end users of rare earths include magnets, glass, and catalysts, as you can see from the chart on the left. These three end users accounted for about 65% of end-use demand in 2019, and analysts generally expect this 65% figure to hold all the way up to about 2025. As a result, we generally expect about a 5 to 10% growth in demand for rare earths by 2025 as well. Moving on to strategic metals. These are a group of important metals as well, except they do not strictly fall under the rare earth classification. Common examples include lithium and cobalt, though for today's presentation, we will focus on lithium specifically, due to its large representation in the ETF we are considering. On the supply side, lithium production is dominated by Australia, which has actually significantly increased its market share in the past 10 years to over 50%. And as for the demand side, looking at a chart on the right, you can see that it is mainly driven by batteries, which account for about 75% or 3/4 of end-use demand. As electric vehicles or EVs become increasingly popular around the world, we also generally expect a lithium market to grow by about 10 to 20% over the next 5 years. We believe that any structural increase in rare earth and strategic metals will support margins and earnings for their related mining companies. And therefore, now we look at some positive drivers that could support the prices of rare earth metals as well as that of rare earth mining companies. First, we are bullish on rare earth and strategic metals, or RESMs, as we believe the push towards emerging green technologies will fuel strong long-term demand for RESMs. For example, electric and hybrid vehicles require batteries which use RESMs, such as the nickel metal hydride battery, which uses a lanthanum-based alloy, or the newer lithium-ion battery, which not only uses lithium, but also other strategic metals like manganese and cobalt as well. It is clear that EVs are becoming increasingly popular around the world, and you can see from the line chart on the right that the proportion of EV sales relative to global auto sales has spiked up tremendously in the past few years. As a result, we expect demand for RESMs to correspondingly increase alongside demand for EVs and EV batteries. Next, these rare earth and strategic metals, or RESMs, are also used in renewable energy production. For example, wind turbines use rare earth magnets such as praseodymium and neodymium, as they can generate strong magnetic fields at a greater efficiency. Another example of renewable energy use is in solar panels, which typically use compound semiconductors such as gallium and indium. While renewable energy right now only accounts for a small proportion of our total energy share, we expect this renewable energy share to increase rapidly over the coming decades, boosting demand for the metals we have just highlighted. Next, So overall, IEA generally expects RESM demand to increase rapidly as a direct result of these green technologies. Based on their set of plausible scenarios, they expect rare earth demand to increase by about 3 to 7 times between 2020 and 2040, which is a compounded annual growth rate of about 6 to 10%. As for lithium, IEA expects lithium demand to grow by about 13 to 51 times between 2020 and 2040, and that is a compounded annual growth rate of about 14 to 22%. As such, to summarize, we believe the structural growth story of RESMs and their related mining companies remains very positive due to their usage in multiple green technologies. Apart from emerging green technologies, we note that traditional technologies can also serve as a backbone for steady demand, at least in the near to medium term. One example is the catalytic converter, which has been legally mandated in pretty much every traditional car since the 1970s, as they help to convert toxic emissions into less toxic byproducts. While the world is slowly moving towards electric vehicles and greener forms of transportation, we do expect demand for traditional vehicles to at least remain strong in the nearer to medium term due to their affordability, as well as the fact that we have had some pent-up demand during this pandemic. RESMs are also used in our everyday electronics, so if you brought along a smartphone, let us quickly examine it together. So the front of our smartphone contains a screen, which is actually composed of two components, our touch screen as well as the normal glass screen. So the touch screen contains rare earth metals like indium, while the glass screen generally contains rare earth phosphors like yttrium. Moving on to the side of your phone, the sound system of our smartphones use rare earth magnets like neodymium and praseodymium. And looking at the back of our phones, the cameras on our phones, on our laptop webcams, on our cameras, the lenses of our cameras use lanthanum. And finally, on the inside of our phones, we can see that the semiconductors in our phone use gallium, and the batteries in our phone use lithium as part of the lithium-ion batteries. So this short exercise in looking at our phones shows that even though we may not be as aware of the usage in daily lives, they're actually very ubiquitous and prevalent. And we believe that as we use more and more electronics in our digitizing world, RESM demand should increase over time. In summary, RESMs are critical for established technologies we use every day, like our smartphones, laptops, transportation, which can contribute to some steady growth in RESM demand. And coupled with the strong growth arising from green technologies, from renewable energies, we believe that the overall demand outlook for RESMs remains very positive. We are not the only ones who believe in this positive outlook for RESM demand. We realize that governments themselves are also acknowledging their importance in the 21st century and will focus increasingly on self-reliance across the entire supply chain. So as we mentioned at the start of the presentation, China is a clear market leader in rare earth production, while Australia is the key market leader in lithium production. This shows that the production of rare earth and strategic metals is actually relatively concentrated. China had more than 50% production, and Australia had more than 50% production in lithium as well. In contrast, if you compare it to traditional metals like copper, if you see the chart on the right, you can see from this chart that there are actually many countries supplying copper. And that means that any country, such as maybe Singapore or anyone who wants to buy copper, has a wide variety of trade partners to choose from when they are demanding copper. Because production of RESMs is so concentrated relative to traditional metals like copper, we expect governments to implement supportive policy measures towards the domestic mining companies that specialize in rare earth and strategic metal production. For example, previous US administrations have issued executive orders that have provided loans, grants, other financial incentives to support domestic companies like MP Materials. And same for Australia. Australia is a key producer of lithium and many other mining commodities, and they themselves have published a critical minerals report and also issued grants and loans to domestic companies for an example of which is a loan, $1.25 billion Aussie dollar loan to Iluka Resources just last month. Another factor is the recent Russia-Ukraine war. And we think the Russia-Ukraine war will further accelerate this race towards self-reliance. We need to note that China, as a dominant producer of rare earths, had actually previously imposed an embargo on Japan in 2010 and threatened to cut off rare earth exports to US in 2019 following some geopolitical tensions. As this ongoing war has exposed Europe's over-reliance on Russian energy, we think that individual governments will take even greater steps towards building supply chain self-reliance for these rare earth and strategic metals. As such, we expect existing mining companies to greatly benefit through increased financial incentives, again through loans and grants from the government. Next up, we note that there are multiple catalysts that could drive demand for rare earth and strategic metals and support earnings for the related mining companies. As such, investors such as yourself may want to consider the Van Eck Rare Earth Strategic Metals ETF, or REMX. This is a passive ETF with 20 holdings listed on the New York Stock Exchange and offers a broad equity exposure to important rare earth and strategic metals. Looking at the listing countries of its constituents, this ETF is concentrated in Australia and China, which should not come as a surprise given what we have mentioned about Australia being the leading producer of lithium and China being the leading producer of rare earths. Its top 10 holdings are also well-established names in their respective industries and cover a good mix of rare earths as well as different strategic metals. Therefore, to summarize, we believe that rare earth and strategic metals look to see strong growth ahead driven by emerging and established technologies, as well as supportive government policies like loans and grants. Investors can consider the Van Eck Rare Earth Strategic Metals ETF, or REMX, which offers a broad exposure into different critical metals and rare earth metals. Using a fair PE ratio of 20 times, we project a target price of about $165 for REMX, giving an upside potential of over 90% by end 2024. Thank you very much for listening to my presentation. I'd like to wish everyone a great day ahead and hope you enjoy the rest of ETFestival 2022.
Thank you, Cyrus. Up next, we have Calvin Yeo, ETF Business Development Director from Nikko Asset Management. He will share with us key macro developments impacting the Nikko AM, Straits Trading, MSCI, China Electric Vehicles, and Future Mobility ETF, and discuss what they see to be potential tailwinds for the sector. Let's welcome Calvin.
Yes, thank you everyone, and good afternoon. I think you had a long day, so just a few more sessions to go. Calvin here, very good to speak to you. So I think, thank you for the introduction. No need to self-introduce myself again. And before I start my 15-minute presentation, maybe just a quick survey. Year to date, for the people here, how many has lost money in your investments? Let's have a show of hands. Come, don't be shy. All right, I would see that it's easily 70% or more, including myself. Right. Now, why do I say myself? The reason is because it's really related to the ETF that I'm talking about, which is the one here. Is it showing on the screen? Yep. There's a bit of a lag every time I press the button. So this is the ETF that Nikko Asset Management we launched on 20th of January this year. It basically is an ETF that tracks the China Electric Vehicles and Future Mobility ETF. So this ETF gives you exposure to a tech sector, mainly electric vehicles. It's down about 30%. We launched it at $1 Sing in terms of the trading price. Today it's just about 60 plus cents. Now, I think what I want to share with you today is really to help you understand, right, why the price is down, for you to think about it, and for you to gauge the opportunity, whether or not, where you can kind of find the bottom and where this ETF makes sense again. There are three key reasons, in my view, why the ETF has sold down about 30%, and I'll run you through that. The first is really quantitative tightening. initiated by the US Fed. The second is essentially second-order effects coming out from the Ukraine-Russia crisis. I think you heard more than enough of that. I'll touch a little bit about that later on. And the third is really the lockdown in China, right? 3 key reasons. So I tried to give, put it into a graphical representation. So like I said, there's always a lag in terms of, So this is a graphical representation of the year-to-date returns of all the 50 companies, which is within the index that the ETF tracks, right? So on the left side are the biggest companies by index weight, all the way to the right side, those are the small companies. Now this is taken in year-to-date as of end February, essentially the first 2 months of this year. So what happened then is that you can see, in the first 2 months of this year, things are looking quite okay. Things were looking quite okay. And as we kind of entered into the new year, what the market was really worried about was the interest rate hike by the Fed. They kind of, they officially communicated that into the marketplace sometime in late December 2021, right? The market was already aware of it. I think everybody has heard about this for like more than a year. And it is priced in as of February this year. And you can see the weakness is really concentrated here in the large caps, right? Large caps. Large caps were selling off in my ETF. And of course, there were pockets of some companies here that saw negative returns as well, but it was okay. So what happened after that? Now, this chart here shows year-to-date returns of the same 50 companies in the exact same order by April. Right? That was 2 months after Russia decided to conduct its special operations in Ukraine. And everything went negative. Now, the reason why I wanted to show this is because there is a difference between what the market is trying to price in based on the returns that you see. This chart, the difference between this chart and the chart that you saw earlier on is essentially the market trying to price in macro factors, and they are worried about what is happening in the Ukraine crisis. And it is market-wide. It is a systematic sell-off. Everything else in the market was selling off. If you look at global equities over the same period, it was down about 20%. If you look at the broader market, China equities, it was also down about 20%. So everything was selling off. I think we need to be very cognizant of this fact. So if we come to China itself, the third reason why there's a sell-off in the China electric vehicle and future mobility sector is COVID. And of course, we all know there is a COVID lockdown. So since March, cases started to ramp up again. And of course, there's a lockdown. But what's important here is that the lockdown does have a positive impact. You can see here, the number of cases are starting to come down ever since the Beijing government started to clamp down everything. So things are improving. But the catch here, the irony here is that the Chinese regulators need to lock down the country in order to control the spreads. And the reason is very simple. Why do they need to have a zero COVID policy? It's because their guys are not vaccinated. Vaccination rates in China is very low. And it is very difficult to vaccinate. No matter 1 billion people, it's just very, very difficult, and it's very costly and very difficult to administer. So China will continue to have this problem going forward until they kind of resolve what they want to do with their zero COVID policy. It will continue. But it will continue in a very interesting way. It will continue in waves. There was actually a mini wave in January 2020. Most of you didn't really realize that. The Chinese regulators were very quick to clamp down. And actually, because of that, the Chinese economy post-COVID was among the first countries in Asia to actually recover. It was very effective then. But of course now, now the market is starting to worry that it's not so effective anymore. But that said, now that they are kind of controlling the situation, it will get better. But once they open up the economy again, there will always be that risk where cases will start spiking again. And with that risk, China equities might come down again. So I just want to put everything in perspective. So of course, how does it relate to the China EVFM sector? I think the impact is quite well reported in mainstream media. So you can read about it. In terms of number of EV car sales, April is a watershed. It'll be bad. Numbers are down about, numbers in terms of car deliveries, EV car deliveries will be down about 50% sequentially. And year on year, it will slow down. And you can kind of expect that in May, things might be similar. So there will be a period of weakness. But that said, we do think that the sector will start to, specific to the COVID situation, things are priced in. And this situation is probably a little bit transitionary. Okay, so coming back to a little bit of a positive note, right? Despite all the three main reasons why the market is selling off, investors are worried, down 20-30%. Why do we still think today that the China electric vehicle and the future mobility sector is promising? And there are really just four very simple reasons. The first is government intervention and policy support. I don't have to repeat too much about this, but essentially we all know that whatever the Chinese government wants to do, they try their best, right? Their track record has been pretty good, but they try their best to make it happen, so execution. Number two is demand, right? So the Chinese market is China car market is very large, about 300 million cars, as large as the US market, if you're not aware, right? And they are going to be essentially be selling EVs into this existing marketplace. And I'll come to the details later on. Number three is supply. China, being China, has vast and deep manufacturing capabilities. It has the manufacturing base to grow an industry. And number four, really, although the name is China EV and future mobility, it's not just a car. When investors invest in this sector, they are investing in a long-term theme, and that long-term theme is future mobility. And what is future mobility? For the index that the ETF tracks, it is essentially exposure into four themes, right? The four themes are listed here. First one is batteries. Second one is smart mobility, sharing economy, high-speed transport, which is quite unique to China. And then the fifth one is vehicle automation. With each trend, it splits into individual value chains, right? And you can kind of see all the chains there. I won't go into the details. But the key thing here that I want to mention is that in designing the ETF, we wanted to capture investment opportunities, as you see here in the slide, over time. And I use the word over time. It takes time for this sector to play out. Using Singapore as an example, we want to sell EVs into the market. Even the LTA, our own regulators have a 5 to 10 year view. It takes time, but it will grow. So if I kind of move on to the next slide here, again on China, I just want to kind of mention that China is already a leader in the EV market. You can see here that over the past 5-6 years, number of EV cars in China, in terms of number of unit sales, have been growing exponentially. And they have always been leading other major economies, right? As of today, China accounts for 1 in every 2 EV cars that are being sold globally, right? And they basically they're also the largest battery manufacturer, EV battery manufacturer globally, accounting for about 70% of global EV battery market share. So they're very big. Coupled with the fact that they have government support, 2 very important policies that came out in 2020, the year 2020, 2 policies, which I feel is very important. The first is the 14th Five-Year Plan. It states that EV cars, will be a strategic emerging industry in China for the next 10 years. That's the first thing. The second thing is the State Council Blueprint, which was also issued in 2020, which states that they want to make sure that EV car sales accounts for about 25% of all passenger car sales in China by 2025. So that's about in 3 years' time. In fact, they are already kind of going over that. They're already achieving that limit. And I would also say that China is interesting because their leadership in this space is something that other major economies really want as well. Be it the US, UK, or even Europe, everyone is trying to set up policies in order to grow this industry. This is a strategic industry. It will add jobs, it will add technology, and it will grow industries. So very important. And I'll just say the last thing is that the penetration rate of EVs within the car market today, globally, is very low. It's about 5 to 10%, which means that it has a very long runway to grow. And that's quite important for any new technology to kind of permeate through the marketplace. So kind of looking beyond the immediate, depressing market, sentiment or whatsoever, we have actually seen very good growth in terms of momentum, in terms of EV sales in China, when we kind of look back. On this chart here, you would see the number of actual EV car unit sales, kind of going back all the way to 2016. So I won't go into the details. I will explain. The blue color are just battery EV cars, and the yellow color are just plug-in hybrids. So total number of unit sales. What's interesting here is that since the start of 2020, the growth rates have gone exponential. In case you can't read this chart very well, the green line shows year-on-year growth. As of the first quarter this year, it was growing at about 100% a year, over 100% a year. Now, the significance of this, barring the immediate market pressures, is that when they issue the directive and when they issue the policy, there is market adoption and there is market acceptance. People do buy. Okay, so it's a market that EV cars can grow in. Now, one good thing resulting from a depressed market as well is that, as prices come down, your valuations also get cheaper. It's a very, very simple concept. Even if you go to an institutional seminar, the analysts will say the same thing. Valuations are very important when it comes to investing in equities, and valuations are coming down for the China EVFM sector. Looking at this specific index that the ETF tracks, the forward price earning ratio, 1 year forward from now around there, is about 35 times. If you kind of look 2 years out, it's going to be about 25 times, which is not demanding, right? Coupled with the fact that the average sell-side analyst is forecasting about 50% year-on-year earnings growth every year for the next 2 years, there is good earnings support to kind of hold up these valuations. Now, if you're thinking whether or not valuations will come down even more, and there is always that possibility, is that one thing for sure, personally speaking, it's not going to go back to 2018 levels of 15 or 20 times. Unlikely. The reason is because you're in a different regime. Back then, there was no policy directive. Today, there is. But what do I mean by today? Today means start of 2020, right? When the direction is being set. So as long as the policy is firm, policy is clear, I think at a very loosely speaking, valuations should find some support at some point. So kind of going down to the last slide that I have, I just want to kind of make a point that although I think through the day, you might have heard a lot about how the various analysts sharing some stock ideas and everything, I want to mention that when you invest in an ETF, being an ETF business development person, when you invest in an ETF, you are really trying to gain exposure to a basket of companies. It's really not about taking a take on a specific company, although that also works. And it's important to understand that by investing across a basket of companies, every company will be different, trying to play its role within the sector. Specific to the EVFM ETF that we have, there are 50 companies in there, each one doing something different. But the point here is when you invest in it, you're trying to gain exposure into the activity throughout the whole sector. So I just use some examples just to show you how different the companies can be. 3 companies out of the 50 here. One is Ganfeng Lithium. They are one of the largest lithium mining companies in the world. Leadership position in China, has got good prospects for structural growth, right? So they are essentially a commodity producer. Second one, Yunnan Energy. Yunnan Energy is an EV battery component manufacturer. I think they are pretty good at making separators. Separators is essentially the material between the anode and the cathode of a battery. It allows the electrons to pass through. So that's important, right? And they have aggressive plans, planning to capture about 50% of the global market by 2025. And you have the third company, maybe called Eve, also a very aggressive company, but aggressive in terms of expanding their capacity because they manufacture EV batteries as well as ESS, energy storage systems, essentially commercial type EV batteries. So, and different types, and you have other companies in the ETF as well. For example, companies that do telemetrics. Electric vehicles are essentially electrified vehicles. And there is a need for all the different components and devices to talk to each other. So telemetry is also a growing field. So many different types of companies. When you buy an ETF, you gain exposure to the overall sector growth over time. So I think with this, I just want to kind of, hopefully you have good takeaways. You get a sense of the development in the China EVFM market today. Hopefully that gives you comfort, despite that 20-30% sell-off in in the price. It happens everywhere right now. And hopefully, last takeaway from me is probably a reminder that yes, China EVFM is down year to date, but it is not out. Thank you very much.
Thank you, Calvin. If you have questions regarding this presentation or anything else regarding related to Nikko Asset Management, head over to Stage B, where they will be online shortly to answer your questions directly. Our next speaker, Edward Pai from UOB Asset Management, will be sharing with us about a unique investment opportunity. Asia Pacific continues to lead the world in economic growth, with real estate as a key sector. With the increasing demand for sustainable buildings and practices, there is an expected increase in rent and capital gains for green buildings. Please welcome Edward as he shares about how we can invest smartly for profit, purpose, and a sustainable future in the real estate sector with UOB APAC Green REIT ETF. Edward, please.
Thank you. Okay, welcome. Good afternoon, everyone. So once again, I'm Edward from the UOB Asset Management. I would like to say my greetings to the online audiences as well. So today I'll be talking about one of the favorite asset class that Singaporeans really love. It's about REITs. So in the next 15 minutes or so, I'll be actually articulating the case of why APAC REITs, and of course the greening of it, as well as the investment opportunity for all of us for a sustainable future. Yep. So these are the key features of our UOB APAC Green REIT ETF, the world's first APAC Green Real Estate Investment Trust ETF. The index that we are tracking is actually developed by SGX as part of the SGX IH product suite in collaboration with UOBAM. We aims to contribute to the greening of the real estate sector with a focus on Asia Pacific. We also have an initial seeding from our parent company UOB, and we aims for a quarterly distribution of 4% per annum, and of course creating the positive green impact for the world, right? So I think why the case for REITs as well as sustainable REITs. Sorry. The slides are not coming up. Okay, great. Sorry. Okay, I think everyone actually know what REITs are, collective investment vehicles where your money is actually put together with other investors to invest in professionally managed real estate assets. All right, and of course what I want to actually highlight is REITs can definitely be a good addition to your typical stock and bond portfolio because they actually aims to provide stable income as well as long-term capital appreciation, and of course the underlying assets actually provide steady rental stream and which flows through to investors as regular income distributions as well. So next slide. Yep. Okay, great. So why Asia Pacific? Because our strategy actually focus a lot on Asia Pacific. Now, if you look in terms of a demographic, right? I think Asia Pacific is home to 4.4 billion people. Now, that's about 57% of the global population. And if you look at the United Nations Department of Economic Social Affairs report, it is actually reported that, by 2030, the urban population in Asia will actually cross, 2.5 billion. And by 2050, it will actually move up the scale to 3 billion. So what does that, all actually translate to? Now, if you look in terms of, the urban, when we talk about urban areas, right, is actually generally associated with, greater productivity due to agglomerations of economies, as well as, there are more opportunities in terms of employment, as well as a greater quality of life in urban areas, in a higher education. Now, with the rise in urban population, we are definitely seeing a trend of growth, in working age adults across Asia Pacific. Now, Cushman and Wakefield, they are actually global commercial real estate service firm, is actually projecting that this growth in working age adults actually translate to a demand in an additional 1.35 billion square feet of office, across Asia Pacific region. Now that is needless to say, APAC real estate is definitely set to grow rapidly, and that is true for now. It is actually growing at a tremendous pace. So if you look, now we have actually covered the demographic aspect, and if we switch our lens to the investment opportunity and we couple with it, I think it's even a more appealing case, right? Now, if you compare the Asia Pacific REITs compared to the broader Asia Pacific equity markets, in the long term, it actually outperformed the broader equity markets with a return of 7.8% compared to about 5% for the MSCI Asia Pacific. And not only that, in terms of yields, Asia Pacific generally generate higher absolute relative yields compared to equities, as well as also compared to the government bonds. So the next will be that, in terms of dividend regulation, I think most of y'all have known, is required by law to actually distribute at least 90% of the taxable incomes and earned from the real estate investment directly to investors through dividend distribution. Now you have your friendly taxation rules, you have steady dividend incomes, long-term capital appreciation, and that has actually allowed REITs to deliver competitive total return historically, as shown in the previous slide. And that is, of course, these are the good benefits and the advantages, but another one thing is also the diversification purpose. They have their comparatively low correlation with major asset classes, especially the broader equity markets, and it's another compelling reason for investors who are actually to give consideration when constructing one's portfolio. Now, I think in everyone's mind today, I think all the speakers have actually talked about it. I think the biggest concern is that the rise in the interest rate. Now, will it actually affect the REITs market? Now, REITs is typically priced for its yields, and of course, it's a defensive asset class, so it will potentially become less attractive when interest rate rises. But however, this doesn't mean that you should actually avoid investing in REITs in the rising interest rate environment. So by right, in reality, rising interest rate typically means that the economy is actually improving. So it actually allows them to grow occupancy rates, build new properties, hike rents, and this actually improve the revenue and cash flows for the REITs. So there's a very good positive impact of strong economies, which outweighs the negative repercussion of higher interest rate as well. And of course, we do expect interest rate to rise as central banks around the world will start to taper. But the good news is that we are actually potentially entering a really sweet spot where the forecasted to see a gradual rise in interest rate, but not too much. And as long as it's in this gradual manner, what we feel is that REITs are poised to enjoy optimal benefits in an inflationary environment through rental growth and capital appreciation. Yeah. So when we look in terms of the current macro environment still remains conducive for REITs. Now, in terms of the valuation standpoint, I think it's really still decent, and the yield spread basis is not at overstretched levels. Now, the yield spread is typically slightly below the mean now, but I think the current trend that you're seeing is actually quite similar to the one that we have seen in the past cycle. So we do expect this yield spread trend to actually narrow further, but there's a room for capital appreciation as well. And definitely the hunt for yields will continue as we are still in a rather low interest rate environment. So generally, the APAC REITs dividends, yields are about 4 to 5% on average. The dividends are expected to continue to grow at a robust pace of 5.2%. And today, at the post-COVID arena, we are also seeing an uptick in the M&A activities. Now that's going to be really attractive to drive the growth as well. And also with the borders and countries reopening, we are expected to see recovery in trade, travel, and tourism, which really will be beneficial for the APAC REITs region. Now, of course, the pandemic, though, is actually really, devastating and all, but it's like definitely a wake-up call for all of us, for environmental and social responsibility. Now, if you look at today, the today weather is really hot. We have news coming out that, we reached one of the highest at about 36.8 degrees in Straits Times paper, I think, in yesterday. We are definitely feeling the whole climate change. And, and that is actually moving tremendous ground in terms of sustainability. Governments, they are categorizing the adoption of sustainability practices. And major corporates throughout the world, are reassessing the businesses' strategies to meet their sustainable targets or goal. And the world is waking up to the investment opportunity that this brings. And definitely, it is nothing new to the REITs sector as well. So there was a survey done by a JLL, another global commercial real estate service company. And these are some of the key findings. 7 in 10 occupiers are now willing to pay a rental premium to lease green buildings. The adoption of net zero carbon emission is set to double in Asia Pacific by 2025. And of course, the green certification of buildings drive, firstly, higher occupancy, higher rents, higher tenant retention, and overall higher value to the assets, which is definitely the buildings, right? So when we talk about ESG, great. So in many ways, if you look at over here, ESG is not really a new concept for REITs, but it has now increasingly, become important in the recent year. So what we observe is REITs nowadays have doubled their focus on ESG issues, such as improving the energy consumption, water efficiency, waste management, and also on the social and the governance sector expert as well in terms of, employee turnover, improvement of your health, and the list goes on. So if you have come to realize sustainable or green REITs are made out of more than just green building itself. But no doubt, when you talk about REITs, the centerpiece of what makes a REIT is still a building. So what is green building? I think green buildings basically aims to reduce or eliminate negative impacts on the environmental and climate changes. And of course, there are many definitions of green building, and it may actually vary. But if you can see from these IFC reports, green buildings are not just a low risk asset, but able to provide higher value too. So like I mentioned before, they offer both economic, financial benefits as well as intangible benefits in the sense of, good health, better employee management as well. Yep. So when we talk about the opportunities, right, one thing that you have to remember is that buildings and construction account for 39% of global CO2 emission. Now, to make things worse, global building stock is also expected to, double in area by 2060. Now, that's going to cause an increase in carbon emission occurring right now. So there is an increasing pressure for real estate, to be green, and that, in fact, in return, actually create a USD 17.8 trillion investment opportunities in green buildings by 2030 in the Asia Pacific region. Now, it is the highest among the rest of the geographical areas. So we have definitely a few reasons of why APAC REITs is attractive. So so we see over here higher return versus Asia Pacific equities. You have your attractive yields, and in terms of green REITs, because sustainability is the mainstream now, right? And not only that, the mindset of the occupiers are different. They're willing to pay for green buildings, and green buildings in general create investment opportunities in Asia Pacific. So that is why we have this UOB APAC Green REIT ETF. So what is it all about? Let me just give you a brief explanation. So this ETF tracks the IH UOB APAC Yield Focus Green REITs Index, and the index is actually comprised of a basket of 50 REITs which deliver high dividend yield to investors by investing in of course, what I've mentioned, Asia Pacific, including Japan, and of course focus on green REITs which are identified via high ESG quality. Now, the ESG quality is based by GRESB Real Estate Assessment. So what is GRESB? Who is GRESB? So Yeah, so GRESB is a mission-driven as well as an investor-led organization providing standardized and validated ESG or environmental, social, and governance data to the capital markets. They are established in 2009, and they has actually become the world-leading ESG benchmark of real estates and infrastructure investment across the world. So the index itself is actually optimized for improve in the risk-adjusted performance via three filtration process. When the slides come up, you can actually see it. Yep. Sorry, I think there's a delay in okay, there you go. So so these are the three different filtration process. You have the dividend yield trap, which which actually choose REITs that actually meet the liquidity requirement that are passed through this filter. Now, this is to actually avoid investing in any poor quality REITs. And secondly, thereafter, they are further segregated and ranked based on market capitalization. And lastly, green tilting. This is what we do. We actually reward REITs that are greener, right, using the GRESB environmental score. So the next will be looking into some of the returns compared to the green REITs index that we actually track compared to the non-green REITs ETF that we have in the market. Generally, a lot of people think that, by investing in green, does it actually affect performance? I think the answer is not really. If you look at the both 3 years and 1 year, they are really quite decent. But of course, you have to bear in mind that the market condition right now is being affected as well. Yep. So there you go. So we have both, the next slide, I will also show you how it has been performing versus major asset classes. So you have the our ETF compared to the MSCI Asia Pacific equity, as well as the bond asset class, as well as the global equity market. And if you can see, right, it's actually quite resilient given that we have seen so much turmoil and volatility in the market for this year itself. So I think it actually proved that having this green tilting, it actually proved in the terms of the resiliency as well as in the long term. I think you definitely have that opportunity for profit. So how about, we have talked so much about profit. What about the purpose, right? So we have this green impact measurement dashboard where we actually have 4 scopes that we measure. We measure the greenhouse gas emission, water consumption, energy consumption, as well as, how many green building certification we have in these whole REITs ETF. So just to put it in the layman terms, the 2% improvement in the greenhouse gas emission is actually equivalent to reducing greenhouse gas emission from 400 homes energy use for 1 year. And of course, the 8% lower of water consumption means that you are saving water which can fill at least 37 Olympic-sized swimming pools. So this is how we actually measure the green impact. Now with that, with all the optimization as well as the screening and scoring components, especially on the ESG part, we are able to deliver both the profit together with purpose. Now this is the sector allocation breakdown, and as I've mentioned, is focused on Asia Pacific region. That's why you have the country allocation in terms of Japan, Australia, Singapore, and Hong Kong. So coming closer to the end of my presentation, these are some of the these are the top 10 constituents that we have in our ETF. So one thing is that I just want you to know, I'm not going to go through all, but these are the REITs that have a very solid sustainability plan to reach some of these sustainable goals, for themselves plan. They have a very detailed disclosure plan as well. So let's say for Dexus One, right, where, they actually manage and create high quality workplace across the office, industrial, retail, and healthcare. In terms of their sustainability aspect, they are actually committed to achieve net zero emission by this year itself. So in one of the sustainable projects that they actually run is that in May 2020, they actually completed one of Australia's largest car park solar projects at Willow Shopping Centre, and that project actually includes, I think, about 4,800 solar PV panels that actually generate approximately 2,500 megawatts per annum, which is equivalent to the usage of 370 Queensland's household. So they each and individual have their own kind of plans to work towards their sustainability goal, and they are really amazing. So with that, I think these are some of the information that we have for the REITs ETF, Green REITs ETF, and that I would actually like to summarize my presentation, rather quick one. So what is it? This is actually the first APAC Green REITs solution that in the world, and then secondly, why I think sustainability or green REITs are an emerging trend, but I wouldn't say it's emerging, it's actually already in the mainstream, right? We got to do something for a sustainable future, and definitely is an opportunity for profit and purpose. So I think let's all of us, work together for forging a sustainable future for ourselves as well as the younger generation. Thank you so much.
Thank you, Edward. If you have more questions for UOB Asset Management, head over to Stage B where they will be online shortly to answer your questions directly. Just before I introduce the last speaking segment for today, I'd like to remind everyone who is here in this hall that in order to participate in the lucky draw happening later, you have to drop the lucky draw stub found in your event flyer at the FSMOne.com booth located outside. Let's now move on to the Q&A section where we take your top questions for today. Joining us in the Q&A section, we have Wei Ren, De Jun, Ferlin, and Ron. A big round of applause to welcome them up. Joining us in this session, firstly, is Yo Wei Ren, Senior Portfolio Manager of Research and Portfolio Management at IFAS Singapore. Next up, we have Tan De Jun, Assistant Manager, Research and Portfolio Management at IFAS Singapore. And Ferlin Tan, Senior Research Analyst, Research and Portfolio Management at IFAS Singapore. Moderating this session will be Ron Ng from the Investment Advisory at FSMOne Singapore. Over to you, Ron.
Right, thank you. So on a day-to-day basis, right, the FSM Investment Advisory team, we actually get a lot of questions regarding markets and also individual ETFs or unit trust products. So other than today, we have gathered some of the most frequently asked questions, especially in current market conditions, and we are fortunate enough to relay it to our research analysts. So maybe the first one, that something close to Singapore will be the outlook for STI. I'm sure a lot of us will be interested in that. So, De Jun, would you like to address this question?
Okay. Good afternoon, everyone. Right. So the outlook for STI. I think first of all, let's take a look at the performance for the STI index over the year-to-date period. I think STI. Like it was mentioned in the panel discussion in the morning, I think STI the Singapore equity market is actually one of the few markets that are that have positive performance year to date. I think that one of the reasons is really because of the composition of the STI and how that composition has actually allowed the STI to do well in the current environment where interest rates are rising. So inside the STI, obviously the major sectors are the banks, which make up around 40 to 50%, followed by your real estate, your REITs, which make up about 20%. So both of these sectors, they actually thrive in an environment where interest rates rise and there's higher than expected inflation. So for the banks, naturally, when interest rates rise, they can loan out money at higher rates compared to their cost of funding, which is the deposits that we as consumers put into the bank. And as for the REITs, they tend to enjoy positive rental reversions as rents and property prices rise, which gives them better performance. And I think given that if we expect interest rates to continue rising over the next few quarters, then I think the STI should continue to do well because it's mainly driven by these two sectors. And even though, the STI, because it has such a natural value tilt, and so despite mentioning the good things about the STI, I think it's also important to give you guys some talk a little bit about the negatives about investing in the STI. So things that you should be wary about is First of all, for the REITs, right? Although most of the REITs inside the STI index, they are considered your blue chip REITs, the bigger REITs. They tend to have lower cost of funding, and which allows them to sort of avoid this high interest rate environment for the time being. However, if your assumption is that interest rates are going to remain elevated in a couple of years, it's still going to remain high, then these REITs will inevitably be affected, and hence their rental income will also be affected. And on top of that, I think one of the dangers about investing in the STI over the long term using a buy and hold strategy is that because the STI's composition is mainly made up of blue chip companies, there is very little room for significant growth, unlike other markets like the S&P 500 in the US, for instance. So that is one thing that you need to take note of before you invest in the STI. So I'm not saying that the STI is bad and you shouldn't invest in it, but it's rather the timing and how you go about investing in it. So for the STI, I think it's better to go with a tactical approach. And I think now, with inflation still high and interest rates on the rise, I think the STI can actually be an attractive investment idea.
Right, thank you, Tejin. So, I think income is also a very important investment criteria when Singapore investors generally look to invest. And rising interest rates generally will provide better income solutions for investors. So, for the next few years, right? I believe this is the next question. What are some of the sectors or regions which will do well in the next few years because of the rising interest rate? So maybe Ferlin, you'd like to take this question?
Okay, yeah, sure. So I think one of the most obvious answer to this question is really the financials and especially the banks, because like what Tejin just said, the banks, they derive their income from net interest income, and which is dependent on net interest margin. So given how interest rate is on the rise, this net interest margin is expected to expand, which will directly benefit the bank's net interest income. Then the next question would be because right now the Fed is raising rates pretty aggressively, so there were a lot of comments about how this may lead to a recession if it goes a bit too fast. So I want to take this today, take this opportunity to share a little bit insights from the management of the global banks in their first quarter earnings results. So what was interesting that they point out is that so far there isn't any delinquencies that they are seeing across the consumer segment. So that's the first thing I want to share. So they're saying that consumer spending is still strong, and the consumer household balance sheet is still very, very healthy because of the insignificant stimulus checks that was given in COVID last year. So the consumers are now sitting on more than 4 trillion cash. So I think one of the banks also pointed out that they are not seeing any delinquencies yet in the consumers' assets, even in the low to moderate income segment. So another thing is that if you're afraid that the Fed will go a little bit too hard too fast, there might be a recession, which will directly affect the banks because the banks are cyclical in nature. So another thing that almost all the banks have shared during the first quarter earnings result is that they are seeing upside to loan growth because of the increasing capex demand from corporates in almost across all sectors. So this is because over the last few years, I think many of them has pulled back on capex spending for certain reasons, and also they are now increasing capex because to meet consumer the rising consumer demand. So all these are actually pretty good news for the banks because of you have loan growth, you have upside to loan growth, and you also have a expanding net interest margins will also support the bank's income. So I think one sector that we are particularly fond of for at least this year and the next 1 year is really the financials. And this is not shared during today's entire event. So of course, the product that we usually recommend for financials is actually the iShares Global Financials ETF listed in the US with a ticker code IXG. So this is something that y'all can expect from us in the next few weeks. We'll be sharing a bit more about this sector.
I think just to add on also, I think if you look at the performance of regional markets this year, the ones that have really been doing well are those that are your traditionally value-oriented markets, like for example ASEAN. Singapore is definitely one of the best performing markets this year. You've also got Malaysia, Thailand, Indonesia. These are all very resilient markets amidst volatility in global equity markets. And the reason for that is because of their exposure to the value sectors, including what Ferlin has just mentioned, financials. So all these markets, they have been very resilient. And if you expect interest rates to continue going up in the future, then I think ASEAN, that's also something to consider. And also, given our reopening wave in the ASEAN region, China, you've got obviously a lot of downward pressures on the economy, but ASEAN so far, it has been very resilient and holding up very, very resiliently this year amidst all the volatility.
Right. Thank you, Viren. So, and rising interest rates, right? Still remaining on this topic, I think it also impacts commodities and energy prices. So maybe the next question, we can touch on the outlook for energy prices. Is there still room for growth?
I think energy prices are probably going to remain higher for much longer. So the obvious driver for energy prices right now is a Russia-Ukraine war. So that's the obvious driver. But beyond that, we see structural factors pushing up oil prices in the long run. So in the past, when demand was robust, when oil prices were high, you see oil companies pumping more oil. You see a lot of them investing heavily in production capacity. But this time around, you don't see that happening. And the reason for that is because of ESG considerations. You've got investor activism. You've got investors forcing all these oil and gas companies to invest in clean energy. And it is now a crime to even talk about oil and gas because of climate change and things like that. And that has resulted in underinvestment in your energy infrastructure over the years. So over the next few years, supply is going to be very tight, because even if companies right now, even if they ramp up on production, these new production, it will probably take a few years before they can actually come on stream to contribute to the global supply of oil and gas. So it will take some time for supply to pick up, even if they do decide to invest. And then you have also factors like energy security. Russia, after what Russia has done, I don't think Europe is going to go back to Russia for their energy supply. And this also means that European economies, either they invest in their own energy infrastructure or they go to alternative suppliers. They go to the US, they go to other countries for their energy needs. And this is going to chase the existing limited supplies of energy that we have in the world and further pushing up prices. And I think the future is definitely clean energy. That's definitely the future. But at this point, we are still very reliant on fossil fuels. That's a reality. And it will take a very long time before we can get enough investments in clean energy to achieve our net zero targets. So as of now, we're still very dependent on fossil fuels. And on the demand side of things, I think that is going to still remain high, at least in the foreseeable future. So we do expect some upside in terms of oil prices, even if right now we have, let's say, a peace treaty or a ceasefire between Russia and Ukraine right now because of all these structural factors.
Right, thank you, Viren. So maybe we take a break from interest rates because like 3 straight questions on interest rates. Maybe we can talk about China for a while, because I think a lot of investors are also concerned about China and its ability to achieve its GDP growth target. I believe it's right, 5.5%. And if so, by when? So, Viren, maybe you want to carry on?
I think the consensus right now is that China is probably not able to achieve its 5.5% GDP growth target. because of all the downward pressures that are putting downward pressure on its economy right now. You've got COVID zero, and you've got uncertainty on the regulatory front. So I think that's the consensus right now. But for us as a house, we are still confident that China is still able to achieve its GDP growth target for a couple of reasons. So the first reason is it's political. This year is a politically sensitive year for President Xi Jinping because he's going to seek a third term as the president of China. And he wants to show the world that China's economy has been under good stewardship and that China's economy has grown significantly under his leadership. And that is what he wants to show. So I don't think he wants to go into his third term with China's economy in tatters and with the Chinese economy not performing well because of all that downward pressures that it is experiencing right now. So first reason is political, and second reason is also because we think that a lot of support measures is on its way. So China is an economy of priorities. So a couple of years back when it was tackling excessive leverage in the economy, so deleveraging was the top of its economic priorities. And then last year you have got your the crackdowns on tech sector, the real estate sector, and the objective of this is to reduce the systemic risk posed by all these different sectors. Recently, that objective, that priority has changed because the government has come out to say many times that its priority right now is to stabilize the Chinese economy. So this is top priority right now. And you notice also the Chinese government, they talked about common prosperity for a very long time last year. But when was the last time you actually heard about Xi Jinping talking about common prosperity? You don't hear him talking about that right now because that has clearly taken a back seat. His priority right now is stabilizing the economy and economic growth. So in order for China to be able to hit its 5.5% GDP growth target, they have to do more. They have to introduce more stimulus measures, and they also have some funds left over from last year to spend. So at this point, if they don't do anything more, I think it's difficult for them to achieve that 5.5% GDP growth target. So we think that more stimulus support is on the way, and we think that China is still on track. They are still able to achieve that 5.5% GDP growth target.
Just to add on a few points to Weiren's second point about policy support, I think China and also the rest of the world, for instance, like the US, they are in very different stages of the economic policy. So China is currently on its way to, it's currently going for a more accommodative monetary policy, while the US, on the other hand, it is tightening. But inflation rates in the US, they are at near a 40-year high. However, inflation rates in China, they are rising. It's about 1 plus 2%. It's still manageable. So it gives the government more room to actually enact all these accommodative monetary policy measures also. And also recently, President Xi Jinping, he also called for an all-out push for infrastructure spending. Things like traditional infrastructure, railroads, your ports, and also for advanced infrastructure like artificial intelligence and cloud computing to stimulate the economy. Yeah.
All right. So thank you, Weiren and Dejin. So so Dejin was talking about a comparison between China and the US. Of course, the two of the biggest economies in the world, and rightly so. If we talk about China, we cannot leave out US as well. So maybe Dejin, like back to you. You can give us your outlook about the US market.
Sure. So right now, I think the outlook for the US market, it is definitely not going to be as great as 2021. So 2021 was actually a fantastic year for US equities. But going into 2022, there are a number of headwinds. So the biggest challenge facing the US economy, US stock market right now is rising interest rates. And with the Fed aggressively raising interest rates because they have realized that inflation is not transitory, and because they're too slow to act, they're already behind the curve. They have actually upgraded their forecast for interest rates. So just to give you guys some perspective, before the March meeting, the March Federal Reserve meeting, they were only guiding about 3 to 4 rate hikes this year. And assuming each rate hike is for 25 basis points, that will bring the Fed funds rate to about 1% by the end of 2022. However, after the May meeting, they actually raised rates by 50 basis points. And the last time they did that was actually back in 2000s. And I think it goes to show that they are kind of worried about inflation already. And they are going to, and more importantly, they are also projecting more rate hikes ahead. And rates could potentially reach 2% by this year end. So I think the greatest challenge right now is, the greatest risk is actually a policy misstep where the Fed tightens rates too much that it slows economic growth and sends the US economy into a recession. So this is something that the Fed will have to do delicately. It has to strike a balance between raising interest rates to lower inflation while ensuring that economic growth doesn't stall. Yeah, and on top of that, I think the outlook is also clouded by other issues such as the Russia-Ukraine crisis and also the lockdowns in China. And some of these things, they are really out of control of the US. They can't really do anything to change the outcomes of these events, not materially at least. And I think overall, US equities, even though they have fallen since the start of the year, I think in terms of valuations, they still seem rather expensive. And that's because you have to consider the valuation multiple PE earnings. Earnings have been revised down a little bit and could be revised down even more. And that's why valuations, even though prices have fallen quite a bit since the start of the year, valuations for US equities, they don't look extremely cheap right now.
I think there is also some good news on the earnings front, especially if you look at our first quarter earnings season. We've got a couple of high-profile earnings misses, especially from the mega tech companies like your Netflix. I think Amazon also didn't do well in terms of its latest earnings results. But other than these couple of high-profile misses, I think the majority of the S&P 500 companies, they have actually managed to beat earnings expectations. So on the earnings front, there is still some good news. Household balance sheets, I think that's also another silver lining in the US economy right now. Consumers are sitting on lots of cash because of the very generous stimulus measures by the US government. And this is also something that is highlighted. I think Feline just now mentioned a lot of the bank management. They have also said that consumer finances are in pretty good shape right now. So there is this cash cushion that consumers have to absorb any negative impact arising from higher interest rates as well as higher inflation. So yes, I think there is a lot of uncertainties with regards to the economic outlook for the US right now, but there are at the same time also silver linings that are mitigating factors for some of these downside risks that we are seeing in the market right now.
All right, thank you, Weiren and Tajin once again. So I think I'll just wrap up with with the last question, which is, do you guys think the era of low interest rate or cheap money, as many people call it, is over? Maybe Weiren, you want to start first?
Definitely. I think the question right now is how high interest rates are going to go, but we are definitely not going back to the era of a low interest rate environment anymore. So I think, so my answer to that is yes, I think it's over, and I think we all should be positioning for a period of high inflation as well as higher interest rates.
Anyone want to add on?
Yeah, basically what Weiren said, I actually agree with him. I think credit conditions in the US especially, it is rapidly tightening with interest rates rising, and the Fed is also going to trim its balance sheet. I think sooner or later, these will start to affect companies' margins and perhaps their bottom line earnings, and that could negatively affect their net income in general. So, and of course, interest rates, they also depend on inflation. So that's one thing that the Fed looks at. So assuming that inflation is going to stay elevated, it doesn't come down, then I think it's logical to assume that the era of low interest rates will probably be over. And what we should expect going into the next couple of years would be a high interest rate environment.
Right. Okay, so thank you, Wei-Ren, Tajin, and Ferlin for your time today. If you have any questions which we didn't have time to answer today, feel free to reach out to us via email or by our live chat on the FSMOne website. So email will be advisory@fundsupermart.com. If you have any questions, just feel free to email to us. We are always monitoring that mailbox, so we'll get back to you as soon as we can. Thank you. Thank you.
Thank you, Wei-Ren, Tajin, Ferlin, and Ron for answering our questions today. Before we head to our quiz and lucky draw where many prizes are about to be won, here are some upcoming happenings at FSMOne.com. Receive 3,000 rewards points by opening a new FSMOne account if you have yet to do so. If you already have an account, you can refer your friends to open an account and both of you could receive 3,000 rewards points. Here is the promo code on screen. From now till December, FSMOne.com is also offering 0% processing fees on ETF RSP. Pick from a wide range of over 70 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. Finally, check out our promotion where you can enjoy 2 free trades in selected ETFs and expand the horizons of your portfolio. Scan the QR code shown or head over to FSMOne.com homepage to find out more. And now, on to our quiz. If you think you know all about ETFs, now is your chance to prove it. 5 lucky winners will each walk away with $100 worth of FSMOne multi-currency cash account credits. We will be starting the quiz very shortly. Here is the QR code. You have to be on Event Live to join us at the quiz. So scan the QR code on the event flyer or scan the one up here on screen. Once you're in there, click on Expand Your Horizon and log in with your name and email. Once you're in and you're logged in with your name and email, click on Agenda and Activities on the left-hand side menu. And under the Agenda section, click on Quiz, and then click on the Join Quiz button. The activity window will be displayed on the right. Same thing here, once the quiz ends, a leaderboard will be displayed and you can check if you are one of our winners. We'll give you a couple more seconds to log in before we start. Fastest fingers first, you have to aim to answer our 5 quiz questions as fast as you can and rank yourself among our top 5 placings. All right. If we're all ready to go, let's start with the quiz. Moving on to quiz question number 1. Which of the following is not one of the 4 key areas where innovation is paving to the future of blockchain? Which of the following is not one of the key areas? Is it asset mining, asset software, asset hardware, or asset exchanges? Fastest fingers first. Which of the following is not one of the 4 key areas? Mining, software, hardware, or exchanges? Very soon, let's quickly look at the results. And it seems the majority of you did not get it right, but congratulations to all 22.45% of you. Asset software is the correct answer. Not mining, not asset mining, not asset hardware, nor is it asset exchange. Onto our leaderboard, currently in our top 5, we've got Shiya and Jay Tan, Hui Ying, and Moritz Sam. Congratulations. But not to worry, the results could change at our next question. Moving on to our second quiz question today. Of the 5 that we have, you've got 4 more chances to go to get your name up on the list. Which of the following is not one of the three main types of commodities to be impacted by the Russian-Ukraine crisis? A little hint, subtypes are not counted. Which of the following is not one of the three main types of commodities to be impacted by the Russian-Ukraine crisis? Oil, metals, energy, agriculture. There are three main types to be impacted by the crisis. Which of these answers is not one of the main types? And the answer is oil. Congratulations to the 23.53%. It's interesting that 52.94% chose metals and a small 9.8% chose agriculture. Oil is the correct answer for this question. And onto our leaderboard, J-Tan, Shiya, Dor, N, and NLH. I think Dor and NLH rose up to the rankings. Congratulations. As you can see, the rankings change after every question. The faster you answer, the higher the chance you have to rise up and climb up our leaderboard. Moving on to question number 3. Which of the following is a sub-theme of future mobility? Which is a sub-theme of future mobility? We've got batteries, multimodal, hydrogen cars, and energy storage. Which do you think is a sub-theme of future mobility? I hear batteries and hydrogen cars amongst the audience. We're looking for a sub-theme of future mobility. And congratulations, close to half of our audiences out there got this correct. 47.27% chose batteries and got it right. Energy storage took up 14.55% of the answers, and followed by multimodal at 14.55%. Congratulations, I think more into some climbed back up to rank 5. J-Tan and TH and Hui Ying, congratulations as well. I think Cindy and Lo climbed up to rank 9 and 5. We've got more chances up ahead. Get your fingers ready because we're about to start. Question 4. Which country in the market leader in the rare? Which country is the market leader? Brazil, Russia, China, or the US? We're looking for the market leader in the rare earth metals space. A lot of these came up in our sharing earlier. We're looking for the country that is the market leader in the rare earth metals space. We've got Brazil, Russia, China, and the US. And congratulations, the majority of you got it right. 79.31% chose China. No one chose the US, and Brazil and Russia took up a small percentage. Congratulations. Very on, we have to move on to the leaderboard and check out who managed to keep their ranks in top 5. I see J-Tan, N, and TH have maintained very strong rankings in our leaderboard. Congratulations, Ellen Tan and Moritz Sam as well for staying out here. Very soon, our last question will come up. Don't lose hope. Get ready to answer as fast as you can. By which year will the adoption rate of net zero carbon emissions be doubled in Asia Pacific? We've got 2023, 2025, 2028, and 2030. By which year will the adoption rate of net zero carbon emissions be doubled in the Asia Pacific? This is our last question. Will you be one of our 5 lucky winners, walking away with $100 FSMOne multi-currency cash account credits? We'll find out real soon. 71.93% chose 2030, but the correct answer is 2025. 14% of our audiences out here got this correct. And wow, a lot of you have maintained your rankings in our leaderboard. Jay Tan, Moritz Sam, Shiya, Ellen Tan, and Anne, congratulations! If you are one of our top 5 rankers, please take a screenshot showing the whole activity window. Ensure your rank, score, and nickname are captured clearly. Then email the screenshot and include your name, your FSM account number, and the daily quiz date to events@fundsupermart.com. Once again, the email is events@fundsupermart.com. Make sure to email us by 31st of May to claim your prize. Congratulations once again to all our winners. And now, for those of you who are here in the hall today, it is now time for our lucky draw. Let's invite on stage Wei Ren to give away the lucky draw prizes. Wei Ren, please. If your number is called, please come to the stage to collect your prize. You can check your number on your event flyer. We will start with our first 7 lucky winners who will walk away with $100 FSMOne cash account credits.
All right, we have our first winner. The lucky number is 8390. 8390. Are you here?
Congratulations, sir. A round of applause for him, our lucky winner.
Okay, congratulations.
You can take a photo right there.
Congratulations.
And our second lucky winner to walk away with $100 worth of FSM cash account credits will be...
Our second winner is 8383. 8383. Are you here?
A beautiful number. Congratulations.
All right, congratulations.
We've only just started with our lucky draw round, but to keep things exciting, our last winner, not the 7th, but the 8th winner, there will be an extra 1 lucky winner very near the end of this segment who will win an iPad.
Yes. Thank you. Congratulations. Congratulations. And our third winner is 8370. 8370. Are you here?
If you're not physically present to collect your prize, we will have to redraw. Oh, congratulations, sir. A round of applause for our lucky winner.
Yes, congratulations.
For those of you who have yet to come out on stage, don't worry, we've got 5 more prizes to go.
Congrats. And our next winner is 8438. 8438. Are you here?
We'll give you about 3 seconds and we'll do a countdown. If not, Wei Ren will have to pick another number. The number is 8438. In 3, 2, 1, let's work your magic, Wei Ren.
The next lucky winner is 8396. 8396. Are you here?
Counting once, counting twice, 3 times, and it's a pass. Make sure to hold on to your event flyer.
Okay, the next number 8432. 8432. Yes, we have a winner.
Congratulations, sir. Let's welcome him up on stage. After 3 tries, we've got our lucky winner.
Congratulations. Okay, congrats. And the next lucky winner is 8384. 8384.
In 3, 2, 1, let's pick another winner. Hold on to your event flyer so you can always check what your number is.
The next number is 8408.
Congratulations! Let's welcome him up on stage.
Congratulations. Okay, congrats.
We've got 2 more rounds to give out our $100 worth of FSMOne cash account credits.
The next winner is 8385. 8385.
Congratulations, sir. Let's welcome him up. We have one last $100 FSMOne cash account credits to give away before we do our last draw to decide who is our extra lucky friend out here today. That prize will be an iPad up for grabs, so good luck to all of you out there.
Okay, congratulations. Our next lucky winner is 8429. 8429.
Give it a 3-second count. 1, 2, 3. I think it's time to find a new winner.
Eight, 3, 6, 6. 8, 3, 6, 6.
Is that you, sir? Yeah, congratulations! You are our last winner who will walk away with our $100 FSMOne cash account credits. Oh, very long legs.
Oh, yes. Congratulations.
And now it is time to give away our iPad, which is that little box lying on the table behind Wei Ren. I think this deserves a round of applause for the extra luck. Good luck to all of you. Only one person will walk away with this iPad.
And the winner of the iPad is 8387. Are you here? Yes, we've got a winner.
Congratulations, sir. I see you're extra lucky today.
Congratulations. Congratulations.
Congratulations once again to all our winners, and thank you, Wei Ren. This wraps up FSM ETF Festival 2022. We hope you've both enjoyed and taken away useful lessons from the various segments and presentations. To catch up on any of the segments, you can head on over to FSMOne.com or on the YouTube channel where a replay will be posted shortly. That is all for FSM ETF Festival 2022. Till next time, goodbye.
The internet basically opened up a new channel. You can reach out directly to consumers, to investors.
iFast TV is going to be so accessible, and there will be a lot of programs, many different types.
I'm here on FA Explains.
Welcome to Last Station.
Welcome to Retirement with Ease. Alright guys, welcome to this roundtable.
Welcome to another episode of Our 2 Cents.
The ideas and plans we have for iFast TV gets bigger and bigger as we get more excited over all the possibilities of what we could do in this new department.
And here's my investment resume. 歡迎你嚟到我嘅 YouTube channel. Welcome to another episode of Money Matters. Welcome to the iFast TV Market Outlook 2022 series.
Tune in to iFast TV if you want to hear all these different programs in the different languages and dialects.
I must have been in my early 20s when I started investing.
Started working in a stockbroking firm as an investment analyst. Later, I really find that investment was my passion. So
I just went to buy my first stock, and that was how I started.
Investing is never about punting.